Chapter 14, Conventional FHA and VA Loans. In this chapter, in this chapter, we're going to describe the issues concerning mortgage financing. We're going to learn about various different mortgage payment plans. We're going to distinguish the differences among conventional, insured, guaranteed, and New Jersey's homebuyer programs. So without further ado, let's dive in. So, home buyers often require some sort of money for a down payment in order to get a loan to buy real estate. Most people don't have all the cash to buy. Do you guys agree with that? Is that a fair statement that most buyers don't come into a real estate transaction with all the cash needed to buy? So they need some money, though, to put down, and then they could get a loan for the balance. Well, why would anybody lend you money? Well, to make money. How do
Mm.
they make money? By charging you interest.
Interest.
What is interest? It's the charge or the rent you pay to use someone else's money. And interest is calculated on an annual basis. So that's how you would calculate the interest rate. You take the loan amount times the interest rate and then divide that by 12 to figure out what your first month's uh,
Interest. The
payment
payment.
goes
Payment.
towards the interest, what the first month's payment goes towards the interest. Okay. So the value, the word value, anytime we're trying to figure out the value of something, we're trying to figure out all of it. So value means 100%. The LTV is an abbreviation for loan to value ratio. It's how much the lender will loan you in relation to the total value, the appraised value of the property, not some crazy overpriced offer that you made. The lender's only going to lend you how much money an appraiser says the property would be worth. They would not lend you more than that because that property serves as collateral for your loan. As a matter of fact, they usually don't lend you all of that because they want you to have some skin in the game, so to speak, right? You got to have some sort of a down payment, some money. So the LTV is the loan to value ratio, how much they'll lend you in relation to the appraised value of the property. And let's just take your typical conventional loan that would require 20% down. So your LTV is 80%. They will loan you 80% of the appraised value if they're requiring you to have 20% down, right?
Mm-hmm.
And your typical FHA loan requires 3.5% down. So the LTV is not 3.5%, it's 96.5. They will loan you 96.5% of the appraised value. Everybody understand how LTV works? That's all it is. It's just telling you how much the lender will loan you after you subtract the down payment that you got to have,
So there
right?
are two examples, right? The example first one is 80%, second one is 96.5%, right?
Correct. Correct. So if you have a type of loan that requires a 3.5% down payment, the LTV is 96.5. The
Right.
lender will loan you 96.5% of the value of the property. Okay. So if I were to tell you the LTV is 90%, how much money you got to put down?
10%.
10%. Not difficult concept.
Right.
All right. So equity. Equity is your built-in value. Equity is the difference between the market value of a property and what it's currently worth. So you could build equity in several different ways. Through periodic payments, paying down your loan. As you make payments down on your loan, you owe less. You're building equity between the market value and what you owe. You could also do home improvements, which increase the value of the property, building more equity. or just do the market values fluctuating naturally. If the market values are going up in the market and you did nothing to your house, well, you're building equity, right? So those are three typical ways to build equity in a home or in a property. So you got the words here: interest, value, LTV, and equity. All right, so let's highlight what is equity on page 267. At the time of purchase, the buyer's equity is equal to their down payment. Makes sense. So equity is the difference between the market value and what is owed.
We have to highlight, right?
Just highlight, at the time of purchase, buyer's equity is equal to their down payment. And then put in there a little definition, or do they have it up here?
Where is the line? Yeah. At the time.
Yeah, they don't have a good definition of equity right here.
I don't see the line.
You don't see what?
Liabilities.
All right, let me take a look.
For buyers.
That's page 267. Let me take a look. Let me get
seven. Got it. I was in 68.
Ah.
Okay. Got it. Okay. Yeah.
Cool.
I have to write it down. Equity is the difference between market value and what is owed.
Yeah. That's the simplest way to understand it.
At the time of purchase, the buyer's equity is equal to the down payment.
What is that? So build the equity. That is a positive word, right? You have to build your equity.
Yeah, you build equity as you pay down your loan. Right? Till you eventually pay off the house. And then it's all equity. Because you don't owe anything on it anymore, right? So equity is the difference between what you owe on the property and what the market value is. All right. So interests is the rent the borrower pays. So let's just highlight these things. We just went over these, page 268. We went over what interest and what LTV is. But so LTV is the loan to value ratio. It's how much the lender will loan you in relation to the value, the appraised value of the property. And this has increased from 40% in the 1920s, when in the 1920s, the lender would only loan you 40% of the appraised value.
So 60% we have to pay.
You needed to put down 60% of the cash.
Wow, that's too much.
Yeah, that's a lot, right? To as much as 95 or 100% today.
Yeah.
And payment periods have also lengthened from the 1920s, where they only gave you 5 years to pay back that 40%, to as much as 30 years or more today.
Wow.
30 years is the average loan today, right? Back in the 20s, it was only 5 years. So you had to have 60% of the cash to put down, and they'd lend you 40%, but you had only 5 years to pay it back. So that really limits who's able to buy a house, right? You need to have people really have a lot of cash. So you had a lot of renters back then in the 1920s. Only the rich people really owned houses, right? Who's got 60% of the cash to buy a house, right?
Only the wealthy.
That's it. So interest rates charged by lending institutions on home mortgage loans vary as changes occur in the money market. As interest rates move up, an established fixed rate mortgage with a low interest rate may be a plus when selling a home. Just the other day, interest rates went down 1/4 of a point. They're expected to go down 2 more times this year before the end of the year. So that's going to be good for home buyers, right?
Hmm.
On the other hand, if a mortgage interest rate falls, homeowners may seek to pay off their loan and refinance at a lower rate because they could get it at a lower rate now.
Yeah.
So to buffer the effects of an unstable money market, lenders have been offering many alternative forms of mortgages in recent years, like adjustable interest rate mortgages. Seller financing also becomes popular when the banks aren't lending.
So how is the refinance works? You have to do like,
Refinancing is just getting a new loan to pay off your existing one, and when the rates are lower.
is there any time frame that, okay, you should do it in every 2 years, 3 years, something like that?
Why?
No, right?
I wouldn't do it that often.
Okay.
You know, it has to be worth it, first of all.
Okay.
Remember, when you refinance, you're just also lengthening out the loan term again. Unless you're getting a shorter loan, and then that could affect how much you're paying as well, because if you're paying it back in shorter period of time, the mortgage payments will go up, right?
Yeah.
So does it make sense to refinance is the first question you should be asking. Not how often should I do it, but
Right.
does it make sense to refinance? I know
Okay.
interest rates are a little bit lower than when I got it, so does it make sense for me to refinance right now, or does it have to go down more for it to make sense for me?
So you
Hmm.
usually refinance when it's at a lower interest rate, correct?
But how much lower is the question, you got to see, is it worth it for me to refinance at this time? Because sometimes there's loan costs involved with refinancing too.
What's the loan cost?
So you have to see if it's worth it. Plus, when you refinance, say you got a 30-year mortgage loan and you're 10 years into it and the interest rates have fallen, they're lower than what you got your loan at. When you get a new loan, are you going to get it at another 30-year mortgage?
No.
But your interest rates will be lower and so will your payments. Or would it make more sense to get a 20-year mortgage loan at a lower interest rate? You gotta analyze the numbers for yourself and see what makes
What is
sense.
best for you?
Yeah, so it may not always make sense to refinance depending on how much lower the interest rate has fallen.
Mhm.
So for years, potential homeowners have been able to receive assistance in obtaining low down payment mortgage loans through government programs of the FHA, the Federal Housing Administration, and the Department of Veterans Affairs, the VA. In addition, private mortgage insurance companies have been offering programs that enable loan applicants to receive higher LTV ratios from the private lenders that they couldn't otherwise obtain, right? Because conventional banking theory states that if the lender loans you more than 80% of their depositors' money, they're taking a risk. So anytime you get a higher loan amount than 80% on the LTV, you're required to carry PMI, private mortgage insurance.
Okay.
And what does that insure? Well, we'll get into that in a moment. Let's see, interest rates fluctuate. Okay, we just went over that. When interest rates are high, alternative forms of financing may be. Okay, this is all the stuff that I just read. So let's move on. Okay, here is a slide that probably should be an explanation in the book here, but it's not. Let me see. Okay, so what is a urban area? Urban area is a densely populated area. You have a lot of people living within a close proximity of each other. So you got a lot of dots there. Those are a lot of people living within a close proximity of each other. That's an urban area. Then you have suburban area, where people are living, they're a little bit further apart from each other. They may not be living in apartment buildings and high rises. They have single family or multifamily homes, right? And then you have rural areas where people, that's like farmland or living out in the country. You got homes that are spaced apart a lot further. So that's a difference. You see, urban, a lot of people within a close proximity, suburban, uh, or suburbia, people living a little bit further apart from each other. And then rural, people living much further apart from each other.
So we are urban. We are urban. Edison is urban.
Yeah.
Okay.
Well, actually,
Say
Edison,
more about suburbs, because
actually,
usually urban is more like city wise.
yeah, Edison is more of suburbia. It's more of
Okay.
suburbs.
Okay.
Yeah. Because you don't have people, you don't have all these high rises and apartment buildings, people on top of.
Oh,
Even
that should be New York. That should be New York.
New York City is definitely urban area.
Right.
Okay.
Most city areas are urban.
Yeah, it's the inner cities, the big cities where people are living close together. It's all apartment buildings and high rises. You don't see single family or two family houses around.
You don't see acres with land and stuff like that.
Yeah, dude, that's rural. Yeah, with the acreage. Yeah, definitely. So those are my definitions there for
Okay.
what a rural, suburban, and urban is. You really should know if you're going to be entering the property field what an urban, suburban, or rural area is.
That's why I wanted to go specifically.
Yeah, yeah.
Yeah.
So
That's
it's not really in the book, so if you want to snap a picture of this slide for your own,
Yeah. Give me a sec.
I'm going to suggest they add something, some kind of definition. They could put a simple definition there. What is a urban, suburban, and rural area?
Come on.
Not that it's on exam or anything, but you need to, you need to know this if you're going to be in a
Of course, yeah.
field.
I'm done. I did it.
Okay. So let's take a look at some fixed rate loan programs. The word amortize, let's first analyze that. The word amortize means to kill off slowly over time. And in a fully amortized loan, that's exactly what happens. You're killing off the debt agonizingly slow over the next 30 years if you have a 30-year term. So
in other words, it's basically you're paying the minimum.
No. Okay, hold on a second. The word amortize means to kill off slowly over time. Okay? Means to kill off. So in a fully amortized loan, by the time you make your last payment, you fully killed it off. That's all that means.
Oh, okay. I was looking too much into it. Got it.
Yeah. So the payment amount doesn't change. Your first payment through to your last payment remains constant over the entire life of the loan if it's a fixed rate loan. Payments get first applied towards your monthly payments. They first get applied towards the interest that is owed, and then the balance gets applied towards the principal. The principal is the amount you borrowed that you're paying down. Okay.
So in this case, that person, whoever does this way, there is no refinancing. He's paying same amount until he finishes that 30 years or 20 years.
Hold on. You can refinance these loans if you want. That's a different subject altogether.
Okay.
We're just talking about like the typical loan that you have. You could refinance any loan. Okay.
Yeah.
Right now we're just talking about the basic structure, the basic setup of a fixed rate loan. Yeah, we're looking over different types of fixed rate loans right now.
No.
They're not adjustable. Okay. So the rates, the interest rate is fixed for the entire life of the loan. So your monthly payment remains the same over the entire life of the loan as far as the loan goes. Okay. Now people's payments, they usually do go up over time because their taxes went up. And if they include their taxes in their mortgage payment, well, then that would affect but we're just strictly talking about the loan here. We're not talking about any other housing fees, okay? So in a fixed rate loan, your monthly payment first gets applied towards the interest that you owe. That's the rent for the borrowing someone else's money, the use of someone else's money that you pay. And then whatever's left over from that monthly payment gets applied towards paying down the balance of what you owe. Okay. So by the time the last payment is made, the loan has been fully amortized. It's been fully killed off. Okay. See what I'm doing? I'm translating the word in my head. I'm defining the word in my head. Anytime I see these words that we're learning, until the loan has been fully amortized. Well, what does that mean?
Mm.
It means it's fully killed off, because amortize means to kill off, right? So until it's been fully killed off and the balance is zero.
Okay.
Now, a straight loan is an interest-only loan. You will never pay down a straight loan because your monthly payments will only cover the interest owed. The entire payment gets only applied towards the interest. So therefore, these are not meant for long-term ownership of a house because you'll never pay it off. These are only for straight loans or short-term loans. They're meant for short-term only. So the monthly payment gets only applied towards the interest owed. So it never gets applied towards the principal to pay down the loan. These are often used as a second mortgage, as a bridge loan, when you have to go through with the purchase on your next home before you actually closed on the sale of your first home. Sometimes we usually try to coincide closings that they happen within the same month so that the homeowner / buyer is not going to have to pay a mortgage payment loan on two houses in the same month. A lot of people can't afford to do that. So, but sometimes it's necessary to close on the purchase of the next home before you actually finish the sale of your existing one. Well, how can you do that if you can't swing the payment? Well, there's something called a bridge loan, also known as a swing loan or interim financing. It's not usually meant to be longer than 6 months. It's an interest-free loan, or an interest-only loan, where it's only meant for short term until you could sell the house. Okay, so it covers 2 payments.
So
Yeah.
this is straight loan called a swing loan or bridge loan, right?
It's called the bridge loan, swing loan, or interim financing. Okay, we'll have a slide just for that.
Okay.
Okay, so and then we have a short. Let me see, and then we have the straight loans, which are used by builders and investors for fixing and flipping properties. Those are only meant for short term. You only pay the interest on there to make the lowest payment possible. You're only paying the interest. And then you're going to sell it. And then when you sell it, you pay back the loan in full. Okay? So not every loan is meant for buyers to use to purchase. There are there's different purposes out there for different types of loans. And this is just showing you an example of that. A short-term loan for builders and flippers who are rehabbing houses. They only pay the interest only. And then when, after the home is built, they put it up on the market for sale, they sell it, they pay back the entire loan. In the meantime, they make the smallest payment possible, only paying the interest. Okay, so let's now highlight all that stuff that we went over on my slide. The word amortize means to kill off slowly over time. Regular payment applied first to interest owed, and the balance then applied to the principal over the term.
1 second.
Regular.
So for example, if I have other house, I can just have interest loan on that, right?
It's not
If
meant.
I'm paying.
It's not meant for homeowners to be in the house for the long term. That's not what
No,
it's.
the
You,
short term. I'm talking about short term.
yeah. For
Mm.
what? What's the reason you would want a short-term loan?
Because you said that in this case you are paying the mortgage for your house, the first house, right?
You're paying interest only on this loan so that you could swing the payment on two houses. Because you may only be making enough money to make one mortgage payment. So the short-term loan is meant to go towards paying the mortgage payment on the other house until you're able to sell it.
Mm.
You should be able to sell your house within 6 months.
Oh,
So they're meant to be short-term loans.
okay, hold
Okay,
on.
it clicked. Now it clicked. Okay.
Okay?
So basically, I have a home, but I have a second home I'm purchasing, but I want to finish paying off my first home. So I'm going to take out the second loan to,
You're going to be making the to swing the monthly payment until you sell it,
yeah, okay.
which hopefully is
But I
as soon
think it's
as.
a better example is to use like if I had I'm selling my first home, but I'm purchasing a second one,
Yeah.
and I want to use that money to do it like a fixer-upper.
No, no,
No,
hold on, no. Okay. Um, you're moving for work.
okay.
Okay. You're moving
Mhm.
for your job. You have to relocate. So you found the perfect house. You've been shopping. You found the perfect house. Um, and your offer's been accepted. Now you haven't sold your existing house yet, the one you're moving from.
Mhm.
And you don't want to let that other one that you just found, you don't want to let it go. So
I want to take out a short loan.
so you really need to purchase it before you closed on the sale of your existing one. But you
Okay.
can't afford the payments on two loans, only on one house, right?
Mhm.
So you take out this interest only short term loan that would allow you to continue making the payments on one of the houses until you sell it. It'll help you
Mm.
swing the payment,
Okay.
right?
Mhm.
It's just it's a short-term loan.
And it only lasts for 6 months, right?
It's usually not meant for more than 6 months because you should be able to sell your house in 6 months. Not unless you think it's worth way more than it really is, and you got all kinds of issues. If a house is priced right, you should be able to sell it.
Okay. Kind of. We get it. I got it now.
Yeah. So, in a partially, if amortize means to kill off over time, what does partially amortized mean? It means you only partially killed it off. So, in a partially amortized loan, periodic payments do not fully amortize by the end of the term. So, at the end of the term, there's still a balance. That last payment is usually larger than the rest of them in order to fully amortize it. That larger last payment that you have to make is called a balloon payment because it balloons in size compared to all your payments throughout the term of the life of that loan. It's just that last payment is larger than the rest. Now, the benefit of having a partially amortized loan is that over the life of the loan, you have lower monthly mortgage payments.
Right.
But that last payment's larger than the rest. So, what do you do with that? Well, if the last payment is larger than the rest, hopefully, well before you get to that, maybe you have a chance to refinance it. So you have
Right.
to deal
And
with
they
that
used to call,
larger payment.
yeah. I was about to say they used to call that balloon payments.
Yeah.
I remember that term.
Or you save up the money to make that last balloon payment. It balloons in size, right? You blow up a balloon, boom, it gets bigger, right? So
Mhm.
that balloon payment is one that's blown up. It's larger than the rest. Okay. And a biweekly mortgage, a lot of people misunderstand this. They think it's 2 mortgage payments a month. You know, every 2 weeks. It's not. It's a half payment every 2 weeks.
Yeah,
Bi-week.
it's like a salary you get every 2 weeks check, right? So you
Okay.
have to pay.
So you're making a half a mortgage payment every 2 weeks. The equivalent of 13 monthly payments or 26 half payments a year, which is the equivalent of 13 monthly payments. How many months are there in a year again?
12.
So you are making one extra payment a year where the entire payment goes towards the principal.
I'm not gonna go with this one.
Why not? It'll pay off a 30-year fixed rate loan. You could have it paid off in 23 or 22 years by doing this. So
Oh,
you could save about 8 years of mortgage interest payments
oh.
by making a half payment every 2 weeks. Or if you have the ability to budget your own money well, just save up the money and make one extra mortgage payment a year and apply it towards the principal. Only the principal. And it could have the same effect. Better if you make the payment at the beginning of the year. So this is basically you making a half payment every 2 weeks. It's like throwing your change, your spare change in a cookie jar, and then at the end of the year, using all that spare change to make one extra payment apply towards the principal. You barely notice it. This is really good for people who have trouble saving their money. All right, it burns a hole in their pocket and they got to spend it. All right, so this is kind of transparent to you. You don't even realize you're making that extra payment because you're only putting a couple extra bucks towards that monthly payment every 2 weeks, right? Um, but if you were able to save the money on your own and you were able to make the beginning of the year a full extra monthly payment, you're paying down the principal. So throughout the rest of the year, that's that much less money they could charge you interest on. So
Hmm.
you're saving on the interest. Okay. This could be a huge savings. Look, if you have a $300,000, do I have this coming up? No, right. Yeah, here it is. If you have a $300,000 loan at a 5% interest rate, okay, look, this loan, you could say you could shave off 7 to 8 years off the loan, right? Um, if you have a $300,000 loan at a 5% interest rate, if you have a 25-year loan versus a 30-year loan, you're saving $53,460 in interest payments.
Ooh.
That's only for 5 years. And these are for two different types of loans that are set
Right,
up that way to
right.
begin with. So it doesn't even really match up quite accurately. So when you make an extra payment on your loan and apply it entirely towards the principal each year, um, you're saving even more.
That's how I do my car notes. I don't
That's
ever take it to the full term.
that's huge. That's huge. Yeah, it's a lot of savings, you know. You're basically uh, saving on that interest, the rent, by paying it off sooner. Okay.
Mhm.
So let's do the highlights now of this. Fully amortized, a straight loan is an interest only loan where the larger, okay, and then we have this one where the final payment is larger than the others. That's called a balloon payment, and that's on a partially amortized loan. And then we have the biweekly mortgage, which involves half payments every 2 weeks instead of monthly, the equivalent of 13 monthly payments a year. That money, extra money applied entirely towards the principal.
So my question is, I'm just comparing, means mortgage and finance, I don't handle, my husband handles. So my question is, if you have installment for 25 years for mortgage to pay, why the last payment is always like balloon size? Why?
It's not. It's only in a partially amortized loan.
Okay,
If
partially
it's a
amortized.
fully amortized loan, your first payment all the way through to the last is
Last payment. Okay.
it's the same. Doesn't fluctuate at all.
Where is money mortgage loan required?
That's only for the
And
that's only
and
a
P
partially amortized loan.
and just asking generally, people usually they like bi-weekly. Do they go for it?
A lot of people are
Bi-weekly.
aware of it.
Really?
Have you heard of it before?
No, bi-weekly, I never heard that.
A lot of people never did. And those that do, you ask them the definition of it, and they usually get it wrong. They think it's making 2 mortgage payments a month.
Yeah.
No, that's not what it is. It's a half payment every 2 weeks. The equivalent of 26 half payments a year, which is the equivalent of 13 months. So you're basically, it's your way of making an extra payment every year, applying it towards the principal, just by taking the extra change in your pocket and throwing it in a jar. That's kind of like what you could equate it to. You don't really notice the difference because you're not making a big payment all at once.
Balloon payment.
It's a way for people who have trouble budgeting their money to be able to do the same thing. You could either have your loan set up this way, or you could just make those extra payments on your own. Sometimes when you already have an established loan and you contact your bank to try to set up that you could do a bi-weekly mortgage payment, they may charge you like $600 or $800 to set it up. What are you setting up? It's an Excel file, for crying out loud.
Yeah.
Right.
I mean, it's not difficult to set up. It's just another way for them to make money, I guess, now. In the past, they didn't really charge you for that. Now they do. So you're better off just making the extra payments on your own.
That's what I do. I said I want to put it towards the principal. So say
only the principal.
500, I put it towards the principal, not the interest.
Correct. Because why would you want to pay the rent early, right?
Right.
Why would you pay the interest only? If I pay down the principal, that's that much less rent you're going to charge me for the use of your money. Right? Because I borrowed less. Because I paid down the principal quicker.
Why you have over there page 267? It should be 69, right?
Oh, is it?
Yes, it is 269.
All right. Do. Boom, 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 boom.
Got it.
Oh, that's a C. I'm like, what is it?
Okay, go.
Good. I'm done.
All right. How about this? Which would save you most money? Getting a loan at a lower interest rate or getting the property at a lower price?
That's tricky. Get a loan at a
lower price. Lower price?
Or get a property at a low price.
I want your answers, and then I'm going to play this. This is a show
Which will
where they have a couple financial experts on it that'll explain it to you.
I would say lower interest rate.
So you change your mind.
Lower price.
All right, let's take it.
Lower price.
Yeah, hey Seth, I want to ask you something about the housing market. My wife and I are looking to buy a new home. I've read that the housing market is in a recession, and that maybe, and I've been told by various people, hey, no, hold off, don't buy right now, that prices may be inflated. Is the housing market in a recession? Is now not a good time to buy, or is it? Or is it? I don't know.
It's a broader question, John, and a lot of it depends on where in the country you are. What we tell people all the time is what you want to make sure you're not doing is overbuying house. If you're looking at your interest rate right now, and to Dan's point, that inflation is what's causing interest rates to go up because the Fed's trying to get that under control. So you've got this compounding issue in the housing market. The problem you got, I would say the one thing you want to focus on is you can refinance interest rates. You can't refinance principal. Principal, whatever you pay for that house is what you bought that house at. Now, in certain pockets, maybe where you are in Miami, where I am in Texas, not where Dan is up in New Jersey, I think in our neck of the woods, prices are going to stabilize. They may not go up as fast, but I think they'll still continue to go up. Maybe not even drop. If you're in a cash position, that's great. If you're up where Dan is, I think they're going to drop. So you might have a buying opportunity. But where we are, I think you might want to, if you find the right deal, get it. but plan to refinance as soon as interest rates do drop.
Yeah, Dan, I don't know where you are, but I read recently that Jersey City has now become the most expensive city in America. I used to live in Jersey City, and boy, I wish I would have bought when I lived there way back 15 years ago, whenever it was. Seth Benson and Dan Geltrude, I appreciate you guys coming on for Money Huddle. Appreciate it. Have a good day.
So there you go. What's the answer? What did you get out of that?
I got the lower price.
Price. Yeah. You'll save more by getting the property at a lower price.
Yeah.
Because you can always play with your interest rate. You
Yep.
can refinance, or you can pay more on your principal than actually on the interest.
There you go. So you could get the property with a high interest rate loan, but then when interest rates drop, you could always refinance it later,
Right.
lower interest rate. But the price, whatever you buy it at, you're not
It should be
you're not
lower.
changing that. Whatever you buy it at,
Yeah.
that's what you owe. Okay.
Very good question.
Yep. All right. So here's a chart for you. You can see this in the book on page 269. Is that on 269? I got my page numbers
Yes.
right?
So
Okay.
260.
Here's page 269. Here's a chart where you could see each bar represents 1 year of a mortgage loan. Okay. The dark color is the interest, and the lighter color is the principal. So, as you could see, for at least the first half of a 30-year mortgage, where does the majority of your monthly mortgage payment get applied to?
Your interest.
The interest. And this small little amount you see up there at the tippy top of that?
Premium.
That's the
Principal.
principal. That's the small amount that goes to pay back the loan that you borrowed. So your monthly mortgage payment, by far the majority of it, goes towards the interest first, and then this tiny amount up here towards the principal for at least the first half of a 30-year mortgage loan.
That's because they want their money back first.
Yeah, why don't they just apply it 50-50 all the way across? They could do that and still make the same amount of money.
Mm-mm.
How come they don't just say that, hey, your monthly mortgage payment, half of it goes towards the principal, half of it goes towards the interest? How
Right.
come they don't just do that?
Because they're not making no money off of it.
No, they can make the same amount of money.
I don't know then.
Huh?
If
How
they're
often-
making the same amount,
How often do people stay in homes these days?
a lifetime.
Really? They do?
Well,
This ain't,
Well, I
this
know
ain't your
people stay
parents
there.
or grandparents' house anymore. The generations have changed a bit here.
Right.
I still got my generations. That's why I'm like, well, we still got our houses.
Yeah, but look out there, look around you. You know, open your eyes, look around
So
you.
our grandparents are passing down, and or they're resizing into smaller homes. They're not
Have Your
taking the big
neighbors
ones.
changed recently, in recent years? Have any of your neighbors moved out and the neighbors have changed or moved recently?
Yep.
How often do you see that? You know, if you start paying attention to that, you could see, well, they're not staying in that home for generations.
No.
People are moving more and more often.
Yes.
The average that people are staying in houses, anybody know what that is?
Like
And
not
20
for
years.
longer time. Not for longer time they're
Well,
living.
I cannot quantify that. You need to give me a number. On average, how long do people stay in homes these days?
15 years.
10,
20.
15 years.
No. Then how you
Five-
get mortgage rates? Because mortgage rates
Seven.
usually has to be
5 to 7 years.
Ooh.
it dropped that bad.
And some are even moving after 3.
Wow.
Is that a
So how do
benefit?
you
Is
get-
that
how
a
do you-
benefit to move like that?
Well, the questions you should be asking is why?
Why?
Societal changes.
Oh.
We have a lot of changes in society. You know, do people, first of all, just take a look at manufacturing for a second. Do we really make anything in America anymore?
Mm-mm.
Very, very few products. They're usually made
Right.
overseas, you know. That's like one of the things that you're seeing right now. You know, president's trying to get manufacturing to come back to the United States.
US,
know,
right.
We don't make anything here anymore. So everybody wants to be the boss. Everybody wants to have an administrative job. So you're not tied down. You don't need to live near the factory where you build the widgets, right?
Mhm.
So people, they're free to move around more. So they tend to, and they change jobs more often. They don't stay with that same job these days anymore. It's not like you had that job at the factory building the widgets and they gave you a great pension and benefits. So people keep shopping around for different jobs, keep swapping jobs and moving all the time. Then you're not really tied down as much. You have you're having more and more people that they don't have a full family structure, so they don't have to worry about the spouse and the kids. Single parent families are becoming more prevalent, right? You got people that they don't have marriages, or they're divorced or whatever. So it's not a matter of trying to coordinate with your spouse about their job too and your job, and does it make sense for us to move as a family unit? Where you tend to lay roots a little bit more. So it's a little bit less stable when you tend to move more and more often. It's not like it used to be where your grandparents lived in this house, and then your parents lived in this house, and then your parents had you, and they raised you in this house, and then you're going to raise your kids in the house. It's not like that anymore.
That's true.
So
Yeah. It's
this
kind of
one,
sad. It's kind of sad too, but
Yeah, it is.
it's what it is. It is what it is.
so my question is, how are they doing the mortgage loans now?
Well, this is why the lenders put the interest heavy up front, because they know you're
Ooh.
not going to be in that mortgage in that house for the life of the loan. So they want to get their interest up front. So this is why they make those
High.
most of the monthly payment gets applied towards the interest up front, because they're not counting on you being here later on.
Oh man, now I got it.
Okay.
Okay.
So then how do you get out of a 30-year mortgage? You sell your place
You
and
sell your place and pay it off.
okay.
Yep. Okay, so let's look at now. We were looking at fixed rate mortgage loans. Let's take a look now at adjustable rate mortgages.
It just can't get easier, huh?
It's just a different type of loan. Adjustable rate mortgage, or we can look at the initials for it, an acronym, ARM. Adjustable rate mortgage. That's what an ARM is. It's an adjustable rate mortgage. So adjustable rate mortgages shift the risk or rewards of changing and fluctuating interest rates from the lender to the borrower. Okay. So like if you were to get a fixed rate mortgage loan, whatever rate they fix it at, if the interest rates go up, well, you're still paying that lower interest rate. So the lender's losing out, having their money tied up with you for the next 30 years, right? On your mortgage loan. So in an adjustable rate mortgage, however, this shifts the risk or reward of those changing interest rates from the lender to the borrower. If interest rates go up, the borrower pays more. If interest rates go down, the borrower pays less. Okay. A lot of people say you don't want to get those. You never know what your mortgage payment's going to be. Your rates are always going up and down. Well, hold on a second. That's wrong. The interest rates usually adjust once a year on the anniversary of the loan.
Okay.
So it's not like your mortgage payment fluctuates from month to month because the interest rates are going crazy. Okay. It adjusts once a year, usually on the anniversary of the loan.
Okay.
Okay. Now, what determines if that interest rate goes up or down? It's tied to some sort of an index. And the index that many lenders use is the 1-year U.S. Treasury bill. So depending on if the interest rate on that 1-year U.S. Treasury bill goes up or down will dictate whether your loan goes up or down, the interest rate on your loan. Margin is the difference between the cost of the lender getting the money to loan to you and how much money they want to make off of you. So it's the markup. So the margin is the markup. If it costs the lender 2% to loan you to get the money to loan to you, and they want to make 2% off of you, they got to charge you 4%, right?
Yep.
Now, people say you don't want to get those adjustable rate mortgages. Even if it adjusts only once a year, that interest rate can skyrocket on you, and your monthly mortgage payment can go through the roof. Wrong. There's something called a cap. A cap is the maximum that the interest rate can go up in one adjustment period. So there's a maximum that caps it so it doesn't shoot up through the roof. Okay, there's a maximum that it could go up in any single adjustment period. And then there's a lifetime cap on the entire loan. We call that the ceiling. The ceiling is the maximum that the interest rate can go up in any over the entire life of the loan. So there's an annual cap on how much it could raise, a maximum that it could shoot up in one adjustment period. And then there's a lifetime cap, which we call the ceiling. And the way I do this is I usually have a soda bottle. Let me grab this out of the garbage here. Hold on a second. I got a whole water bottle here. Okay, so let's just say that this water bottle I have here is soda. Okay, you're gonna shake it up.
Not a good thing.
Well, what's preventing it from shooting up?
The cap.
Okay, there's a way to remember it. The cap. Now, if I were to open the cap, what's going to happen?
It's going to spread everywhere.
Okay, now what's preventing it from going to infinity high?
The ceiling. Now we got cap and ceiling. Got it.
So which one is higher? Which one is higher?
Ceiling.
Yeah, the ceiling. Yeah, because the cap is the maximum it could go up in any single adjustment period, and the ceiling is like the lifetime cap. It's the maximum it could go up over the entire life of the loan.
Okay.
Okay.
So
Very good example.
Cap. You know,
Good example.
Yeah, just think of the soda, the bottle of soda. That the cap on the soda is preventing it from shooting up. That's the maximum. That's its limitation in any single adjustment period. But when you take off the cap over the entire life of the loan, the ceiling is stopping it, right? All right, so let's see. So when you get these adjustable rate mortgages too, you get some of these people, they're like, oh, you never know what the interest rate's going to go up. It could go up on you really high. That's wrong. They're either lying to you or they just didn't look at a damn piece of paper that they signed. Because when you get an adjustable rate mortgage loan, there is a sheet of paper. Okay, there's a sheet of paper, right? And on that paper, it spells out the worst case scenario over the entire life of this loan. What's the highest that the interest rate can ever go up on your loan, and what would the highest mortgage payment possibly be? And it's in a font size that's like that big. Look at that. That's about a third of the page almost, right?
Mm-hmm.
And people need to sign next to that. So how are you going to tell me you didn't know?
Right, and it's real big.
Right? They spell out the worst case scenario and you signed right next to it to confirm that you've seen what the worst case scenario could possibly be. And then later on, they're like, oh, I didn't know. That's wrong. That's a lie. Or you're just scribbling on paper just to get that house and you didn't look at anything because you didn't care. You just want to get the loan and buy a house.
Gotta look at the fine print.
That's not even fine print. That's like the print is a third of the size of the piece of paper, Okay. So that's the anatomy of an adjustable rate mortgage.
I think I took a picture.
So I'm sorry, in that paper, we signed the paper, but what does it say? It says ARM?
It shows the worst case scenario. So in the worst case, the lender states how much the maximum payment could be at the highest possible rate over the life of the loan. It'll show you what's the maximum your interest rate can go up and what your monthly mortgage payment would be for your loan in that worst case scenario.
Okay.
So they have you sign off next to that you've seen what the worst case scenario is for this possible loan that's adjustable. So you sign off that you've seen it, you're aware of it, you're good with it.
I see.
All right. So
Thank you.
let's do the highlights now. Page 269 for ARMs, adjustable rate mortgage. Just write ARM next to that because that's what we usually call it, an ARM. And it shifts the risk or reward of changing interest rates from the lender to the borrower. Now, a lot of people blame these loans on the mortgage market crash of 2006. Actually, a lot of people don't even say it was 2006. They say it was 2009. No, I was working in the industry. It was 2006 when I started to notice that the market was slowing down and some people started defaulting on loans. It's just that it really got bad in 2009, because it got worse and worse. And 2009, that was probably where everybody started saying, or 2008, 2009, that's where people were saying the bubble really burst. And like the people were then getting foreclosed on.
Oh,
So I wrote up here a little story about what actually happened. So a lot of people blame the real estate mortgage market crash of 2006 on adjustable rate mortgages. However, there was a lot more to it than that. If you watch the movie The Big Short, which does a decent job explaining what happened in the mortgage industry. Now, it doesn't explain the politics, the political element of it, because Hollywood and all, they're in bed with their certain favorite political party. But they did a really good job explaining what happened. It doesn't completely cover all the political decisions and the House oversight of the banking industry by the regulators and political decisions made by politicians over the years that allowed the reckless lending practices and even encouraged them under the guise of writing more loans to poor people and minorities to get housing. This is what enabled that bubble to happen. This came to later be known as predatory lending. All right, so I threw a lot of little cookies out there, just trying not to, get too deep into it. But when you really look at it, of course, oh, there you go. No. I'm going to open up my whiteboard for a second here. And there we go.
I will watch this movie to understand.
It's a star-studded movie. It's packed with movie stars in this movie. Some big names that you'll recognize. Okay. So let me share the whiteboard with you. You guys see the whiteboard now?
Yeah.
Okay, so for years, the real estate market fluctuated. It has its ups, it has its downs, right? It goes up, it goes down, it goes up, it goes down, but it's fairly stable, right? Now, around this time over here, you had, what was it? Actually, the picture doesn't really depict as well, but okay, so we had the down market here, and around this time you had Jimmy Carter was president, and he passed something called the community. Oh, shit. Of course, my mind goes blank now. Anyway, he passed some kind of a legislation that made lending a little bit easier. So the market values of homes started going up and up and up and up and up, but it wasn't too crazy. But it had a steady going up. So that was the beginning of this bubble. Around this time right here, you had President Clinton was in office, and he took that same law and made some modifications to it that allowed. Actually, I think it was around here. This was Clinton. Yeah. So yeah, Carter in the 70s, somewhere he passed this law that made lending go, more available through the Community Something Act. I forget what it was called. And then you had President Clinton.
Clinton for 8 years, right? Yeah.
He did something with the legislation, tweaked it that allowed it to go more steady. Okay, but nothing crazy, nothing crazy. But during his administration, you had somebody that was the head of the banking commission. So you got all these, these senators and Congress people. They got their committees and stuff that they serve on, right? There's one that's called the Banking Oversight Committee. Well, a boring committee, right? So you had this guy. His name was Barney Frank. You still see him probably on TV. He's kind of ancient now, but he talked with that lisp. He sounded like Daffy Duck with his lisp. Anyway, he called a meeting. His job was banking oversight. So he was in charge of the banking regulators, those that are watching the bankers, making sure that the banks are following all the laws and rules that Congress put in place for them, right? Making sure they're not discriminating against people, making sure that the banks are following all their mathematical formulas and stuff that they're limited to, But Barney Frank, he stepped in, he called the regulators, the investigators, into a meeting that they had on that public TV. It was called C-SPAN, right? You guys know those boring shows on C-SPAN where you just watch the politicians having hearings and stuff.
Yeah.
Well, there was this one that he was on, and he called the regulators in, and for the investigators, and he was basically talking about how the lending works. And the regulators were like, well, it's based on risk to the lender. They calculate they use factors like the person's credit score to determine the risk and of them defaulting on a loan, but they also have to look at numbers like their income versus their expenses to get a debt to income ratio, and he's explaining like all the stuff I'm teaching you right now, right? This is what the regulator was teaching Barney Frank, or saying to Barney Frank, and then his response was this: "I didn't hear any of that. I want to know how come they're not writing more loans to poor people and minorities." And the regulator said, well, they're not supposed to consider, well, when it comes to poor people, they have to look at how much money they make in relation to how much their debt is. And they could only lend them so much money based on their income and debt ratio. As far as minorities, lenders are not supposed to look at people. There's laws in place that prevent lenders from looking at somebody's color or national origin. There's laws against that from the whole Civil Rights Act, And he's like, I don't hear any of that. If banks don't start writing more loans to poor people and minorities, I think they're discriminating. We need to get more of them in homes. So, if they don't start writing more loans to poor people and minorities, we're going to seriously start considering either fining them heavily or yanking their licenses to continue doing banking. And, the bankers listen to this stuff, and they're like, say what?
You're going to lose my license?
You're going to be us or losing our license because we don't give more risky loans to poor people? Mm-hmm. As far as minorities, how do you get minorities to get more loans? It's up to them to come in. You can't force people to take a out, right? I mean, the banks have no control who walks in the front door and wants to take out a loan to buy a house.
Right.
So they have to figure out a way, though, to get more minorities in. So how do you get more minority people? Maybe you start advertising. You start these targeted marketing plans to try to advertise to minorities, maybe on the radio stations or TV programs that they watch more often, or billboards or mailings and stuff, but you're focusing on people based on their race rather than any other factor. Okay. So that's how they targeted minorities. Now, what about poor people? How How do you make more poor people be able to get a loan if they can't qualify for it? Think about it for a second. You lower the lending standard.
That's what I was gonna say. You have to learn, you have to
You
make
gotta lower
it
the standards. Yeah, you gotta lower the standards because you have no control over how much money they make or what their debt is. So in order to get more loans to poor people, you've got to lower your standards. But let me ask you a question. If you got people that could already afford a property at this rate, okay, and you lower the lending standard, so now those people can afford that much more, right? Those poor people, they could get in and be able to borrow because you lowered the standard. But what about those that could already qualify? Well, now they could qualify for more. And if they could qualify for more, what are homeowners going to want for their homes when they sell them?
more money.
More money. It's common sense. It's not exactly rocket science, right?
Mm-hmm.
But I guess Barney Frank didn't consider that. So that's around the point over here where we saw property values start doing this. Up and up and up at this steep upward climb. And I started in real estate about here, about halfway up that. I started in 2004.
Wow.
Okay. So when I started, I was like, these property values are crazy. Yeah, they're really going up ridiculously just over the last couple of years. Suddenly, like I noticed it as a new real estate agent. I was like, what the hell is causing property values to go up so much over just the last couple of years? And I seen it going, and I was like, all right, whatever, it is what it is. I guess I'm never going to own a home, but I could help these other people go out and buy them. And I started making money helping people sell homes. As a matter of fact, it was not hard. People would come to you already. They know what home they want to buy, and they want to write a contract in on it already, So in order to get listings were real easy too. We were doing cold calling. I hated cold calling. But it'll help you build a thick skin, that's for sure, with all the rejection. But the scripts that we were using were like, did you know that your home can be worth $100,000 more than it was just last year? We could help sell your home, and you could earn all that equity by selling your home now. You could make all that money. Just in the last year, your home has increased in value probably over $100,000.
Mm.
Really? Cha-ching, I could cash out on that. And it's just in the last year. We're not talking about the last couple. Damn, how much is my home worth? Okay, we'll set up an appointment where you could come in and do a CMA for me. Boom. That's how we got our foot in the door. We get listings. We sell those houses for more and more and more. And people are bidding wars, and people bidding higher, paying higher than what what the asking price even was. And this happened up until, because they lowered the lending standards, right? How did they lower the lending standards? It still goes by debt to income ratio and all, right? So how do they lower the lending standards? The credit score, it's all about the risk to the lender. So how do they lower the lending standard?
How they lower the lending standard?
They had to change the requirements.
What requirements? Well, no, they didn't change the requirements as far as your debt to income ratio or even your credit score for that matter, because that's how they measure the risk. So how do they lower the lending standards?
Lower the property value?
They have no control over property values, the lenders. It had to deal with
interest.
When you go to get a loan, what do you got to show to the bank?
Your income.
How do you do that?
Proof of income, your bank statements or your
pay stubs and all that stuff.
Pay stub and
okay. They came out with something called SISA.
SISA?
Yep. Stated income, stated assets. Where you didn't do any of it. You just told the lender how much money you made and what your assets were. You didn't have to show your bank statements. You didn't have to show your pay stubs, You didn't have to show your tax returns, or your bank statements.
Wait a minute. So you didn't have to show anything?
Nope, you just tell them how much you made. You tell them what your assets are in the bank. That's how you lower the standard, because people are going to go in there and fib because they want to be able to buy a house and get into home ownership. You know, this is where we see bus drivers claiming they make $300,000 a year. It's like, come on. At some point they were like, you got to be a little realistic with it. You can't be claiming that they're making $500,000 a year. But this is how they actually lowered the lending standards. So boom, more and more people, and then adjustable rate mortgages, and where you get the fixed lower interest rate for the first the adjustable rate mortgage, and there was a twist on adjustable rate mortgages. There's something called a hybrid mortgage. A hybrid mortgage is it's a fixed at a lower teaser rate to get you into the loan at the beginning. So it's fixed at a lower teaser rate for a year or a couple of years, and then it becomes adjustable. So that was another thing that people started doing, getting into that low one. Now, why would you want to get into one of these adjustable rate mortgages? Well, because if it's fixed at a really low rate for the first couple of years, property values have been shooting up. I mean, property values never go down, right? So this is the thinking. So people are like, I'll just get into one of these adjustable rate mortgages that are fixed rate for a couple of years. I know that when it starts becoming adjustable, there's no way I'm going to be able to afford that mortgage payment because the rates are up, But you know what? It's fixed at that teaser rate for the first couple of years. And as long as property values keep rising, I'll just be able to refinance into a fixed rate loan when I get enough equity. Pretty smart, huh?
Yeah.
Or is it gambling?
It's gambling.
Because that only works if the home prices continue to rise.
Mm-hmm.
But what happens when the bubble pops, the bubble bursts, and then the property values start to drop?
And you still at that high interest.
What is refinancing?
When you reapply to pay off your first loan?
Simplify it for me.
Refinancing is another mortgage loan. You're redoing a loan.
So you get a new loan to pay off your existing loan.
Correct.
Okay. Now,
hold
on a second. If your property value has fallen, who's going to give you a loan for more than what your home is worth? Because isn't that what refinancing is? You're getting a new loan to pay off your existing loan.
Correct.
Is the lender going to loan you more money than the house is worth?
No.
So if the bubble bursts and the property values start dropping, and now your home isn't worth what you owe on it, you're trying to get a new loan to get a lower interest rate, but your property has to appraise for the purchase price. And if it doesn't, because your home isn't worth that anymore, you're not going to be able to refinance. And now we get to this point that your loan, that fixed low teaser rate, we're at the end of that. Now your loan becomes adjustable. Your interest rate shoots up, your payment goes up even further, and now you can't afford that.
That's a gamble.
So what happens if you can't afford your mortgage payments?
About to be in foreclosure.
You're going to get foreclosed on, right? So then Obama came out with, then Obama became president, and he tried putting out these plans where you can restructure your loan. Right, I forget what they call it, loan modification. Right, started coming out with all these loan modifications. But you remember the last chapter I showed you? We were talking about how you could avoid foreclosure and or delay it. And they're like, well, the banks aren't really listening to you or communicating with you. Obama, the one guy even said, he's like, you got all these Obama plans out there to try to redo your loans, but the banks aren't listening to you and they're foreclosing on you. So what's a homeowner to do? You could try to delay that foreclosure, buy yourself more time. Remember he was saying that line?
Yeah.
Well, that's exactly what was happening. He came out with all these plans, but those plans for or presidential orders for lenders to work with people to try to restructure their loans. But how do you restructure somebody's loan if they owe more than the current house is worth? Who's going to give you a loan for more than what it's worth? So banks just were not doing it. They weren't approving these things unless they had limited ability to. So they were on some people, but the only thing that they could do, they can't forgive your debt. The only thing they could do is maybe take your 30-year loan and lengthen it out to 40 years, make it a longer loan, give you more time to pay it off, perhaps. And if that wasn't enough to cover the difference in your price drop, they weren't going to refinance your loan, and then you'd eventually get foreclosed on and lose out anyway. But the banks had to stop the foreclosures while they analyze your loan to see if this is possible to restructure it. And then when that didn't happen, because that was just a big old failed plan, and even the ones that people did restructure the loans, people started scratching their heads afterwards and saying, okay, so now I got a 40-year loan to pay off a house that's not worth what I owe on it. So I owe more than it's currently worth. Why the hell am I even going to be paying this loan that I managed to do? You know what? F it. And they just walked away from the home. They couldn't sell it, right? So what did they do? They just walk away. They let it foreclose anyway. So a lot of those people who managed to restructure their loans got foreclosed on anyway.
Wow, went through all that just to get foreclosed on.
Yeah, because they started thinking about it. Why the hell am I going to be, I was doing this to try to save the house, but then again, why am I going to be paying now for 40 more years instead of 30 years? Now I'm paying 40 years for a house that's not worth it. They're like, screw that. Walked away, let it foreclose, better off. I'm not knowingly paying hundreds of thousands of dollars more than my home is currently worth. Why would I be paying hundreds of thousands of dollars more for the house? So people were like, F this, and they walked away. They got foreclosed on. Like, whatever, my credit score, I'll improve it over time. It's worth it than paying all these hundreds of thousands of dollars more than what the home is worth, right? Mm-hmm. So that's what they did. Okay, so the market continued to crash as this was happening. So then in 2008, politicians in all their arrogance came up with a bright idea how to stop this problem. You know what we could do? If we get people to go out and buy these homes, the prices won't continue falling, right? If we get consumers to go out and buy. So what did they do? They offered a tax credit of $7,500. So when they offered that tax credit of $7,500, a lot of home buyers started rushing out. They were thinking, hey, wait a minute, the markets have been crashing now for a couple of years. We got to be near the bottom of the market. It's got to be stabilizing by now. That $7,500 may be enough to cushion it if it goes down anymore. So you had a bunch of home buyers that went out to buy homes for that year that they offered a tax credit of $7,500 if you rush out and buy a home. There was just one catch to it. You had to live in the house for at least 3 years, or you had to pay that $7,500 back. Okay, so people rushed out to buy homes. Now, did it flatten the curve on that falling real estate market? A little bit, but it was still falling, but just at a slower pace because so many buyers came out of the woodwork to go buy homes. And then at the end of the year, when that tax credit went away, the market continued to adjust itself and fall. So those people that were just enticed to come out and buy homes that were not even in the real estate market, now they're in the real estate market experiencing the crash. So they were like, screw this, I'm out. And they managed to sell their houses. Some of them did short sales, to avoid foreclosure. And they're like, ooh, dodged the bullet, but it really hurt my credit. And now you managed to do the short sale, you got out of that one, you dodged that bullet, and then who's that knocking on the door? It's the IRS. That $75 tax credit we gave you? we want it back now. You weren't in that house for the full 3 years that you were required to, so you got to pay that $7,500 back to us all at once now, please. Or you're going to face late fees and penalties.
Oh, wow.
So those politicians, their solution to flatten the curve in the housing market was nothing more than a delaying of the inevitable market adjustment, right? And in the process, they pulled people who were not part of the real estate debacle into it by offering them that $7,500 tax credit. Now, you figure that politicians would learn now that they just pulled more people into financial hardship. That's all they managed to do. But that's not what they saw. They saw, look how we managed to flatten that curve. We almost flattened it. Yeah, but then when the tax credit went away, it started dropping again. So you know what the politicians
buying anymore.
Yeah, so you know what the politicians' idea was? You know what the problem was? We didn't offer enough money. We didn't throw enough money at the problem. So they did another tax credit, this time for $11,000. So anybody who rushes out to get to go out and buy a home, we're going to give you an $11,000 tax credit this time with the same terms. You got to live in that house for at least 3 years. So what did people do? They're like, okay, the market dropped, it leveled a little bit, it dropped again. We got to be near the bottom now. And now it's at 11,000. That should be enough to absorb the cushion, right? So people rushed out. And it did flatten the curve a lot more, but it was still declining. And then at the end of that year for that tax credit, boom, the market continued to correct itself and fall. And then people did short sales again, and then
here come
$11,000, please. They pulled more people into financial hardship. Oh, and by the way, a lot of these loans that people were using to get the homes, about half of them were FHA loans. FHA are government insured loans,
right,
where they insure the bank against loss. They tell the banks, hey, lend your money to these borrowers and we'll insure it that you will not lose a penny.
Wow.
And that insurance fund went bankrupt. So you had President Bush did a bailout, a massive bailout. And then you had President Obama came in afterwards, and he did an even bigger, massive bailout. But the politicians on the right, the Republicans, they were like, wait, no, Bush already did this, and that money went to golden parachutes for CEOs of banks, and a lot of that money went to waste, fraud, and abuse. And he is like, that's all right, it'll trickle down and to the economy. Wait a minute, isn't it Democrats are always blaming Republicans of this false thing called trickle down economics? Which there's no such thing, actually. It doesn't exist. There's no such thing as trickle down economics. It's just it's a made up political argument. But anyway, he used that term, which I found very interesting. Oh, don't worry about putting any rules into place how the money can be used. It'll trickle down and back into the economy, and people will then spend it. So it'll work out in the long run. No. Don't do it. Just wait 1 or 2 days for us to put a couple of rules into place how this money can be used. No, we can't wait. We can't wait. We need a huge, massive bailout for the banks again. So he did the bailout without putting any rules in place again, and of course more golden parachutes for bank CEOs and such. What do I mean by golden parachutes? That was a term that the news was using at the time, if you guys recall. You could even do a Google search. What is a golden parachute? So the presidents and CEOs, they get big salaries, but they get huge bonuses if they do a good job and the banks are performing. How do they measure if the banks are performing and doing real well? By how much money they got in their coffers, right? How much money they got in their savings. So if you got the government that's throwing all this massive money at the banks for their defaulting loans to make sure that ensures that they won't lose a penny, Now all of a sudden they're getting paid back all those loans at the same time in full by the federal government. Those coffers are full. They're overflowing. So those
They did good.
CEOs were getting huge bonuses. We called them golden parachutes. And then they were just retiring. They were like, this is crazy money right now. We're never going to see it again. We're going to go to jail, so I'm going to take my money and run.
Yep.
So that was their golden parachutes. Okay. Because there was no rules put into place that money cannot be calculated and used for bonuses for CEOs of banks and such like that.
Mm.
And one of the people that were fighting for against having the rules in place was a lady called Maxine Waters. You guys all know her.
I remember her.
She's still in Congress. She's still around.
She is.
Oh yeah. Oh
They
yeah.
must have quiet her because I haven't heard from her in
Yeah.
a while.
She looks like the crypt keeper these days. She's old.
Yeah.
But she was fighting against those rules to be put into place. And it was really strange because her husband, he was one of the CEOs for one of those banks. I think it was like Sun Bank or something like that. And he was a recipient of one of those golden parachutes.
Mm.
It's like Nancy Pelosi's stock trades, right? A little too close.
Mhm.
Okay, so now we're at this point, and the markets continue to correct themselves until they pretty much got to the same point where they started. If you look at where Barney Frank, started threatening the banks, and then they loosened the standards, and then the lending happened, and prices went up and up until the bubble burst, and then came down, and then instead of coming straight down, it was delayed for several years because of politicians and their arrogance, until it eventually came back down. And look at this. If you draw this line straight across, pretty much went back to where they started.
Mhm.
All of that because of politicians. You could probably squarely blame it on politicians, because none of this would have ever happened if politicians never
Put
started
that tax credit out.
messing with things.
So, what does the market look like moving forward, like 2 or 3 years?
Okay. So now we're at this point. The market finally is flattened out a bit. This is now the end of President Obama's second term, and now Trump comes into office. Okay. And Obama's probably around here still. This is the end of his term, is declining still over here. And then Trump is running for president, and he says, "Oh, I could fix this. I could do this. I could do this." And some of the famous magic words he said, "What are you going to do? Wave your magic wand?" And then President Trump won, and he waved his magic wand. Whatever he did was able to. The market still continued to fall a little bit because it takes a little time for things to get implemented, but then it started flattening out, and then it started coming up. Okay, so we leveled out, and then we started coming up a little bit. And then somewhere around here, you had Trump as president, but, he didn't have control of the Congress. So a lot of people were not listening to him. You had holdovers from the Obama administration. They were not enforcing the borders. They were doing everything against them. Trump wasn't a politician. He didn't know really how government works and how nasty it can be. So you had all these people in government that were the deep state that he was talking about that were actually working against him. Everything he tried to do, they were fighting against him. And yet they were working at offices. He could have removed them and appointed someone else. But then again, Congress has to approve any of his appointments, so they delayed all that, like they're doing right now. He still doesn't have a full cabinet in his second term. He's still waiting to try to get people appointed because Congress is not wanting to allow to have those confirmation hearings. But either way, because of all this, now we have open borders. We have all kinds of issues where groups like BlackRock and Zillow now are buying up entire neighborhoods because some politicians are wanting to do away with single family zoning. Because do you know that single family homes are racist? At least that's the argument. They say, yeah, suburban communities are racist because black people can't own a house, I guess, which that is a racist statement all in its own. I don't know what the hell they're talking about. There's plenty of black people around me that own single family homes, but that's the argument that they're given. So they want to do away with those single family zoning. So current suburban communities, they want to be able to do away with that single family zoning so that they could put apartment buildings and high rises in these areas. So you have groups like hedge funds like BlackRock and then Zillow. They're buying up entire neighborhoods of homes overpriced, overinflated prices. They also need places for the people that are coming into the country to live. The government's paying for their housing at over market rate rentals. So what is that going to do to property values? Oh my God, all these things are causing the property values to go up and up and up again. Right? And then it reaches a point where you got Trump now. He's in his second term. He locks down the border. He learned some things from his first presidency, and he's just doing a lot of stuff on his own. And he's putting a cap on that stuff. Even though right now we're still, this isn't a completely accurate drawing here because I guess you could say we're about here right now because property values are still creeping up to the various reasons. But so somewhere around here, we're looking to the future now. At some point, property values are gonna start dropping. Okay, but the thing is, we have interest rates that are high, and property values are still going up. How is that possible? Usually, when interest rates are high, property values fall because people can't afford it. But you still got these groups of people that are buying these houses all cash. These hedge funds and all these groups, which they started cutting back on now. So we should be seeing, I think we're around this area right now. I think we're about to peak. I think that property values should be coming down along with the interest rates. Now, are property values going to stabilize and go through like that? Or are they going to be crashing? I don't know. I don't know. But that's where we're at right now. We're either going to see a stabilization of the market, maybe a little bit of a dip, or the market values are going to crash because property values right now are incredibly high. And we just had an interest rate drop the other day. Powell was Jerome Powell. He was resisting the president's pleas for him to lower the interest rates. But he finally did it. And now, the president gave him a nickname, too late Powell or something like that, for waiting so long to lower the interest rates. So it's gonna have less of effect for a longer period. But either way, he wants him to lower it again, and he announced that he's going to lower it 2 more times. But I guess he's taking his time to do it. So where are we going to be? Are we going to stay here or are we going to drop here? I don't know. I don't know where we're going. As you could see, politics plays a big role in real estate, doesn't it? So what's happening in the political climate today? Is this going to have an effect on the real estate? And how is it going to have an effect on the real estate?
Don't know.
Your guess is as good as mine. But you know what I usually do to try to keep up on these things? I go to the Ottawa classes. If it's not for the annual CMA workshop, I like to take their seasonal workshop where they give you market updates and predictions based on solid data and facts of the guy backs up where he's getting his predictions from. And, there's a lot of groups out there that listen to these groups of appraisers that put this information out there. I already showed you their client list, right? It's for investment groups, it's for insurance, it's for law firms, it's for across all kinds of industries. But they put together presentations for us as real estate agents to try to predict the markets a little bit, so we know how to adjust our business in the coming season.
all links you already I think
Yeah,
in which
it's
chapter you showed
yeah,
that?
it's not in the book. It's OTTEAU.com. That's Ottawa.com. That's it's a group of, here, let me close this whiteboard now.
OTT.
OTTEAU.com. So that's Ottawa.
Oh,
OTTEAU.com. It's the Ottawa group, but their website is OTTEAU.com. Here you go. This is a local group of appraisers, New Jersey appraisers. Okay. And the owner, Jeffrey Ottawa, he put together presentations. Like so you see it on the
yes.
so you can take a look at their client lists, some of the groups that they've actually done business for. I'll show you some of these
Okay.
Fortune 500 companies they put together presentations for their investments or whatever it is they're doing. But they do it all based on real estate and how other factors like job markets and all kinds of other things play a role on real estate, affect real estate. So all of these groups I mean, you guys hear of any of these companies, these Fortune 500 companies,
Mm,
these big players? What about some of these financial institutions and lenders?
JP Morgan, my husband, yes.
What
Then
about some of these developers? Now they're consulting with all these different groups,
wow.
a lot of developers.
I know Toll
Yeah.
Brothers.
You know, Renaissance Properties, they're all over Edison.
I know Toll Brothers. They've been in the business for a long time.
Toll Brothers, yeah. And then you have some of these other groups,
ADP.
ADV, Bausch and Lomb, the railroads, Cigna, Frito-Lay, Gulf, McDonald's, Nestle,
Oh,
look, North Jersey Oral and Maxillofacial,
Princeton University.
you know,
St. Peter's.
and government, cities, municipalities, the state of New Jersey, like Borough of Metuchen,
yeah.
Swan River Regional Sewer Authority, New Jersey Green Acres Program, NJ Transit, state of New Jersey itself listens to these guys. And they serve as expert witnesses for a lot of law firms too. Healthcare.
JFK.
Now they should be adding a bunch of other ones here. Maybe they put it under miscellaneous. I don't know. Let's take a look. Do they have Netflix in here somewhere?
See Netflix. They got St. Peter's University.
Well,
They
I
even
know,
got Sony. Sony's still around.
of course, Sony's a huge business corporation. Yeah, they make some of the best TVs out there.
Oh, yeah, it is still Sony TVs out there. I'm thinking Walkmans and stuff like that.
Okay. Yeah, you don't see it. I mean, they got added now a new section here, a new sector, which is becoming big in New Jersey, is the movie section, Hollywood. Because of the politics and taxes in Hollywood, that's making Hollywood the toilet of the nation. Rich people are fleeing. They're moving with their money, even those actors and actresses in movie theaters, right? They talk a game that, oh, this is our politics. We love it. But then when it starts affecting their safety and their money, they're like, we're walking, you know? And it's a fact. We've been saying this for years, but now New Jersey's actually becoming the new Hollywood.
Yeah, they're building that Netflix down in was it South Jersey, Monmouth, somewhere around there?
Yep, that's the Netflix. Yep, the Netflix theater. They bought the Netflix bought.
That was the Navy, not the Navy base. The
the governors sold them one of the military bases. I forget what it is.
The Fort Knox, Dixie, Fort Dixie.
Netflix, New Jersey studio. There we go. Let's take a look at it. So Netflix is building a large $1 billion film and television production studio at the former Fort Monmouth Army base in Monmouth County.
Mm.
Yep. They call it Netflix Fort Monmouth Studios or Netflix New Jersey. Yeah, they're dumping $1 billion into it. Look at that.
Which is going to create a lot of jobs, right? That we
Look
need.
They got a lot of lakefront or oceanfront property here too.
Wow.
All right, so
They had it on the news this
uh,
morning. I don't figure
that's
what.
just showing their plans for their studio. Let's move on. I don't want to get into this too much here. All right, so if you guys want to watch that movie, I got The Big Short in our class links Word document, but I also got the links a link to it here. You click on it, you can see The Big Short. You
Yeah,
know,
that I can
what do
watch
you
it.
got? Christian Bale, Steve Carell, Ryan Gosling, Brad Pitt, and many other famous stars are in this show as well. Marissa Tomei.
Marissa,
Yeah.
Margot.
All right. Oh, I didn't share the screen with you.
Yeah.
So yeah, as you can see, Christian Bale, Steve Carell, Ryan Gosling, Brad Pitt, and some Marissa Tomei. Oh, Margot Robbie, she was in there.
Yeah.
Uh, yeah, these guys. But anyway, you get the idea. So check it out, The Big Short. It's specifically about what happened in real estate, and we're doomed to repeat ourselves because politicians never learn.
Mhm.
We're starting to see some of that stated income, stated assets stuff come back. All right, so this is the anatomy once again of that adjustable rate mortgage. Cap is the maximum. The interest rate can go up in any single adjustment period. And a ceiling is sometimes called the lifetime cap. It's a maximum allowable interest rate over the life of a loan.
I really like that example that you saw it with bottle. That way we can remember.
Yeah, it makes it a little bit easier to understand. You know, the cap is here, but what's above the cap? The ceiling, right?
Yeah. I just wrote it down, soda bottle next to that.
Yeah, let me know what you guys are.
Yeah, give me a second.
1 second.
Hold on. Let me write it down. One.
And ceiling is over the lifetime of a loan.
Makes the
Okay, done with that.
okay. Go up. And go. I just,
You good?
Mm-hmm. Yeah.
So negative amortization. Okay, so amortize means to kill off slowly over time. Partially amortization is you only partially killed it, so the last mortgage payment balloons in size, so that you could finally kill it off. Now we're going to see negative amortization. Well, if amortization means to kill off over time, and negative, that's the opposite of killing off. Okay, so what does that mean?
You're not paying.
When your monthly mortgage payment is less than the interest owed. So every month you make a mortgage payment, it's not even enough to cover the interest payment. So that shortfall is added to next month's payment, and now you're going to be paying interest on your unpaid interest. That's not a good situation to be in.
No, right. Yeah.
So that shortfall is added to the balance. So in the first year of an an adjustable rate mortgage, the lender will eat those losses, knowing that they'll make it up in the long run when they're offering those teaser rates. To get in those below market teaser rates at the beginning. All right. And let's see, best for short-term ownership or when borrower plans to refinance later, fix up loan, however, risk keep the value drops. Okay, so you guys got negative amortization right here on page 270.
Yeah.
When the monthly payment isn't enough to cover the interest due. That's all you need to know.
Right.
But how can that work?
Because when the lender offers you a below market interest rate, so they're giving you an interest rate less
Very low.
than what it costs them to get the money to lend to you.
Oh,
So somebody's got to pay for that loss.
But so they're giving me a low
Listen,
interest rate.
sometimes the lender will set up a loan this way to tease you into getting the adjustable rate mortgage because it shifts the risk or reward from them to you. So they know they'll make up in the long run. So at the beginning, they're willing to eat the loss. So they build it in there by giving you like a really, really low interest rate that you ain't getting anywhere else.
Mm-hmm.
And it'll be fixed at that for the first year. And then the next year, it will raise a little bit to a more reasonable rate, but it'll still be a low rate. And it'll be fixed for that for the next 3, 5 to 7 years. And then after that, it becomes adjustable.
Okay. I'm like, well, how did I start off like that anyway? Okay.
Okay. That's what we call the hybrid loans, where they're a combination of fixed rate and for the first couple of years, and then they become adjustable. So it's a combination fixed adjustable loan. They call it a hybrid loan.
yeah.
And here we are. Payment plans, hybrid mortgage loans. It's a combination fixed rate and adjustable rate loan. It's fixed initial rate for 3 to 7 years. Annual rate adjustments for balance of the term every year on the anniversary of the loan. Right? Because the interest rates, they don't change on your loan every month. They change, they get adjusted once a year on the anniversary of the loan. And it's usually tied to some sort of an index, and that's usually the 1-year U.S. Treasury bill. Lenders can use a different index, but they'll tell you what it is, but it's usually the 1-year U.S. Treasury bill. Okay, so straight loan is an interest-only loan. It's got a low monthly payment possible because debt is not amortized. It's not killed off. It's only making the payments on the rent, the interest owed, not the principal. Right. So it can be risky to get these kinds of loans. Some loans are interest only for part of the term. And that's common for new construction builders, where it'll be a interest only loan. The builder got to tell the lender how long they estimate it's going to take for them to construct the property, to construct the building, right? And then how long they got to estimate how long it's going to take them to sell it, to close and then give the money back to the lender all at once. Now, so it'll be an interest-only loan during that whole period. Now, once they start going past those estimates and they didn't finish building or selling the house yet, the lender actually can start penalizing the builder and giving them fines or higher payments. Okay, so the payments will significantly increase. Okay, I've seen a builder do this where they went way past their estimates of when they should be done with the construction and then sell the property by, and the builder started getting penalized by price adjustments or payment adjustments from the lender, where they had to make incredibly high monthly payments of $3,500 a month.
Wow.
Yeah. Then again, the builder thought that they were going to be building a mansion type home in a lower middle class neighborhood. Let's just call it that, because it was on a lake. This was actually a listing that I had. The guy was always worked for a builder. He was working in construction for the longest time. He said, "What the hell? I'm gonna start my own business as a builder." And he got this property in Old Bridge. It was a nice property right on the lake. But he decided to build a crazy house. He said, "It's right on the lake. If I build one of these expensive homes, the mansions like this, sell no problem." The guy, he is a builder.
It was solved his problem.
He's not in sales. Nope. The actual expensive homes were a couple blocks away. That's where that neighborhood was. This neighborhood was a lower middle class neighborhood. Let's just leave it at that. It was a lower middle class neighborhood where you had all these people then riding over his property with ATVs and dirt bikes and walking across it to get to this peninsula where they would do fishing in the lake, and like they didn't respect his property at all. As a matter of fact, they were fighting against him building it because they thought it was public property the whole time, and it was like a park that they were able to walk across. But they found out when he put up a fence, so they tore down the fence so that they could ride their ATVs and motorcycles over to get to the peninsula or get to the woods where they could ride their bikes and ATVs. The kids eventually, in various stages of the building, were breaking into the house that he was building, this high-end house, and they smashed up a very expensive hot tub jacuzzi, very big hot tub jacuzzi in one of the bathrooms. It looks like they took a sledgehammer to it. They stole the electric fireplace that they had, or gas fireplace that they had. All these things cost thousands of dollars. They actually even started in the winter. I guess they were cold, so they started a little bonfire in what would be the living room. So you saw that some of the plywood was all burnt up. They're lucky they didn't burn down the whole house. At one point, they smashed every window in the house. So all of these were causing construction delays where he had to make insurance claims and then get the payout for the insurance and then redo the work that he already had done. It took that. These are all delays on the construction. So eventually his original lender who lent him the money, they're like, "Well, you should have already been done building this house by now. What's taking so long?" And because then all these things are also causing re-inspections from the city. You got to pay for inspections, reschedule inspections, and eventually they started giving him these, "You need to pay $3,500 a month." And he's like, he eventually got driven out of business for it. I told him, I was like, "You're asking too much money for this. You need to lower the price." So he was asking like $785. Eventually, he lowered it down a little bit to $750. And I'm like, "Dude."
Did he price the homes that was down the street and see how much those were?
Those ones a couple blocks away, that's a couple, if he built it a couple blocks away where those homes were, he would have gotten the money.
Yeah.
You don't want to build a mansion in the middle of a crappy neighborhood. Well, it's not a crappy neighborhood, but it was a totally different class of neighborhood. You're building in a neighborhood with like $280,000, $300,000 homes, and you're trying to sell an almost $800,000 home. You'll never get your money back.
But he should have known that if it's this type of.
But he
didn't want to listen.
Sales. So he didn't make very wise decisions, and even at the beginning, I told him, "You need to lower this significantly. I mean, maybe I could get you in the 600 range, maybe in the low 600s, but you got to drop the price significantly," which he refused to do. And eventually he got foreclosed on by the lender. So his first house he built ran him out of business. And then the lender ended up selling it for $450,000.
Oh man.
Wow. After he bought it. So when he had to make these insurance claims, do he have to let the lender know all this was going on, or they don't?
process of construction. I don't know if he was letting them know or not. It doesn't matter to me. You know, he had to file the insurance claims with the insurance company to get the money so he could replace those things that were being damaged, you know. It was just a nightmare, you know.
Yeah.
Unfortunately
Yeah.
for him. Yeah.
So how much did he lose out of that deal? A lot.
He lost his
Almost.
business. He lost his shirt, you know.
He said he lost his business.
That's insert.
All right, so interest only loan is a straight loan for short term. It's used by builders, flippers, and bridge loan as bridge loans. That's when you got to
Interest
purchase
only.
your next home before you sell your existing one. You need a loan to bridge the gap in the interim.
Where can we write it down? Interest only loans. Oh, here.
Yeah, page 271, interest only. Just write straight loan, short
Yeah.
term, used by builders, flippers, and bridge loans.
That's I put on my bridge loan. Did I take a picture of this already? I'm not sure.
Flippers. Oh, that's used by builders.
So if you get a question on exams, which one of these is an interest only loan? Straight loan would be the answer. Or they may ask you a bridge loan.
What's the question you just said? The previous one?
Like if they ask you on exam, which one of these is an interest only loan? And they give you a
Okay.
bunch of examples of loans. If a straight loan is the option, that's the answer. Or if they give you a bridge loan, that's the
That's the
answer.
answer.
Yeah.
Short term.
About
That's the
short-term
answer.
loan.
An interest only loan.
Oh,
They're
yeah.
short-term loans, but they may ask you on exam, which one of these is an interest only loan? It's a straight loan. All right, let's get into it. You know,
Okay.
we've been dilly-dallying too much. Interest is the charge. It's the rent for using or borrowing someone else's money. And interest is calculated on an annual basis. Next slide, we're actually going to go over the math of it.
But 1 minute.
Get a
I don't know.
calculator.
One question.
Yeah, go ahead.
When we buy the house, the interest rate that we get, like for example, 5.85, it stays up to 30 years once I have that
If it's a fixed rate loan.
fixed rate loan, I say. I have to choose the interest, which interest I want, right?
You wish. You don't get to choose the interest. The lender tells you how much interest you could qualify for because we know you want to get the lowest interest possible. So
Yeah.
it's not going to be your choice. It's going to be the lenders. They're going to tell you how much interest you qualify for on your loan. What's the lowest interest you could get from them? And what determines the interest that they charge you? The amount of risk you pose to the lender. How much money did you put down? How much is the home worth? What's your debt to income ratio? What's your credit score like? You know, all of these factors play a role. What's the current market conditions? You know, all of these things play a role in the interest rate that you're going to get. Okay, you have very little control over your interest rate.
But does it change? Once it's fixed, once its lender gives you that percentage, does it change if it's 20 years, 30 years? Does it that?
If it's a fixed rate loan, it is fixed for the term.
Okay.
Now, amortization schedule. There's a little chart on one of these pages coming up. An amortization schedule is a chart that shows the balance and how payments are applied to the principal and the interest over the life of the loan. So, for instance, if it's a 30-year loan, there's 360 months in 30 years. So you'll have 360 lines on this amortization schedule that at any particular month over that 30-year term, you could see what your payment is, how much of that payment goes towards the principal, how much goes toward the interest, and what the balance is at any given time throughout the life of the loan. They call that the amortization schedule.
Okay.
I'll show you that when we come up to it on the coming slides. Now, a point, some people call them discount points. Paying points in advance may allow for the borrower to borrow more money. As a buy down to get a lower interest rate, you could prepay points. What are the points? A point is prepaid interest on the loan. It's tax deductible by the borrower in the year that it is paid, no matter who paid them. The borrower can deduct it. Now, what's the math of a point? Each point is equal to 1% of the loan amount, not the purchase price, but the loan amount, because we're talking about the loan here.
No.
Okay. You may have put down some money of your own. You don't factor the purchase price in. It's the loan amount. It's the interest. Okay. So you're prepaying interest on the loan. And that interest is tax deductible by the borrower in the year it's paid. That's why your lender sends you an interest statement every year.
Mm.
This could be paid by the buyer or the seller in negotiations. And it doesn't matter who paid them, the borrower can deduct it on their taxes. So it's tax deductible interest is deductible by the borrower in the year it is paid, no matter who paid it, because it's the borrower's loan and they get the tax statement. Now, a rate lock. Okay, I actually found that they do have a little reference to a rate lock, even though, oh wait, this isn't the slide for it. Let's see. So I know they've removed some stuff about rate locks here, but on page 271, I think they have something.
Rate lock is guaranteed by the lender to issue the
Yeah,
loan.
they don't tell you much about it. So look, here, a rate lock is the lender locks in a rate. So even if rates rise, the borrower gets the low rate, a locked in interest rate.
That's good.
You could get it 30, 45, or 60-day complimentary rate lock from the lender. But if you go over that, interest rate on your loan can go up. But they allow you to purchase an extension of the rate lock for a couple hundred or a couple thousand, depends on your lender. So is it important that you close on time?
Mm.
So players think the real estate agent, my real estate agent, they kept pushing me like they wanted, like they couldn't wait to get their commission. They want, oh, you got to do this, or you got to do that. They were trying to get me to close quicker because they just, I guess they wanted their commission. That's a perfect example of an agent not educating their client every step of the way. They're doing what they're supposed to do, but they're not educating their client. You need to explain to your client and keep them involved. Teach them why you're pushing them. Tell them, listen, during this transaction, it's going to seem like I'm pushing you and pushing you and pushing you. Get this done. Get that done. Do it quick. Did you get that done yet? Did you get that done yet? There's a reason why I'm doing this. Because you're not buying all cash. You're getting a loan. And if you want to keep that interest rate that you got quoted on that loan, it's only going to be locked in for a certain period of time. And if you go over that deadline, your interest rate will go up. The lender will allow you to extend the rate lock, but they're going to charge you for it. So I'm trying to save you that money, which could be hundreds and hundreds of dollars, to extend the rate lock. That's what I'm doing. That's why I'm trying to keep you on top of things. You'll see. Okay. So now your client will understand. So during the transaction, when it seems like you're pushing them to get this or that done, they'll be more apt to do it. Mm-hmm. Because they know now why you're wanting them to do it. Otherwise, they're like, they keep pushing me to close. What do they need to pay their bills? They need my commission. They need that commission, you know? That's the impression that they get. You need to educate them, okay?
Yes.
Let me add in here.
Interest.
Rate. Yeah, I'm going to remove all this. The lender locks in the rate. There you go. At an additional cost if you don't close before payment. If the borrower doesn't close on time, their rate will or could go up. But they can
Okay.
purchase at an addition, purchase an extension for an additional fee. Which could cost hundreds of dollars. Yeah. Complimentary rate lock period. Or if the complimentary rate lock period expires. There we go. That's a better definition. So for rate lock, the lender locks in a rate. So even if the rates rise, the borrower gets the locked in interest rate for 30, 45, or 60 day, for 30, 45, or 60 days.
Days.
If the borrower doesn't close on time, their rates could go up, but they can
Right.
purchase an extension for an additional fee, which could cost hundreds of dollars if the complimentary rate lock period expires. Okay.
A question.
Yeah.
Yeah, I got this one. If the tax deductible, the above one, can you please tell me again? Because I'm confused no matter who paid it.
A
That's a
point,
borrower.
it's the borrower's loan, so the borrower is going to be getting the
Statement.
statement at the end of the year.
So no matter who paid it, what is that means? Only
Yeah,
borrower.
if you negotiate for the seller to pay points on your loan,
Ah,
the borrower is the one that can deduct it on their taxes, not the seller.
Mhm.
okay.
Because it's your loan, you get the statement at the end of the year.
Got it. Thanks.
All right, so a rate lock is when the lender offers a complimentary lock on the interest rate. So if they go, the borrower gets the lower locked-in interest rate. This could be 30, 45, 60 days, and if missed, the borrower could purchase an extension for an additional costs. Okay, so this is what was in the older version of the book, the 15th version of the book. They haven't had it in the book since then. that lenders, so this is not a screenshot from this version book, but it's from a previous version. You're not going to see this in this version book. However, on page 271, you'll see a little blurb about it. It just says a rate lock is a guarantee by the lender to issue the loan at a quoted interest rate as an incentive to the borrower. Under some conditions, the rate lock can still change. So basically, it's not very informative and doesn't give you much information about what the hell a rate lock is. Okay, I'll give you a little more information here. Because interest rates change constantly, lenders may offer the borrowers the opportunity to lock in a quoted rate. In this situation, the lender agrees to hold the quoted rate for a certain period of time. And if the interest rate goes up, the borrower is protected. Unfortunately, if the interest rate goes down, the borrower often cannot take advantage. Well, you could threaten to go to another lender, and then all of a sudden they're more receptive. So lenders typically can lock in the rate for 30, 45, or 60 days and hope that they get to closing before the rate lock expires. That's why we as real estate agents keep pushing. So that's that.
For an additional fee, the rate lock can be standard.
Maybe.
I also wrote it down next to that. These slides 23, 24. For more detail. Info. Okay. This is which version? Is this 16? 18?
Yeah, this version of the book has a single sentence there about it on page 271.
Yeah, they don't put. Oh, I'll have to write that in.
How openly they change the book?
Well, sometimes they do major rewrites, and sometimes sometimes they're only slight rights. This sucks.
Sorry.
So I mean, they used to come out every year, but sometimes they came out with two versions in the same year, you know. So it varies.
All right.
30, 45, 68. Got that picture right.
All right. So interests. What is interests? It's the
Charge.
rent that you pay for the use of someone else's money. Right? So interest is calculated on an annual basis. So you take the loan amount times the interest rate equals the annual interest rate. Divide that by 12 if you have 12 monthly mortgage payments to figure out how much of your monthly mortgage payment is going towards the interest. Now, if you subtract that interest from the total mortgage payment, PI, that's your principal and interest, that's your total monthly mortgage payment, you'll find out how much of it goes towards the P, the principal. That's how much you borrow. So that's the formula for figuring out how much of your monthly mortgage payment goes to pay down your principal. You got to calculate the interest, figure out what the monthly interest is, subtract that from your monthly mortgage payment, and you're left with the principal. Okay, so PI minus I equals P. PI is principal and interest. You subtract the interest, and you're left with the principal. Okay, so an example they give here is if you have a loan of $100,000 at a 7% interest rate, and the monthly mortgage payment, including principal and interest, is $665.31. They just gave you that figure here. How much of the first month's mortgage payment goes towards paying down the principal? Well, 100,000 times 7%, that's 7,000 in annual interest. Divide that by 12, so $583.33 for the first month's interest payment. You subtract that from your monthly mortgage payment of $665.31, and you're left with $81.97 that went towards paying down your loan, the principal. So if you borrowed $100,000, subtract that $81.97, and that's your balance of how much you owe now. So if you want to find out how much of your next month's mortgage payment goes towards the principal, start over at step one again, but use this number, the $99,918.03, and start all over again. $99,918.03 times 7% divided by 12, subtract that from the mortgage payment. And if you keep doing this over and over again, that's how you create a mortgage factor chart. That's how the lender does. So here's something that you should probably write on here too, that PITI, total monthly expense for housing. Principal and interest, that's the PI part, that's your loan, principal and interest. That's your entire loan consists of principal and interest. But then you also have other property expenses like property taxes and homeowners insurance. So if you calculate the principal, interest, taxes, and insurance, that's your total monthly expense for housing. PITI.
PITI.
So this is on page 272. So you guys may want to go to page 272, put a highlighted box around this. You already highlighted the line from the previous slide. Let me go back up for a second just to make sure you did. Well, not that slide, this one. A charge for the use of someone else's money is called interest. It is the rent. That's on the top of page 272 under interest. You guys had that, right?
Yes.
So now put a highlighted box around this, which is further down on that page. And right at the top, calculating interest and amortization annually. And on the side somewhere, you may want to write this part about PITI. PITI equals principal, interest, taxes, and insurance. See, I broke it down here next to the chart. I wrote that that's $665.31. That's PI. That's the principal and interest. This is your monthly interest, the I, and this is the P, the principal.
I can write that at the calculator.
Available to pay down principal. interest due first month. Monthly payment made. They got it written here too. But I just wrote PIIP.
PITI.
So your monthly payment consists of the principal and interest. So that's why I wrote PI here. You guys could even write it on here on this side next to monthly payment made, PI, principal and interest. You can put it on this side. That's fine. Here. Sorry.
Thank you. Taxes and insurance.
I'll do it. I'll put it right there. PI, that's your principal and interest.
Wait, you just changed something.
Now I'm just moving it to the other side.
Oh,
It's
okay.
the same line. That's the same number.
And then what's the principal? The 81?
Mm-hmm.
8197, correct. Or do you like it where it was before? Here, I'll put it back.
I was right, and I'm
Yeah.
like, it just moved. So like,
Okay.
what's going on? Our PI
Okay,
is
let me
principal,
highlight.
and the interest is the 53. And the principal is the 84.
MORTIZA. DIO.
Okay. PI is the 65.
Everybody got it?
Yes, well,
Yeah.
So the first 3 and the last 3 months of the mortgage amortization chart, you can see here at the bottom of page 272. Yeah, next to the second monthly payment though, where it says interest, change that. The number is wrong. Change it from a 3 to an 8. Little typo they have there in the book.
582.36.
Yeah.
76 or 86?
86.
86. Oh, okay. So if we count, it's gonna be like this. First, second, third month. Oh, and last 3 months also I still in that this one. Mhm. So last 3 months only 1151, 769, and 386. Wow, nice.
This is a 30-year fixed rate mortgage loan. How do I know that? Well, there's 360 months.
Yeah, that 360 days. Yeah.
360 divided by 12, that's 30. That's 30 years.
Mhm.
How do I know it's a fully amortizing loan? Because when you make the last payment, the balance is 0. How do I know it's fixed rate? Because first payment all the way through the last, the payment amount is still the same. The only thing that changes is how much gets applied towards the interest and how much gets applied towards the principal.
So this is fixed, right?
Yep. This is a 30-year, fully amortized, fixed rate loan.
Fully amortized fixed rate loan. Okay.
All right.
Mhm.
So here's how you find out what your monthly mortgage payment's going to be. I want you to read above this chart, mortgage factor chart, like I have written up here. Now, above the chart, there's a paragraph that explains to you how to read the chart, just like what I have over here. So, how do you read this chart? You take your index finger from one of your hands. If I tell you that you have a 30-year, if you have a 30-year mortgage loan at a 6% interest rate, you run your finger down on the rate column, you run your finger down to where it says 6, okay? And now you move over to the right, to the 30-year, to the far column, all the way to the right, where it's 30-year terms.
Six
And what-
forty.
And that'll give you the factor. And what do you guys have as the factor?
6.00.
6.00. That's the mortgage factor.
Mhm.
So what does that mean? What is a factor? Well, for every $1,000 you borrow, your monthly mortgage payment, including principal and interest, is $6. That factor 6.00, that's $6. So if you had an interest at 6.5% interest rate for 30 years, what's the factor?
632.
That's $6.32 is your monthly mortgage payment for every $1,000 you borrow. So if you borrowed, get your calculator out, pull out your cell phone. I'm sure you got a calculator on your cell phone. If you don't have a calculator handy, you got one on your cell phones.
Mhm.
Hopefully you guys know where it is.
Yeah.
Oh.
Okay.
All right.
Mhm.
So if you have a $300,000 loan using this factor chart at a 6.5% interest rate for 30 years, what's your mortgage payment?
Okay. 1 minute.
What is that rate?
6.5%.
And it's a 30-year term.
Yep. What's your mortgage
6.5.
payment on a $300,000 loan at a 6.5% interest rate for 30 years?
$18,960.
$18.96.
18,960, right?
Yes.
Yeah, that's I
You-
said.
Oh, okay. He's a
Okay.
960. Okay.
18,960.
All right. So, yeah, $1,896. Correct.
Mhm,
That's correct.
Mm-hmm.
Everybody get that? Everybody see how we got that? For every
Yeah.
$1,000 borrow, the mortgage payment is $6.32. All right. So if you have a $300,000 loan at a 5% interest rate for 30 years,
Let me tell you.
The loan amount is 30,000.
How to delete the amount?
what's the monthly mortgage payment?
Okay. You said 5%?
5% for 30 years, $300,000 loan. What's the monthly mortgage payment?
1,611.
Correct. 1,611. Because the factor is what? 5.37, right?
Mhm.
Everybody get
161.
5.37?
Yeah.
So does everybody know how to read this chart?
I'm confused, but I'll figure it out.
Okay, well, hold on a second. What are you confused about? Here, stop. This I'm going to give you a problem just for you. You got a 4% interest rate for a 30-year loan. What's the factor?
4.78.
Okay, so you got it. You know how to read this. You know how to read this chart. That's all I was trying to figure out right now. I was trying to. At this point, I just want you guys to be able to know how to read the chart.
I
So,
know how to read the chart. Okay, I got to read the chart part.
so 4.78. You know how to read the chart. Great. Now, if you have a $300,000 loan, this is how the 4. What is it? 4.78. That is your monthly mortgage payment, principal and interest.
The 4.78.
Yep. For every $1,000 you borrow, your monthly mortgage payment, including principal and interest, is $4.78. So how many thousands are there in 300,000?
300,030.
300.
Okay,
Just
300.
cross out the 000, cross out 3 zeros, and you got it right there. Or you divide it by 1,000. How many thousands are there in 300,000? It's 300. So 300 times 4.78.
Times 0.478.
Mm-hmm.
0.478? Okay.
The factor. What's the factor? 4.78, right?
Mm-hmm.
And what's your mortgage payment?
143.40?
Not 100. It's 1,434.
Divide 100 you have to do because you're
I
using.
gotta write this one down. Okay, so if I
Oh.
had
Okay. So you know the factor by running your finger on the chart. You figured out the factor. That's easy, right?
yes. So I take
Now,
the
how do
1,000.
we figure out what your monthly mortgage payment is? Take the loan amount of 300,000 and divide it by 1,000, or just cross off the last 3 zeros, and you get 300.
Okay. And then we take the 300.
And you multiply it, you times it by the factor.
So I'm gonna take the 300 times it by 4.78.
Correct.
Okay, times it by 4.78, which is my factor. And at 1,434.
Boom. That's it.
Okay, so this is my mortgage, my loan amount
Now, if I wanted to get difficult,
divided
well,
by
it's not that difficult, but we could make it a little more complex. I could ask you, how much of that monthly mortgage payment goes towards the principal?
the principal. So my interest is,
What's your question?
we gotta figure out
How much
the,
of this monthly mortgage payment goes towards the principal? I just gave her a problem. If you get a loan for $300,000 at a 4% interest rate,
Mm-hmm.
30 years, she just figured out that the monthly mortgage payment is, including principal and interest, is $1,434.
Right.
My question was, how much of that $1,434 goes towards the principal? So you guys remember the formula on how to figure this out?
I'm trying to do that right now.
Hold on a second. You do this.
Yeah, that's the chart I'm looking at now. So we got the
You
monthly
take the
payment.
loan amount times the interest rate, which was in the problem, the question that I asked you, right? So you borrowed 300,000 times 4%. That gives you the annual interest. Divide that by 12. That gives you the monthly interest.
1,250.
What did it come out to?
1,250.
1,250. So
Okay, right now I have 1,434. That's our monthly payment, right?
that's your monthly payment, including, that's your PI. Your
Okay.
principal and interest.
Yeah.
To calculate the interest, we took the full loan amount
which
times
is
the interest rate. What was the interest rate in the problem? 4%.
Divide 12. Divide
5%.
12.
Whoa.
5%.
It was 4%. 4%.
4%, no,
Yeah.
4.
Okay, so $300,000 times 4%, that's $12,000 in annual interest. Divide that by 12, that's $1,000. Okay?
Yeah. I at the beginning I
Yeah, you
thought
did the
was
wrong number.
5%.
Yeah, I see. Okay, so now we figured out that your monthly interest for that first month's interest payment is $1,000. So 300 times the factor of 4.78. Your monthly mortgage payment was $1,434. Subtract that monthly interest of $1,000, and you're left with the principal. $434 of that payment went towards paying down your interest. Oh, your principal, sorry. Went towards paying down your principal, the amount you borrow.
Oh, so we have to count two things, interest and principal, right?
If I'm asking you to figure out, to tell me what the,
Annual
how
interest.
much of the monthly payment went towards the principal, yes. So, there, we got problems coming up on this.
Yeah.
All right. Did I adjust this yet? No, I did not. Okay, I have to make an adjustment here because President Trump made some changes to the law recently. Actually, I think I already did. Did I? No, I didn't. I have to make some more adjustments. I got to look them up on my notes and figure out what they are, though. See, these things change with politics too. People are like, hey, President Trump, he's in with the millionaires and billionaires, right? He's in the bed with Wall Street. You guys remember the haters saying this stuff all the
You
time?
can't hear.
Okay. Trump's in bed with the millionaires and billionaires, and he's not there for the little guy, the average person. So you got to judge the guy by his actions, not what people say. Look at what he does. He actually tried to end a tax loophole for the rich, at least somewhat. However, this kind of has a negative impact on very high taxed states. New Jersey's one of them. We're the highest tax state in the nation.
Very tax, yeah.
All right. So this points out which states have extremely high taxes. And then he said, you know what? I don't set your property taxes. Your local politicians do. So if you have really high taxes, you need to bring it up with your local politicians. I have no control over your property taxes. Your local government does.
Mm.
Okay? And he was trying to use that as a way just to say, look, Democrats are highly taxing you, not the Republicans. Okay, that's his way of doing that. But that wouldn't work for him if it wasn't true, though. So who's complaining against him? It's the other party. Okay, so I don't want to get into politics here as far as left and right. I just want you guys to understand that politics plays a role in real estate.
Mm-mm.
Okay. And the taxes are determined by who? Who determines your property taxes?
The
Tax
There's a
assess.
chapter 8 or 9 taxes.
The county, the municipalities.
Your municipality
right.
that you live in, your council people, and your mayor
Tax,
vote on it.
tax assessor.
Now, they do have to take into consideration a tax rate, and that rate, who contributes to that? It's also the county and the county and the state, the school districts, the water sewage districts, all that stuff that plays a role. They all want a piece of the tax dollars, right? They need it to run. So your local municipality assesses a property value on your property, and then the tax man takes that assessed value and they multiply it by the tax rate to figure out what your taxes are.
Mhm.
Okay? So they're the ones that set the taxes. It doesn't get to the federal level. Presidents have no say in your property taxes, don't matter who the president is. Okay, But when it comes to tax deductions and things of that nature, it's a little bit different. So you have the Tax Cuts and Jobs Act, or TCJA, that he passed and put into law during his first term, which went into effect from 2018 and was set to expire 2025. And whoever was president at the time, this was going to be beyond his presidency. He said they could either renew the tax break or they could let it expire. If they let it expire, everybody's taxes, well, your deductions go away. So this allowed homeowners to deduct interest on qualified home loans of up to $750,000, which he lowered from $1 million. Previously in 2017, it was $1 million. So if you owned $1 million home, you could take all kinds of tax deductions. However, he lowered that amount because who owns $1 million homes? Rich people. So he lowered that a little bit to $750,000. For taxpayers who use married filing separate status, or if they're just single people, the home acquisition debt limit is $375,000. Now, these were average prices of homes in the United States. Obviously, these numbers seem pretty low for New Jersey.
Yeah, that's true. 375, you cannot find anyone.
But why is that? What drives up the prices here? What drives up the taxes here? You know, all of these things have nothing to do with the federal government. So the president's basing it on the averages in the United States. So they're dealing with the average people, not the rich people. So he's passing laws not for the rich, but for the average people to make these tax deductions. But you may be complaining about this because New Jersey is a very expensive and highly taxed state. So it affects us more. But it just goes to show he wasn't going after rich people, he was going after poor people. Oh, I'm sorry, he wasn't going after poor people, he was going after rich people, saying that the rich people can't take these deductions anymore. So the new law ended for the deductions for interest on home equity lines of credit until 2026. So basically, if you want to deduct the interest, if you take out a home equity loan for your house, you know, what is equity? The built-in value. It's the difference between how much you owe on the property and what it's currently worth, right? How much you owe versus what it's worth. That difference is your equity. So you could take a loan and drain that equity out of your property. And what can you use that loan for? Anything. Anything you want. It's your equity. You can do whatever you want with it, right? But if you want to get a tax break, if you want to be able to deduct the interest on that home equity loan, President Trump didn't want you using your house as a piggy bank. Unless you were putting that money back into your house for home improvements. Then he said, any loans you take, you could deduct the interest on that home equity loan if you put the money back into the house to try to do home improvements. The thing is, people were using their houses as piggy banks. They were draining the equity out, taking those home equity lines of credit, and then they were buying a car or vacation or buying whatever it is they wanted to buy. And then wanting to deduct the interest on these loans on their taxes. Sometimes people default on these loans. They don't pay them back. And they're like, well, I got all this money on the house now. It's like, it ain't worth it for me. It's like, whoa, hold on a second. It is worth it to you. The thing is, you already pulled that value out and you used it to go on vacation or buy a car or something. You already used your equity. You need to pay it back, right? So
As a home equity loan.
this was the whole purpose of him trying to do away with you being able to deduct the interest on your home equity loan unless you're putting it back into your house. it's less of a chance of people defaulting on their loans. It increases the value of your home, so they allow you to deduct the interest on it. It's actually a kind of smart thing to do, instead of using your house as a piggy bank for miscellaneous spending. And then you don't give a crap because now you're like, oh, that money's all gone now. All right, anyway, let me move on. So the upper limit to the state and local tax deductions, the SALT deductions, it was limited to, hold on a second, let me see what it was limited to. I think it was $10,000. Yeah, it was limited to $10,000 when he first passed the law. Now, he just renewed the law because it came up for expiration. So he renewed it and he raised this limit because people were in blue states, the high tax states, that they were complaining that, well, our taxes are so much money, we can't take advantage of these tax deductions because our states are taxing us so much. So he's like, all right. Yeah, I realize that your politicians in your state are not going to do nothing, and you're not going to argue with them because that's your politicians and whatever. So he's like, you know what? I raise it to $40,000, but just have you know that $40,000 is a lot for property taxes, isn't it?
Of course.
It used to be if you're paying $10,000, you're rich. If you got a home that you got to pay $10,000 in property taxes on or more, you're rich. That's why he put a $10,000 limit on who can make these deductions on their taxes. However, people in blue states bitched and complained, and some red states that have blue, where you have politicians that are actually blue states that have Republican politicians in them. They're like, we're not going to get reelected if we don't allow people to have these deductions. So the president's like, all right, I'll raise it to 40,000. So this limit has been particularly hard on property owners in New Jersey, New York, and California because these states have very high property taxes. Okay, so tell me politics doesn't play a role on how much you pay in your taxes or how much you could deduct on them.
That's so true.
Right?
So, that'll be 40 now.
Next time you got people that are complaining that President Trump is for the rich, then why were they complaining about his deductions taking them away from the rich? All right, so different income tax regulations apply to mortgage loans and investment properties. And we as real estate licensees should always recommend that clients consult a qualified tax person about their current tax regulations. Okay? So this is just to show you, we do have these laws in place. Now, I got to find out what the number is here, because I think the value for the homes, I think that went up again. I don't have the numbers. Let's see if we can look it up really quick. Hey, Google. The Tax Cut and Jobs Act that was just renewed allows qualified home loans up to how much?
These are the top results.
Of course, they're not showing me anything. All right. I got to go to some website somewhere and see what they say.
Ask AI.
Yeah, I didn't install the AI thing on my phone yet. I've just been going with the other Google features because they allow me to do something.
What is the question? What is the question?
What are the qualified home loan limits to the Tax Cut and Jobs Act? What are the qualified home loan limits for the Tax Cut and Jobs Act recent update?
Okay, who qualified for home loan limit?
According, no, this is still the old one, showing me the old figures. Unless that hasn't changed. You dive deeper.
Qualify for home loan limits and what?
Oh, no, it's still the same numbers. It's just now that it's permanent.
Oh,
because he said it to expire in 2025. But now in the big beautiful bill, he made it permanent.
It's for New Jersey, right?
No, for the country.
The
For the
federal.
country, yeah.
God, I hate these nuts. These nuts are causing me cough. Now maybe I'm allergic. I don't know. Anyway, moving on. A point is prepaid interest on a loan. It's tax deductible by the borrower and the year it's paid, no matter who paid them. And the math of the point is each point is equal to 1% of the loan, not the purchase price. We need to know this to get a problem right on exam,
Yeah.
which I'm going to have a couple slides that'll walk you through it. I made these slides interactive, so they're pretty cool. Okay, now let's just do these highlights and we'll get into the math. after.
Yeah.
So let's just do those highlights there.
Prepaid.
By the way, I don't think I threw out any polls today, did I? No, I did
No.
not. Let me toss one out there now for you. Now let's see who's paying attention and answering the polls today.
I wanted to ask for my hours. Did I finish 75 hours?
Oh, yes.
Okay.
Yeah, you definitely have it now.
Because first 2 days I was not there. I joined after that.
Yeah.
So we're in the same boat. We've joined together, right?
Yeah.
Yeah. You guys joined the same time. You missed the first 2 days, but we went over 2 days already.
Yeah,
right?
yeah.
So you guys definitely have enough time. There. All right. But those other people who aren't answering these polls even, that aren't paying attention in class, I can't say a whole lot for them.
Every day here.
Hint, hint, there's a poll out there. You may want to answer it. You want credit.
Okay, I have to line it.
All right.
Skip.
I'll end that poll because they're obviously just logging in and walking away. All right. So you guys have these highlights here?
Oh, no, let me get that one.
Yeah.
Prepaid interest.
Yeah, it's basically just saying that what a point is. A point is prepaid interest, and each point is 1% of the new loan, and the IRS allows the buyer to deduct them, not the seller. Even if the seller, we negotiate and get the seller to pay points, the buyer is the one that can deduct it on their taxes. Hoorah. All right, so with a buy down, I guess this will be the last slide, and then we'll break for lunch. I'm sorry. With a buy down, the borrower can purchase interest rate. I tell you what, if you got extra money to pay points on your loan to buy a lower interest rate, why not just use that money to make an extra mortgage payment, apply it entirely towards the principal? It'll save you more money in the long run.
Yeah, that is called.
So don't do this. Don't do this. Buy downs never. Look, I'm not a math guy, but I know formulas for stuff. But economists and these financial experts, they tell you your money's worth more in your pocket today than it is down the road. So don't ever purchase a lower interest rate. Okay, it doesn't even make sense. I actually got suckered into this once myself. I actually paid points knowing better that I shouldn't have. I bought an interest rate because it was just a super low interest rate. And then only to find out that like 6 months later, it came down even more. And I was like, do I do it again? It's like, no. But I got a low enough interest rate because mine is like 2.25 or 2.5 or something like that. It's super low interest rate. So the borrower is better off using that money to pay down the purchase price and borrow less for a lower balance than the lender can charge on the interest. So if you lower your balance, doesn't matter what the interest rate is, it's a less money they could charge you interest on.
Okay.
So you're saving more in the long run that way. Your money's more valuable in your pocket today than it is down the road, especially if you don't own the property long enough for that savings to pay off.
Mhm.
All right. So by the way, sometimes it's referred to as a buy down. A buy down is prepaying interest to get a lower interest rate on your loan. Some call it a 3-2-1 buy down. What is it? Often the seller pays points for a buyer to lower the interest rate for a period of time. For example, by 3% for the first year of the loan, 2% for the second, or 1% for the third. It's a 3-2-1 buy down. Because the buyer's qualifications for the loan is calculated using the initial interest rate, such an action by the seller enables the buyer to pay a higher purchase price for qualifying for a larger mortgage loan. Okay, that's the only. Actually, I said don't ever buy prepay interest. I lie. There is one time. Do not prepay interest to do a buy down to get a lower interest rate. You only prepay interest if it's needed for you to qualify for the loan. Sometimes people's debt to income ratios are a little wacky, and the lender won't lend them enough money. They won't qualify for enough money to purchase the property. But if they prepay some of the interest to buy a lower interest rate, all of a sudden it makes it more affordable for them. That's the only time where it would make sense for a buyer to prepay interest on a loan to lower the interest rate, is if it's needed for them to qualify for the loan. Okay. And the lender will do the calculations. We don't do these calculations, the lender does. All right. All right, so we're gonna leave it at that. I'll leave this slide up here. You guys can peruse through it if you like. And we're going to take our lunch break right now. So let me pause the record. All right. Mortgage lending is money lending is based on risk. So we refer to it as risk-based lending. The best interest rate you could possibly get is directly tied to the amount of risk that you pose to the lender. Factors include your down payment amount, if any, the FICO credit score of the borrower, your DTI, your debt to income ratio, the value and condition of the property, as well as the local market conditions. PITI, that's your principal, interest, taxes, property taxes, and homeowners insurance. So PITI payments include those property taxes and insurance in the monthly bill. The principal and interest, that's just your mortgage loan. Property taxes and homeowners insurance, those are expenses that you incur as a homeowner, and you could include them in your monthly mortgage payment. And if you do, it's less risk to the lender because they know these important bills are getting paid. So there's less risk of them having a tax foreclosure that wipes out their interest, or a house fire or something occurring and their interest or their collateral going up in smoke. So they try to incentivize borrowers to include those important payments in their monthly mortgage. And in exchange, they'll give you an 1/8 of a point discount on your interest rate. Do you need to include your taxes and insurance in your mortgage payment? No. They try to incentivize you by giving you a discount on the interest rate, an 1/8 of a point, if you do. So the total monthly expense for housing is PITI. But if you're buying into a condo, well, you also need to factor in HOA fees as well. So, but otherwise, it's normally PITI is principal, interest, taxes, and insurance, unless it's a condo, and then it also factors in HOA fees. They could all play a role in your qualifying to get a loan too. So a PITI loan is known as a budget loan because it includes all your total monthly expense for housing so that you could better budget your expenses. It's all rolled into one payment, your mortgage loan payment. So reserves. are an amount of money built up for the coming year's future expenses. So the first time you're charged in advance to help build up that reserve account for your closing costs. And that's at the time you purchase the property. So your property taxes and homeowners insurance for the coming year's expenses, that's your closing cost, basically. It makes up your closing cost. So RESPA, that's the Real Estate Settlement Procedures Act, limits the amount of reserves that a lender may charge. So lenders do periodic accounting annually, and they have to return any excesses in the reserve account over $50 above the maximum that lenders are allowed to charge, whatever that maximum is. Okay, so what are reserves? It's an amount of money built up for emergencies and repairs. Or coming years, or in this case, the coming year's payments, which are your taxes and homeowners insurance.
Do we have it in the book? Reserves?
Uh-huh. So right here,
Oh,
page
yeah.
274.
274. Oh, yeah. Budget loan. Basic.
So, when you pay off your mortgage loans, if you have any money in the reserve account still, the lender needs to return it to the borrower, because that's for the coming year's taxes and insurance. And you're not going to have any more mortgage payments, so they shouldn't be collecting any more money from you. And if they have any extra money built up for those in the reserve account, they need to return it to the borrower. And if they don't, where can you find it? Unclaimedproperty.nj.gov. They report it to the state. Or they
Okay. Okay. So, so reserves is for emergency and?
Well, reserves, when it comes to like if you're a member of a condo, you have an HOA fee, or you have reserves. Reserves is an amount of money that they build up for emergency payments and repairs. But when it comes to lending, reserves is also an amount of money that's built up, but it's for the coming year's expenses, like your property taxes and homeowners insurance.
Okay.
Because we use that term reserves in different times, for homeowners associations or for lending. When it comes to lending, the reserve account isn't for emergencies or repairs. That money is for the coming year's property tax and homeowners insurance bills. How about this? We know, according to RESPA law, lenders are limited in how much money they could collect for the reserve account, right? For the coming year's taxes and insurance. Can a lender require you to insure your house for a higher amount? Let's take a look at what happened here. Let's see what Count Dracula did. Guy looks like Dracula, right?
This morning from Philadelphia. Hey, Patrick.
Hey, how are you?
I'm doing well. So explain this for us. You actually had a home that Wells Fargo came to you and said, look, you need to take out a homeowner's insurance policy that you don't think it's worth the value of your home. What did you do to Wells Fargo in response?
I told them I wasn't going to renew that policy that they were having me renew. I had an insurance policy on my house, which I had bought for $180,000. And Wells went to the insurance company and said that they wanted me to insure it for $1 million. And as you can imagine, the premium on a policy like that is through the roof. So I said, no, I'm not going to do it. And they said, well, we're going to do it for you. And they force-placed an insurance policy for me that doesn't cover me. It only covers them. And that was the genesis of a dispute with them that's been running for nearly 2 years now.
Well, we did reach out to Wells Fargo, got no response from them. It sounds just like your experience with them, no response at all. Are you surprised by
Welcome to the
that?
world of dealing with Wells Fargo. No, I'm not surprised at all.
You also then found an interesting loophole, or not a loophole, but you found an interesting law dating back to the 1970s, which enabled you to work this angle, which is they needed to respond to you within 20 days. They needed to respond to you with written responses to your inquiries. They didn't do so, and therefore you were able to place a levy on their office and foreclose on them?
That's true. There's a law called RESPA, and there's a 20-day window that they have to acknowledge receipt of your request, and then they have 60 days to actually respond to that request. And if they don't, it's possible for you to collect damages and even additional fines on top of the damages. So I took them to court here in Philadelphia through the municipal court system. I won a judgment. They ignored the judgment. The court advised them they had to pay. They ignored that court's advice. And so I got a sheriff's levy, and when they ignored that, I ordered a sheriff's sale on their branch in downtown Philadelphia, and they still weren't going to pay. But let me tell you, when the media coverage started and it was on the front page of the business section that their office furniture was going to be sold off to pay a judgment, I had a check in my hands the next day.
Brilliant. And I can imagine a lot of viewers this morning waking up wondering if they're in a similar position. Do you think that your story opens the floodgates for other people watching this morning?
I think it does. I mean, people ask me what I hope to get out of this, and one thing is if I wind up being the Johnny Appleseed of RESPA letters, I would absolutely love for that to be my epitaph. These RESPA letters are not difficult to write. There are numerous consumer resources sites on the internet. There's government sites on the internet that'll help you with that process. And these RESPA letters, the banks are legally required to respond to them. So I would say to consumers, these are a very important tool if you're having a problem communicating with your mortgage lender.
Patrick Rogers from my home city of Philadelphia, good luck to you, and thanks for coming in and telling your story this morning.
Thanks for having me on.
Thanks, Patrick. Coming up here on the show, the budget protests in Wisconsin.
Okay, so that was that's a little bit of knowledge imparted to you there about RESPA. The RESPA laws require lenders to give certain disclosures to the consumer within certain time frames. And there are many, 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 many RESPA rules. In this one, he explained the RESPA rule that required the lenders to respond to inquiries from borrowers within 20 days. And if they don't respond to acknowledge that they received your inquiry within 20 days, they can be held liable for you for fines and damages. And then, like he said, they have to then respond with the actual information that you requested within 60 days. Otherwise, they could be held liable. And that's how he was able to get judgments against them, which they refused to pay. Surprise, surprise.
This morning.
But yeah, the RESPA laws cover a lot of different types of disclosures and for lenders. But basically, RESPA is known as the Real Estate Settlement Procedures Act, and it requires that the consumer have knowledge of all closing costs in the transaction. All right, let's go over some more math when it comes to a point. We learned that a point is prepaid interest on a loan. It's tax deductible by the borrower in the year it is paid, no matter who paid these points. So the math of a point is that each point is equal to 1% of the loan, not the purchase price. So here's a question for you. If the purchase price is $325,000 and the buyer put down 20% and pays 2 points and $5,000 in closing costs, how much money does the buyer need to purchase? You get a question very similar to this on school exam, I know, hint, hint. This is not the same numbers, but same idea. What would be the first step in trying to solve this?
First, we're going to find how much money does interest. Yes.
Interest. The points?
Each point is equal to 1% of the loan amount.
So what's the first step? What are you trying to figure out here to get for this project?
How much money does the buyer need to purchase?
Yeah, what's the total the buyer needs to purchase here?
So we need to find the interest and principal.
No.
No.
Yeah. First, I think we need to figure out the down payment.
All right, so what's the down payment at 20%?
Where is my phone?
So 325,000 times 20%. Figure out
One second. 1 second. Oof.
Okay, then walk me through after you figure out the down payment.
6500.
Just tell me. I want you to walk me through it. Just tell me what are your steps. I just want to know the steps. I don't want to know the numbers just yet.
Okay. I did it like 325,000 to the 20%. So that's the.
Okay, so you figured out your down payment amount, and that's the way you do it. 325,000 times 20%. Now what do? Now what's the next step?
Have to figure out the points.
Okay, and how do you calculate points?
1%. Each point is 2%, right? So 2%, 2 points, 2%.
Slow down. 2%.
2% of the that 65,000, right?
Well, what is 65,000?
I'm sorry?
What is 65,000? What are you talking about? What is 65,000?
Did I say 65,000? 325 times 20%? How much?
See, we could walk through this without the numbers here. 300. Let's take the purchase price of 325,000, times it by the down payment, 20%. That gives you how much money you need to have for a down payment.
65,000.
Next step is calculating a point. How do you calculate points?
Okay. Loan amount. So we're gonna do loan amount is.
What is the loan amount?
Is that right? 65,000?
The loan.
The loan amount is your down payment. No. 65,000.
So we're trying to.
65,000 is your down payment. That's the 20%.
260,000. 260,000.
And what is 260,000?
That's our 80%.
Okay, so that's the loan amount. Is that
the principal of the mortgage?
See, I want you to know what it is you're doing. You're punching in numbers and stuff, but you're not explaining to me what it is you're doing. I'm stupid here because I want you to explain to me what you're doing here. Okay. You have to. So 325,000 is your purchase price.
Right.
And you need to figure out what your down payment is. It's 20%. So you do
25% of the 3,500.
So you do 325,000 times the 20%. That gives you your down payment amount. The next step was to figure out the points. So I'm still asking, how do you calculate a point?
You have to multiply the mortgage loan times 2%.
The loan amount times
the point is the 1,000 on each $1,000, right?
Each point is 1% of the loan amount. It's on a slide right in front of you. Look at the slide.
Yeah.
Each point is equal to 1% of the loan amount.
Loan amount. Yeah.
Not the purchase price. So you got 2 points here. So you multiply the 2 points, the 2% times the loan amount. But what is the loan amount? Don't give me the number. How do you calculate the loan amount?
That's 80%.
That's the 20%.
80% of 325,000.
2 points.
The loan amount is the purchase price minus the down payment.
Minus the down payment, right?
So 325.
See, you could do this without doing the math. Okay, I just
minus
really to understand the concept. So 325 is the loan amount. I'm sorry, is the purchase price. You
Right.
subtract the 20% down payment,
Which is 65,000.
and whatever's left over is your loan amount. So then you multiply the loan amount times 2%. Each point is a percent of the loan. So to figure out what the 2 points are. And then you have that $5,000 in closing costs. So look at the screen. 325,000 times 20% down payment.
Which is 1625.
That's $65,000. That's your 20% down payment. You see how I
Right.
write next to each step what the number is so I don't get lost in the numbers?
Mm-hmm. Times the
Then you take that 325,000 purchase price minus the 20%, the $65,000, and $260,000 is your loan amount. Now, 260 the loan amount times the points, 2%, and that's $5,200. And then we get the 65,000, our down payment amount. We have the $5,200, that's our 2 points. And then we also need $5,000 in closing costs for a grand total of $75,200 is needed to buy.
Mhm.
See, that's your typical conventional loan, right? With a 20% down payment, if it required a 20% down payment. You see how some of these government insured loans can make it more affordable to get into home ownership when they require low down payment?
Mm-hmm.
Yeah, if you guys want to snap a picture of this, I'm going to move on to the next slide.
One minute. So 75,200 is the
That's how much money you need to purchase this house to close.
yeah,
Your down payment amount,
down payment, right?
2
Total.
points, and the closing costs.
Question.
Yes.
So when you buy the points, so the point they apply to the mortgage, to the interest, they apply the money you
Yeah.
pay?
Yeah, that's a point. It's prepaid interest on the loan.
Uh-huh.
Not everybody purchases property has to pay points.
It's saying like you put more money in the payment, right?
So where does the points come from?
Well,
That's Mike.
the lender may require you to pay points because your debt to income ratio, you don't qualify to borrow this much money unless you prepay some interest on the loan.
Okay, so
Right.
it comes from the lender.
So if you qualify, they're not gonna charge 1%.
Well, you may need to be charged the percentage in order to qualify.
Oh, the point's gonna be there.
Maybe, depends on your financial situation.
I see.
Okay, not everybody has to pay points. It depends on your finances, your financial situation, and the loan products you're getting. Or maybe you're trying to buy a lower interest rate too. Okay, so let's take the same exact problem. And we're going to word it differently. Look, this is the question that we had on the previous slide. If the purchase price is $325,000 and the buyer has to put down 20% and pay 2 points and $5,000 in closing costs, how much does the buyer need to purchase? Here's another way of saying the same exact thing. The purchase price is $325,000 with an LTV of 80%, and the buyer needs to pay 2 points and $5,000 in closing costs. How much does the buyer need to complete this purchase?
It's the same price, yeah.
It's the same exact problem, but the thing is, you need to know what an LTV is. If an LTV is 80%, how much is your down payment?
That is the 5,200.
20%.
20%. That's the 65,000.
Right.
Okay, so you need to know that, and if an LTV is 80%, LTV, what does it mean?
Yeah, I forgot. What is the loan?
loan to value ratio.
Yeah.
It will loan you 80% of the appraised value of the property. See why we need to understand what these terms mean? If you know what an LTV is, that's how much money the lender will loan you in relation to the value of the property. So if the LTV is 80%, that means, so the value is $325,000. They'll lend you 80%, so that means you got to put down 20% of that
Down payment. Mhm.
25,000. But you need to understand that. Otherwise, it's not going to be spelled out for you like this problem, perhaps. It could
Loan
be
to value.
this way, which they both say the same thing, except they don't tell you straight out, you need to put down 20%. Instead, they say the LTV is 80%. You need to figure out that you need to put down 20% by knowing what LTV means. Okay?
Also, let me ask you, what is that closing cost?
Closing costs usually consist of your impounds, for the coming year's property taxes and homeowners insurance.
That's
There may be some other miscellaneous costs involved there for filing fees, recording fees, and things of that nature. But the closing costs are primarily the coming year's expenses for property taxes and homeowners insurance.
okay.
So you're
That's gonna be
building up that reserve account for those expenses.
okay. And that's gonna be there too, right? Whenever you get the mortgage. Okay.
If you're getting a pity loan, also known as a
Oh,
loan, which includes those things. Do you need to include your property taxes and homeowners insurance in your mortgage loan? You do not.
can you repeat one more time?
Do you need to include your property taxes and homeowners insurance in your mortgage loan?
Not necessary, right?
No, you don't.
Yeah. Yeah.
The lender will try to incentivize you to by giving you a discount on your interest rate, by giving you an 1/8 of a point discount on your interest rate if you include those important payments in your monthly mortgage payment, so they could be sure that they're being paid, because they're the ones that are going to be paying them
Oh,
from your monthly payment.
I see.
All right, here's another problem. For the same math problem that we previously did, but using a different loan product. So if you're purchasing a property using an FHA loan, which only requires a 3.5% down payment for an LTV of 96.5, how much would you need to close if the purchase price is $325,000, a 3.5% down payment, and 2 points and $5,000 in closing costs? So it's the same math problem, except this time we're using an FHA loan, which only requires 3.5% down payment. So how much money do you need to close on this property?
So first we're gonna count the down payment, which is 6.5
What?
down payment, 6.5 down payment. So
Wait. What do you mean 6.5?
no, sorry, 3.5 down payment. Okay.
So what
So
do you do?
suppose
What's the first step here?
You need to know how much is down payment.
Okay, and so to figure out the down payment, you take the purchase price times the 3.5% down payment amount.
Mhm. The second step is to figure out how much is going to be the loan, mortgage loan.
And how do we figure that out?
To have to subtract the total price less the down payment.
So we have to subtract the down payment from the purchase price to get the loan amount.
Exactly.
And then we calculate the points. So here we go. On screen, 325 times 3.5%. Your down payment amount is $11,375.
I got it.
significantly more than the conventional loan, or significantly less than the conventional loan, which required $65,000 down payment, right? And so now we subtract that amount from the purchase price, and the loan amount is higher though. It's $313,625 because we put less money down. Now we calculate the points. We take that loan amount times the points, the 2%, 313,625 times 2%, and that gives us $6,272.50.
Right.
So the down payment amount, the 3.5%, 11,375, plus the points, the 2 points of $6,272.50,
16,375 total.
plus $5,000 closing costs, for a grand total of $22,647.50.
Yeah.
You got to add the down payment plus the points plus the closing costs to get the total needed.
I don't know why I happened. I counted, but I don't know.
So what was needed to purchase it using the conventional loan that required 20% down? What did it come out to? 72,000 and change that you needed to buy this same house?
Can you repeat the question, please?
How much money did we need in that other math problem that was using a conventional loan requiring 20% down payment? It was like 72,000 or change, right?
75,200. Yeah.
75,200.
Right.
Significantly less is needed using an FHA loan. So, can these government insured loans make getting into home ownership a lot more affordable?
Yeah.
Yeah, you need less than a third of the amount of money to purchase.
But you have more money up to the bank too. So you mortgage more large, you have to pay more.
Okay,
to payment.
but do you eventually pay it off over time?
Yeah, but it depends. I think if you have budget and your budget, you try to make it short as possible. So try to, if you have money, so you put it 20%.
Let me ask you a question. Would you rather be a renter?
What happened?
Would you rather be a renter or an owner?
Owner.
All right, so what's the argument?
No. My question is, my point for me personal, to do more down payment and get less money to pay to the bank because your interest is lower too.
What if you don't have it though?
If you don't have it, that's too pity. I know, yeah.
Yeah, but these types of loans make it more affordable for people to be able to get into home ownership.
Yeah.
And you'd rather be a homeowner than a renter.
Exactly.
Even though you're with this because you're putting down lower down payment, you're still getting into home ownership, and eventually you're paying the debt down, building equity, and building sort of a nest egg for you in home ownership of something. You know, if you could rent for the rest of your life, you'll never own the property. You'll never have anything of value. But if you instead pay down this loan, you get a loan, sure, you're borrowing more money because you don't have as much to put down, but this FHA insurance program allows you to get into home ownership when you don't have as much money.
Yeah.
You could always refinance later as you build equity into a conventional loan.
Yeah.
But this will help you get into home ownership.
Yeah, the value to be homeowner, the equity, I know, yeah.
Why do most people get FHA loans?
Because they want to make a less payment to buy property.
It's because it requires less money to buy the property.
Uh-huh.
So if you don't have all the money for the down payment, it allows people to get into home ownership without having a large amount of cash on hand.
Mm-hmm. Yes.
So half the loans in existence are FHA loans. All right. So remember, each line here is how much of your mortgage payment gets applied towards your principal and how much it gets applied towards the interest for each year of a 30-year loan. So you can see for the first half of the 30-year loan, the majority of your monthly mortgage payment goes
Interest.
to the principal. I'm sorry, goes towards the
Interest. Interest.
which is the rents for the use of someone else's money. Because most people don't live in the house for the full terms these days. So they reuse this mortgage factor chart to find out what your monthly mortgage payment would be based on per $1,000 you borrow. So if you get a loan at a 5.5% interest rate, what is for 25 years, what is the mortgage factor?
What's the rate you said?
5.5% interest rate for 25 years.
6.15.
All right, everybody agree?
For how much?
5.5% interest for 25 years. What is the mortgage factor?
6.88.
What?
25 years, 25 years.
25, yeah, 6.15.
Okay. So I want to make sure everybody can read the factor chart here. Right?
Yeah.
This is a little interesting clip. This is over a year old now. This has got to be maybe about 2 years ago. I snagged this off of the business channels. If you notice, a lot of the news that I get is from the business channels from different news networks. Because you get straighter news from the business channels, okay? If you retire, let's look at, this is just an interesting thing about if you retire and you have $1 million in savings, how long can you live off of that? It depends where you live.
It depends on your life.
Yeah. And also your lifestyle.
Let me ask, does anybody here have $1 million in savings so far?
I don't know.
The thing is, most people don't. Most people are living paycheck to paycheck, maybe have some money stashed away, but by no means anywhere near $1 million, unless you have 401k plans or retirement plans and you're starting to save up or build money towards your retirement. I highly suggest you do. So if you're just living paycheck to paycheck, you're never going to have any savings. And that means when you get a retirement age, how are you going to live? Off of Social Security? Social Security is a Ponzi scheme. You're never going to, it may not be around. We need politicians to keep injecting money into it. People say, well, I paid that money into the Social Security system. You didn't pay anything near to that system, what you're going to be pulling out of it. So that's why it's a Ponzi scheme, especially since we're paying people to collect Social Security benefits that just don't work. Maybe because they claim they got a disability, or maybe because they say, well, I don't know. We got people collecting on Social Security that shouldn't even be in this country legally. Okay, that we have them collecting Social Security benefits, which I don't know how that managed to happen, but they shouldn't have been. We've got dead people collecting Social Security, which is another thing. You know, this is that whole thing about that. What was that thing that when Elon Musk was helping out Trump? What did he put? Doge. Doge discovered that, you know. So, but this system, unless politicians find a way to revamp it, or they got to keep injecting money into it, we're never going to live to collect the Social Security. So let's just pretend that you have $1 million in savings. How long can you survive off of that?
The report, by the way, noted that even with $1 million.
Hold on, let me share the computer audio so you can hear it. Now let me raise my volume here because it's
dollars in retirement. The report, by the way, noted that even with $1 million in retirement savings, the average person would only be able to cover about 14 years of expenses in New York City, and I'm not sure it would go that far. New Jersey came in 49th in affordability, followed by Vermont, Massachusetts, Maryland, Washington, Connecticut, Maine, Illinois, and Oregon. California not in there, making up the bottom 10. Okay, let's get to the other side of the story. Where's the most affordable place? Alabama, number one, as the most affordable state to retire in, followed by Tennessee, West Virginia, South Carolina, Wyoming, Delaware, Georgia, Arkansas, Florida, and Mississippi. In other words, the South. All right, Stu, there you go. New York, though, not very affordable, apparently.
that was a very nice summary. In other words, the South.
interesting. All right. But it's something that we should be thinking about. And hey, you're going in the real estate industry. You're going to be earning money. Hopefully, you'll earn a lot of it. And then you could start saving in your retirement plan if you haven't. What the hell? How to calculate your monthly payment. Okay, so let's look over calculating monthly principal and payments. Your loan amount per $1,000 borrowed times the mortgage factor equals the principal and interest. Use the mortgage factor chart to get the factor. You know, the one on page, what was it, 272?
Yeah.
273, I'm sorry.
273.
So how do you calculate your monthly interest? Well, you find out interest is calculated annually. So you have to calculate the loan amount, excuse me, times the interest rate. That gives you the annual interest, and then you divide it by 12 to get the monthly. Then you take your monthly mortgage payment, the PI, subtract the monthly interest, and then you're left with the principal. So here's the formulas. Loan amount per 1,000 borrowed times the mortgage factor equals the PI, the principal and interest. Then you take the loan amount times the interest rate equals the annual interest divided by 12 to get the monthly interest. And then you take your PI, which is your monthly principal and interest, and then you subtract the monthly interest, the I, and you're left over with the P, the principal. So, question, pull out your calculators. $400,000 loan for 30 years at a 5% interest rate. What is the factor? Using that factor chart.
Okay, so 5%, 1 minute, 30 years is 537. Okay.
Okay, let's take a look. 5.37 is correct. So that's the factor. So how much is the monthly mortgage payment? This is a two-part question. How much is your monthly mortgage payment, the PI? And how much of that monthly mortgage payment goes towards paying the principal?
You want us to count?
Yes.
Okay.
What's the first step?
We're gonna find down payment first, which is 20,000, which is 20,000.
So how do we figure that out?
That we're gonna take 4,000 loan amount times
Is there a down payment stated here in this question?
Oh, loan for 30 years. What is the factor? Ooh,
Okay.
that's it.
Well, you got the factor already. But
Okay.
now the question is, how much of that goes toward, what is your monthly mortgage payment, and how much of that goes towards the principal paying down the debt? So, what numbers do we need?
We need,
How do we figure out monthly mortgage payment?
You have to multiply the loan, the amount the loan time to the factor.
Okay, so the factor is 5.37. So what numbers do we multiply here?
400,000 times by 5.37.
We take 400,000?
no, 400.
400. It's loan amount per $1,000. So 400 is the loan per 100,000 because there's 400,000. So there's 400 times the factor of 5.37 gives us a PI, the principal and interest of $2,148. That's your mortgage payment. So how do we figure out how much of that goes towards the principal? What do we got to do? See, I don't want you doing the math. I want you to, because you can use calculators on exam. I want you guys to understand the formulas to remember how do we get to it. So I don't want you guys stuck on a calculator punching in numbers. I want you to understand the theory behind how do we get to those numbers. So
Okay, 1 second. Before we do this, so the previous examples, we did not use that $1,000. We took the whole amount, 325,000, something like. Here we are taking 400 only. Why?
previous examples where we were trying to figure out the monthly mortgage payment, we did.
Mortgage payment. Okay.
The last problems on the previous slide that we were doing, we were figuring out how much money you needed to purchase the house. Okay, that's a little bit different. Here we're trying to figure out what your mortgage payment is. This is how your lender tells you what your monthly mortgage payment's going to be. They use a factor chart and they plug it, and this is what they do behind the scenes. So they want you, the lender's doing behind the scenes here. Okay, but now I'm trying to so you guys understand the math of how do you figure out how much of your monthly mortgage payment goes towards paying down the principal. Look, here's the formula right here. PI minus I equals P. So we got to figure out what the I is. What is I?
Interest.
Interest.
So how do we calculate interest?
So
we're gonna take the amount, the loan amount
You take the loan amount
times interest, 5%.
times the interest rate. There you go. So 400,000, not per thousands. You take the full loan amount of 400,000, times it by the interest rate of 5%, and that's $20,000 in annual interest. Divide that by 12, and you get $1,666 is that monthly interest payment. So how do we figure out what the principal is? We subtract the I from the PI to get the P. 2148, that's your PI, your principal and interest. Subtract the 1666, that's the interest, the monthly interest. And you're left with the principal, 482.
So this calculation usually lender, they do it, right?
Well, the lender doesn't figure out how much of your monthly payment goes towards the principal. They figure out what your monthly mortgage payment is. They only take the factor times the loan amount to give you the PI.
The only thing I'm confused, when to use that 400, you took out that 1,003 zeros.
When you find out the monthly mortgage payment, you take the loan amount per $1,000 borrowed. You use the factor chart. That factor chart is how much your mortgage payment's going to be for principal and interest per $1,000 borrowed. So if it's like, if the factor is 5.37, that's $5.33. That a factor, they call it a factor, but that's
Yeah.
$5.37 for every $1,000 you borrowed. Here you're borrowing 400,000. So you're not gonna be multiplying 5.37 times 400,000. You're gonna that's per $1,000 borrowed. So for every 1,000, 400, how many thousands are there in 400,000? 400. So 5.37 times 400 will give you your monthly mortgage payment of $2,148.
So whenever we have factor, we use that loan per $1,000, right? That we use like
Yes.
right?
See-
Whenever it's the factor.
You could use this stuff with your own clients to give them a ballpark figure of how much the mortgage payment would be for them. But usually we get a mortgage rep on the phone and they run the numbers for them because different lenders have different loan programs.
Right.
Plus, these numbers may not be exact to what their figures are because maybe their factor chart's slightly different, But this is basically how we run down the numbers. So I guess the Real Estate Commission just wants you to know how this stuff gets done. I mean, you don't even need to do this in real life when you're working in real estate and selling real estate, but you can use it to help your clients
Yeah, of course.
ballpark how much their loan will cost before they even contact the mortgage rep, right?
No, Miss, I got the point actually for both different examples, but only I'm confused when to use this $1,000. Like 400,000, we are counting 400 times
When you use-
when you use the factor, right?
correct.
Yeah,
Then-
that's I need to. Yeah.
Per $1,000 borrowed when you're using the factor to try to figure out what the monthly mortgage payment is.
Right.
So just remember this, interest is calculated on an annual basis and you use the loan amount times the interest rate, the full loan amount times the interest rate. So it's the full $400,000 times the interest rate. Okay. So knowing that, you could figure out that the other one, when you're trying to figure out the mortgage payment with the factor, that's the one that's per $1,000.
Hmm.
Okay, anybody want to snap picture of this one before I move on to
Yeah,
another?
let me snip it.
I'll give you another
So
question.
to be loan officer at the bank, so you had to have license, mortgage license? No.
Yeah, they're mortgage solicitors. Yes, loan solicitors. Yes, they need to be licensed. It used to be, I used to have my solicitor's license. Basically, what I did is, I was a licensed real estate agent and a loan solicitor. It was to get your mortgage loan solicitor's license.
There's loan mortgage.
You fill out a one-page application and submit $100 to the state treasurer of New Jersey. No training, no class, no exams, no nothing.
Yeah, because the bank employees, when they want to move from one place to another place, so if you are telling they want to promote it to be loan officer, they just keep moving. They go to the fingerprint and do the application, and yes, you are loan officer.
What fingerprint? There was no fingerprinting. It was a one-page application and $100. That's it.
No, they do because I used to work for Wells Fargo.
That's when I got my license.
Okay.
Now, today, things have significantly changed. You
Okay.
take classes. You need to take an exam. You need to take, actually, you have to take classes every year or every 2 years. You need to take continuing education classes as a loan solicitor now, too. There's a lot more involved in it. In the past, you filled out a one-page application with a very few questions on it, and you paid $100. You're a loan solicitor. I hope you get some training from your mortgage broker.
So let me
Yeah.
ask you, some people I see that they have license, they got the license and 4 or 5 years or 10 years, they didn't do anything. So when they're coming back, if they want to come back, they have to take the exam again.
Oh, no, they
They
probably take a class, take an exam, get fingerprinted. They need to affiliate with a broker, mortgage broker, or a bank or lending institution. You know, they need to fulfill um, annual training, the CE classes and stuff.
State exam, you said again they have to take it? No, right?
Yeah, they do.
So
Different,
it's just
there's different requirements. There's new requirements now for licensing.
so
Yeah.
it's the same thing they have to study again, like they have to go over with whatever the
No, they got their license, so I couldn't tell you what they got to do. It depends how long their license was not hanging, you know, or their license was not active. You know, if they didn't keep
of
up,
course it's not active.
if they didn't keep their studies up on these things, yeah, they need to they got to retake everything,
Wow. Okay.
just like a real estate agent.
Yeah, yeah.
If you have your license hanging in referral for a long enough period of time, you may be required to retake the exam.
Oh,
Okay. You got your screenshots here, so I could move on?
I did.
I have it.
All right, here's a
Thank
question
you.
for you. If you notice, all these same instructions are the same up top. So if you want to just take a picture of the instructions just on their own, get a screenshot just of them without the problem.
Oh,
Mhm.
really? Okay, 1 minute.
The formula that you need to know to figure it out.
Yeah.
Yeah,
To practice.
I keep stressing to you, you need to study the formulas. I could care less if you know math. I suck at math, but I know how to use a calculator, and you could use a calculator on your exams. So as long as you know the formulas, who cares if you know the math? Okay. Okay, so here's a new question for you. Well, actually, no, it's a continuation of the previous question. We're going to add something to it where you need to calculate the pity.
Oh,
So for the same problem as the previous slide, if the taxes were $9,000 and the property insurance is $900 a year, what is the pity, the principal, interest, taxes, and insurance amount? So remember the previous problem, the PI was $2,148. So now in this case, we have $900
repeat.
a year insurance and annual taxes of $9,000 a year. How do we calculate the pity?
So right now we don't have a factor or anything because of course we have that thing. Okay.
Yeah, well, we don't need a factor. We already got it figured
Yeah,
out.
we got it. We got it. Yeah.
We got it. So this is your PI. Okay, so how do we calculate the taxes and insurance into that? How do we figure out the pity payment?
So you had to add 9,000 plus 900, then divided by 12, and then add it to the PI.
So you add your PI. So you got to figure out what your monthly TI is. So you add your taxes, your annual insurance to get your annual combination of taxes and insurance, the TI. You divide that by 12, and this is your monthly TI, taxes and insurance. So you add your PI to your TI, you shake it all back, and you get your PI.
Your PI, your P plus your TI.
Yeah,
PI,
I pity
PI.
to make that payment, right? Oh, $2,973 is your total monthly expense for housing now. So taxes and insurance, could that significantly increase how much money you need? Yes.
$800.
This plays a significant role. So states that have really high property taxes, New Jersey being one of them, can significantly consider contribute to your monthly mortgage payment if it's included in it.
If they are flood insurance, there's more money, right?
Yeah, taxes and insurance. In this case, it's $900 a year and $9,000 in annual taxes. You know what the average taxes are in New Jersey now?
1,000.
1,000. I wish.
Oh,
What are your annual property taxes?
property. Mine is almost 15,000.
What are the average property taxes in New Jersey?
Property
Average
tax. I had insurance. Okay, property tax. 10,000. That's average.
10 to 15,000 or 7 to 9,000.
You know what's the scary part? You guys say that without even blinking. You know, not even in disgust. You just take it for what it is. You know, I think it's disgusting that taxes are that much. You pay 15,000 in taxes. Oh my God. You know,
Yeah.
now the average taxes in New Jersey now, I believe, are $9,700 a year.
Yeah.
10,000. Yeah. Yeah. It's too expensive. If they don't do nothing.
Yeah, I mean the previous year I was teaching this, it was 8,500.
Oh man.
Tells you how much your taxes can go up like this. But then again, you know, your taxes are based on various factors. Mostly your municipality votes for your property taxes and determines what your property taxes are. Now, the state can contribute to that because they may have, remember, they have that the tax rate. They contribute to the tax rate, how much money they need for park districts and forest preserves and transportation for state and federal or for state government, for libraries, for education, all that, and that's all factored in. So they also need to multiply that. So your municipality though covers a large chunk of that amount in that tax rate, and you multiply the assessed value of a property times the tax rate to come up with your property taxes. So, but then again, you know how it is. Governor Murphy told you every time that everybody elected him, he said, if high taxes aren't your thing, then New Jersey ain't for you. How arrogant. We got another election coming up, and people are fighting, about taxes, right? Does anybody know the views of the two candidates for governor right now on the high taxes that we pay in New Jersey for various things? The election's coming up soon. You better familiarize yourself. I do not suggest you watch these commercials, though.
They don't say nothing about taxes.
Oh, they are. Oh, they are. That Mickey, what's her name? Mickey Sherrill or something like that?
Cheryl.
Yeah, Mickey Sherrill. She's been putting out commercials there that Jack Ciattarelli wants a 10% tax increase. She created this little video that's like an animated GIF of him. 10% increase, 10% increase, 10% increase. Or 10% taxes, 10% taxes, 10% taxes, but it's like 2-second clip that just keeps repeating. The whole reason behind that is because she made it up. It's a false story. Jack Ciattarelli outright called her a liar and said that he's going to sue her if she doesn't stop these commercials. Her and her production committees that are putting out these commercials now. He said he's going to sue her for it. He's like, that. She got that little video clip of him saying 10% had nothing to do with New Jersey. He was actually in Tennessee, and he was commenting about different places, different states, and how they do the taxing of their to collect the money from their citizens, whether it's property taxes or some other way. Tennessee doesn't have any property taxes. Instead, they charge everybody 10% tax on everything. So she took that clip where he said 10% tax on everything and just put it on a loop. 10% tax, 10%. And keep in mind, he did this back in 2010, I think it was. She took a clip from 2010 and she's putting it out there now saying that he wants to raise everybody's taxes by 10%, 10% taxes, 10% taxes, 10% taxes, so do your own research and don't go by commercials you see on TV, because I don't believe anything these political action committees say out there. They're just trying to get their candidates in office. I'm not pushing you one way or the other. I'm just telling you, do your research on both of them. Okay. Hey, check this out. How do you compare two mortgage loans? You get a question like this on state exam. How much would you save on the interest over the life of a loan on a 25-year loan versus a 30-year loan if the loan amount is $300,000 and the interest rate is 5%? You approach this problem. I just want to ask you. I got it solved on the next slide, but I just want to ask you. Can you think of an approach of how you would figure this out? Based on what I taught you already.
You need to look for the
Down payment first.
There's nothing here about a down payment.
They say the loan, right?
Yeah.
The loan. Okay, so we have to find out the factor.
Okay, you got to find out the factor for each loan, and then we're gonna run the numbers side by side to compare the loans.
Exactly.
So what is the mortgage factor on a 25-year loan at 5%? And what is the mortgage factor on a 30-year loan at 5%?
585 and 537.
Okay, so now you figure out what the monthly mortgage payment would be for each. Because it's per $1,000, you take 300 times the factor.
Times 585. Yeah, 1 second.
And then you take 300 times the factor for the other. And you
So
do calculation, right?
Yeah. And I got for both 1611 and 1755. So first one for 25 years one, that's 1755 and 1611.
Okay. So the question here is asking now, how much would you save on interest over the life of the loan? What would be your next step? You have the monthly mortgage payment that includes principal and interest right now. That's where you're for each loan. So how would you calculate to compare how much interest you pay over the life of the loans for each one?
How to compare?
I'm going to give you a little tip. It has to deal with how many payments are there in 25-year loan and how many payments are there in a 30-year loan. 30-year loan, there's 360 payments. 25-year loan, there's 300. So multiply your, what was the monthly mortgage payment for the 25-year loan?
1755.
Multiply that by 300 because there's 3 payments in 25 years.
300 times 1755 for 25 years I'm counting. 526, 500.
Okay, 526, 500. That's how much total you would have paid over 25 years for a 5% interest loan for $300,000.
Oh.
Calculate how much of that went towards the interest. Well,
okay, so
subtract the principal. 300,000. And then you do that for the other one too. Here, I'll show you on the next slide. Well, actually, the next slide, I got the factor chart here on how you figure it out. And here it is. So look, the 25-year loan side by side. Here's the factor for each one using this factor chart. We figured that out, okay? Now we know, well, how many total payments over the life of the loan? 25 years times 12 months, that's 300 months in a 25-year loan. 30-year loan times 12 months, that's 360 months in 30 years.
Right.
So how much is the mortgage payment? Well, 300 because it's per $1,000 borrowed. So 300 times the factor of 585 is 1755 monthly mortgage payment. That includes principal and interest. And 1611 for the other one, right? So now you just calculate it by taking the monthly mortgage payment, times it by the number of payments over the life of the loan. For a 25-year loan, that's 300. For a 30-year loan, it's 360. And now you get the totals.
Now,
second and take a look at this just for 1 second right here. If you take out a $300,000 loan at only 5% interest rate, if you keep that loan for 30 years, you would have paid $579,960 for that house.
You pay 50,000 more, 53,000.
So it's better to go with 25 year.
Well, look, in a 25-year loan, you borrow $300,000 in $26,500. The house isn't $300,000 anymore. It's now $526,500. Although keep in mind you can deduct the interest payments on your taxes, right? So there's that. But at the end of the day, how much did you pay in interest payments? Well, we could take the total PI minus the principal, the amount we borrowed, the $300,000, and that gives us the interest over the life of the loan. So you would have paid $226,500 in interest to borrow $300,000 over a 25-year loan.
Mm-hmm.
And for a 30-year loan, you would have paid $279,960. Okay, so now let's subtract these two to compare the two loans and see what the difference is, what the savings would be.
Oh, wow.
A 5-year loan versus a 30-year loan. It's a $53,460 total savings in interest payments. So that's how you come up with the answer. You just fill it out side by side, but the key there was figuring out how many payments are there over the life of the loan. Okay? That's the key. You may want to snap a picture of this where I show you step by step how to do it.
This is similar to car loan, right?
I don't know. Let's just focus on this.
Not all steps.
Yeah.
Basic.
Yeah, I don't know. Car loans have a lot of other stuff that they stuff in there. Other expenses and fees and nonsense.
I see.
Yeah. Let's keep it simple. Let's just focus.
Yeah. Okay.
I'm gonna also remake this slide, make it interactive. You know, instead of just having the side by side comparison.
This is good.
Yeah, make it interactive too.
I
So
see.
you see, slide number 44. I'm just gonna make a note for myself to redo the slide and make it interactive.
Okay.
Chapter 14, slide 44. Make interactive.
So each month I am paying how much?
Which loan do you have? Which loan are you talking about?
25 and 30, anyone, but how much I am paying monthly?
Oh, you already got it.
Over there.
25-year loan, it's $1,755. 30-year loan, it's $1,611.
Yeah, that's 1755 each month, right?
Yep.
Plus the TI.
Yeah, that's just this is just for your loan.
Yeah. For the loan.
It's not counting the taxes and insurance. This is just a part of the pity.
No escrow account.
Yeah. All right. There's some other problems here. You could work through these slideshows if you want to work on some other math problems. Plus, there's other problems in the back of the book. And the shared Google Drive, I got plenty of them for you as well. Okay. Here's a couple.
Okay.
All right. So let's take a look at this. The T formula. Okay, small number always T formula. We did this on day one. We used it to figure out our commissions and such. We used it to figure out a couple math problems already. We used it to figure out. No, we didn't figure out cap rates yet. But
hey, look at this. Thank TGIF. Thank God it's Friday.
No, first.
I'm sorry.
It does not stand for thank God it's Friday. It stands for the top number, the number that's on top of the key, goes in the calculator first.
Okay.
That's our little acronym there. TGIF. Top number goes in calculator first. So you down and multiply across to figure out the missing number. You need to have two of these three figures to figure out the missing component. Okay?
Mhm.
The small number always, the large number on one side, and a percentage or rate goes on the other. Now, whatever that is, I'll give you some examples. So here's that same thing from the previous slide, but here's some actual examples. Like if you want to figure out what your commission is going to be, well, that's number one here. You match it up to these are the other numbers you need to know: the sale price and the commission rate. So then you multiply across to get the commission amount. Now, if you have the commission amount and the sale price and you want to figure out what the commission you charge,
Commission rate.
you take the commission amount divided by the sale price and you'll get that amount. And if you want to figure out what the sale price is, because you have the commission and the commission rate, but you don't have the sale price, you take the commission amount, put that in the calculator first, divide the commission rate, and you'll get the sale price.
Mhm.
So that's how you would do the math problem. But now there's 5 different problems here I show you how to figure out using this T formula. You could use it to figure out interest payments, but you got to use annual amounts. Net income, that would be, let me see, number 3, that would be the market value or the cap rate, to calculate cap rates. Number 4, dollar amount, net profit loss, that's for figuring out profit and losses.
Investments.
Mhm. And then for taxes, right, the assessed value, the tax rate, and the amount of annual taxes that you pay.
Mm.
You could figure out the figures here using these formulas. You may want to snap a picture of this because this is not in the book.
Yeah, give me a second.
This is a tool I'm teaching you. They do have the T formula in the book, but they don't even show it like this. They show the small number is the part, the large number is the base, and the percentage is the rate. Base part rate, they teach you. Okay.
Mhm.
All right, so here's a problem for you.
Oh, wow. Nice.
Monthly interest payment is 5%. If the monthly interest payment is 5%, payment at 5% is $1,250 monthly. What is the principal amount of the loan? I already got something over here for you figured out. I should fix this so it doesn't say I gave it away.
7500000.
So what I did here is I gave you this. I gave you part of this.
Yeah.
To cover that up, and just to ask you, looking at this problem here, if the monthly interest payment at 5% is $1,250, how much is the full loan amount for?
$300,000.
Yeah, but the loan amount, you got to use the annual interest, not the monthly. If you're trying to figure out the full loan amount, if you're trying to figure out a monthly mortgage payment, this number will work. But if you're trying to figure out the full loan amount, you need to figure out the annual interest. So how do you calculate the annual interest? You just take the monthly interest, this number, times it by 12 to get that 15,000.
Right.
That's how we came up with that.
Mm-hmm. And 5% is the
15,000 divided by the interest rate of 5%. And then you get the loan amount of 300,000. Sometimes they try to be tricky with you like that on exam. Instead of giving you the full interest, annual interest, they tell you what the monthly interest is. It's not that hard of a problem to figure out, but you just got to understand the concept of it, the formula. The numbers.
15,000 times 5%, right? Or minus.
Yeah, but how did we get that 15,000? Because that wasn't in the question. They didn't give you this number. I gave it to you by mistake.
Yeah,
here.
yeah, right.
And they give you 5% and $1,250 monthly payment. You needed to know that if you're trying to figure out the full loan amount, the principal, not a monthly payment, but the annual, the actual, or not the annual, the full loan amount, you need to know the annual interest payment.
Annual, yes. 1,250 times.
That's the trick to figure out this problem.
That's true.
And then it's not that hard after that. You could use the T formula to plug in the numbers.
I got 750. 15,000 times 5% is 750.
Times
It's,
you,
it's,
you divide down. Remember the T formula. You divide down or multiply across. You have 15,000. And what's this symbol right here? That's not multiplication. That's division.
right,
So you got to hit 15,000 divided by 5%,
right.
not multiplied by. And now what did you get?
Divide. Okay. 15,000. Divide 5%. 300,000. Got it.
There you go.
I was doing that.
You got to remember TGIF. That's why you got to remember the top number goes in the calculator first, but you got to know what that top number is.
What is that?
Large number on one side and a percentage or rate on the other. And you divide down, multiply across.
Well, we have to read the question, what they're asking. That's the thing.
Yes, you do. But this T formula, they're not going to give you. It's a tool I'm teaching you to help you know where to plug in numbers. And if you got to multiply or divide. So the small number always goes up top.
Wow.
Always goes on the bottom. So in that example that we just did, is the interest a small number in comparison to the loan amount?
Can you repeat one more time?
Is the
Couldn't hear.
interest smaller than the loan amount?
No.
It's not.
Yes, it is.
Yes, it is.
Oh, then loan amount. Yeah, of course. So interest is smaller amount. Yeah.
Interest is always going to be smaller than the loan
Smaller
amount.
amount. Right.
So that interest dollar figure goes on the top of the T formula, and the loan is down the bottom, and then the interest rate on the other side. So you then divide down and multiply cost to figure out the rest.
I see.
But you got to use a little thought there about what's the small number and what's the large number.
Mm.
Or you could study this whole thing here, trying to remember everything.
Wow.
But just know the small number, large number, small number always up on top, large number on the bottom, and the percentage or rate on the other side. Okay?
Interest payment, net profit, loss, taxes. Okay.
All right, so let's move on from the math for a little while. We'll have more math coming up.
Yeah.
The Your Home Toolkit, we still got a lot more to go through in this chapter. So the Your Home Loan Toolkit is a step-by-step guide explaining how to shop for loan costs, and it warns consumers about the pitfalls and charges from lenders when shopping for a loan. Now, there was always a booklet like this from HUD. HUD is the Department of Housing and Urban Development. But during the Obama presidency, during his administration, he created a new agency called the CFPB, the Consumer Financial Protection Bureau. Ooh, it sounds nice, that name, Consumer Financial Protection Bureau. But even back then, before President Trump was ever president, he was complaining about this, saying, that's unconstitutional. You created a fourth branch of government. You can't have the president of the United States create their own branches of government. That's not how our country was set up. So, and some people, whatever. Well, no, think about it for a second. He created this new government agency. Their job is to create rules for lenders and then create fines if they violate those rules. And then they also get to collect those fines and keep the money to fund their own agency. Oh, answerable to the president or Congress. Isn't that a new agency? Separate but equal, but not answerable to anyone? So it actually ended up taking years, but President Trump was able to get it to the Supreme Court and rule that it is unconstitutional. And so we still have the agency there, but now they're answerable to both the president and to Congress. Okay, because the way it was set up originally, it was created like a fourth branch of government. So now you're going to hate the fact that he created this agency because I'm teaching you this stuff now. This new branch, this new governmental agency, the Consumer Financial Protection Bureau, at least when it comes to real estate and lending for real estate, they took over a lot of the duties of HUD. And to try to justify their existence, they took a lot of the forms that HUD already had and they renamed them. Or they combined some forms and then gave them a new name. So and what I have to teach you right now is, you need to know what the old form was called under HUD and what it did and what the new name is and the timeline that it needs to be given to the consumer. So you don't just need to know the name of the form and what it does, you also need to know the timeline and what the old name was. Don't shoot the messenger. All right, so lenders are required by the CFPB to provide the toolkit within 3 business days of the completed loan application, aliens. Now, go ahead, ask me, what are aliens? Creatures. No, aliens is actually an acronym to figure out when the consumer has completed the loan application. When they provided the information of aliens, the address of the property that's being purchased, the loan amount requested, the income of all the borrowers, the estimated value of the property, the names of all the borrowers, and their social security numbers. That's what the acronym aliens, you see it spells aliens straight down here, aliens. So on page 294, there's something like this too that we're going to highlight when we get to it later, where you can highlight straight down like that in the aliens acronym. All right, so the interesting thing is the lenders are required to provide this toolkit on how to shop and compare loan costs between lenders within 3 business days of the completed loan application, or they face all kinds of stiff penalties and fines. The interesting thing is they didn't put any rule in place that required anybody to explain it to the consumer. So they just created some rules that lenders need to follow so that they could fine them if they don't give it on time. But they really don't care if they explain it if anybody explains it to the consumer or not.
So right now, whenever do they give you this kind of toolkit?
Yeah. Send it to you in the mail.
Oh, okay.
But nobody explains it to you. I suggest that you as a real estate licensee should go over it with the consumer. So familiarize yourself with it and talk to the consumer about these topics that are in the toolkit. You know, like how to shop for loan, how to compare loans, how to shop for loan affordability. You know, should you prepay points, all kinds of stuff like that, you know, because a lot of lenders will tell you when you get pre-qualified for a loan with a lender, the lender will tell you, hey, don't go shopping for loans because each lender is going to run your credit score and it's going to drop your credit score. And then you may not qualify for a loan anymore because it's going to destroy your credit score. That's false. That is 100% false, or 9% false, because it affects your credit score slightly. But the credit reporting agencies are going to realize that you're shopping for a loan. It's not going to take such a huge hit on your credit score. If you go shop for a couple of lenders and they all run your credit score, yeah, it's a hit against your credit report and it will affect your credit score a point or two.
Oh, yeah.
Is a point or two going to destroy your credit to the point you're not going to be able to get a loan? No. And if it is, you're not ready to shop for a home. That means your credit score is all, it's low. And you need to get your credit house, your financial house in order before you start actually shopping for a house. Okay.
Right.
So aliens, once again, is this acronym of the loan application is considered complete and the lender is required to send this toolkit out to the consumer to show them how to shop for loans. Now they also need to provide something called the LE to the consumer, the loan estimate, which we're going to be getting into this stuff in a moment. So here's the opportunity for a buyer's agent to educate their clients. And by the way, here's some more free content for your real estate websites I provided for you here. A link to the Consumer Financial Protection Bureau's website to that toolkit where you could get an interactive one online. I also found a great home buyer's guide from the Real Estate Commission that is kind of old, but it's still a great guide for shopping for a home. It teaches you everything about how to select a real estate agent, what their job is. It teaches you about different loans and how lenders qualify you for loans and all kinds. It's very, very informative, and it teaches about all steps of the home buying process, from the lending and buying to selecting a real estate agent to home inspections and getting repairs done afterwards and all kinds of other stuff like that. It's a complete guide. It's actually good for you as a new agent or to be agent to study this. Or just to read it over once, you know. And then there's another home buyer's guide from the New Jersey Mortgage Housing and Finance Agency called or New Jersey Housing Mortgage Finance Agency, the NJHMFA. They put together a home buyer's guide that's interactive for us as well. Let me make sure it's still there. Yes, it is. Okay. Because the interactive one's no longer, but I found the link and I replaced it here. So they've got a guide here as well. All right, for
toolkit
for learning about how to shop for a home. Okay, so this is their guide. NJHousing.gov, the road home. 1-800-NJ-HOUSE is their phone number. And they got all kinds of questions and calculators for you. Look, they talk about affordability calculators, biweekly mortgage calculators, and you can get that stuff from the New Jersey Realtors website. They've got all these calculators available there. But so you see they got links and all kinds of neat stuff there, all right? So let me just take from the slideshow. You could also take a look at the New Jersey Real Estate Commission's home buyer's guide. This one's a little bit older, but most of the information's still good. See, this was created by the not by the Real Estate Commission, I'm sorry, by the Department of Banking and Insurance. Actually, the Real Estate Commission created it, but the Real Estate Commission is a division of the Department of Banking and Insurance. So here's that guide. Talks about getting started, why buy a home, why not, you know, assess your financial situation, review your credit, what's the score, going shopping for a home, you know, making the offer, getting ready for settlement, insuring your home, sealing the deal, you know, and it goes over a lot of these things that we've already spoke about. And I'm going to have some screenshots actually from this booklet in the coming slides. What are the tax advantages of being a homeowner? You know, all kinds of stuff like that. So let me take these guides here and share them with you. Let me get it from the slideshow and I'll share it with you, even though all these links are in that ClassLinks Word document.
Okay, 1 second.
I'm going to share this with you in the chat window.
Okay. Okay.
There you go. You got it in the chat window.
Yeah.
All right, so in the toolkit, they explain how to determine loan affordability, how credit scores affect your ability to get lending, borrowing money, how to choose the best loan and down payment, understanding the trade-off between points and interest rates, the value of shopping for several different lenders, how to avoid pitfalls and problems, and then they teach you about the loan estimate and the CD. And I got some page reference numbers, some cross-reference numbers here for you, where we'll learn about it in this chapter and the next chapter where they bring these things up. So within 3 business days of your completed loan application, when is your loan application considered complete? When all the information from aliens has been provided, right? That acronym. Then the lender needs to send to the consumer the toolkit, and they need to give them a loan estimate. This is a loan estimate of what your closing costs are going to be. But this is given at the beginning of the transaction. So it's only an estimate. These numbers are not guaranteed to be 100% accurate. But the lender has to be as accurate as possible, because towards the end of the process, the closing disclosure shows what all the actual final numbers are at the closing. This needs to be provided to the consumer within 3 business days before the closing. So the consumer should compare the loan estimate with the CD. There are certain tolerance limitations that the lender cannot vary greater than. Otherwise, the lender has to eat those costs. All right, so the Your Loan Home Toolkit, let's just highlight this stuff now in the book on page 275. And after you do that, we can also take the after lunch attendance poll.
Okay, 1 second. Okay. The home loan toolkit. Where is the next?
All right, everybody got that?
Toolkit.
Yeah, got it.
Yes, yes.
All right, so now let's learn about the different types of loans that are out there. We have conventional loans. These are loans originated by what we call portfolio lenders. These are lenders who lend their own money. They don't plan on reselling the loans. They keep them in their own investment portfolio. So these loans are directly between the lender and the borrower, with no third-party influence from outside sources who may set the guidelines for the types of loans they're willing to buy. Those outside sources being those investors. Remember what I told you? Your local lender will originate a loan to you with the intent to resell it to some investor that they already have lined up. Those qualifying, remember I told you they got those qualifying loan qualifications that you need to meet in order to qualify to get the loan? Well, conventional loans, they don't do that. They got their own qualifications that have nothing to do with any third-party outside sources, because they're not planning on reselling these loans. They plan on keeping them themselves. We just went over the math showing you how much money lenders can actually make off of charging you interest if they hold on to those loans for the long term, right? At a 5% interest for a 30-year loan, they're making almost $300,000 by lending you $300,000, right? What was it, $279,000 they made in interest? Pretty good to hold on to it for the long term if you got that kind of scratch, right? So these are lenders that lend money directly between the borrower and lender with no third-party involvement or influence from those outside sources who set up those guidelines for the types of loans they're willing to buy. Because this lender doesn't plan on reselling the loans, they have more flexibility in who they lend to. Now, that doesn't mean you take your borrowers who have crappy credit scores and debt to income ratios that are through the roof to the conventional lenders. They're not going to lend their money to risky borrowers. Would you? If I told you a person has a poor record of paying back loans that they, could you lend them some money? Would you do it?
No.
No. I love you. So these guys aren't going to do it either. But they do have more flexibility because they don't have these rigid guidelines that they need to follow, these rigid arbitrary guidelines that some investor outside investors said the borrower needs to meet these criteria and the house they're buying needs to meet this criteria. Otherwise, we will not buy that loan. Okay. Conventional lenders, they don't care because they're not planning on reselling those loans. They're going to hold on to them themselves to make the money. So they have a little more flexibility. So the government-backed loans, we have government-backed loans, those from the FHA, that's the Federal Housing Administration, who insures loans, and the VA, that's the Department of Veterans Affairs, who guarantees 25% of the loan made to veterans. Now, here's an interesting thing. Contrary to popular belief, the FHA and the VA does not lend money. The FHA insures loans, the VA guarantees loans. So both the FHA and the VA loans require purchase contracts contain a special amendatory clause that states if the property appraises below the purchase price, the buyer can get out of the contract without penalty. That's not the first time I said this to you in this class. I said it plenty of times actually already. So what is the purpose of the special amendatory clause required by FHA and VA loans? It says if the house does not appraise for the purchase price, the buyer can get out of the contract without penalty.
Mm-hmm.
They will not be held in breach of contract. And then we have loans from the state of New Jersey itself. We have the NJHMFA. That's the New Jersey Mortgage, Housing, and Finance Agency. Once again, they do not lend money directly themselves. They have a list of approved lenders who are approved to lend money to consumers through their programs that they insure. So the loan comes from the lenders, the approved lenders for their various loan programs. They have loan programs for teachers and firefighters and police pension programs. They have loan programs for first-time home buyers. They have a lot of different programs like that. So these loans are direct. Okay, so those loans come from the lender and they're insured by the NJHMFA. And then we have loans that come directly from the federal government. The REC-D, that's the Rural Economic Community Development, formerly called the Farmers Home Loan Administration. These loans are funded directly by the USDA. Anybody know what that is? The United States Department of Agriculture. So they give loans directly to people who live in rural areas. It's not just for farmers. They give loans to farmers and people who live in rural areas, including those that live on Indian reservations. Yes, we have Indian reservations in New Jersey.
They're Native American, right?
Yes, the Native Americans. They could get loans from the USDA directly, even though they're not a part of the United States government. If they're sovereign territory, they don't need to follow our laws. All right, so remember, we have the urban areas, which are densely populated. We have suburbia, or suburban, which is a little less densely populated. And then we have rural, which are those sparse areas where people live farther away from each other. So let's do the highlights now, page 275. A conventional loan are those arranged entirely between the borrower and the lending institution. Loans are the insured by the FHA and guaranteed by the VA. I just put a little note in here. Max seller concession allowed for FHA and VA loans is 6% of the loan amount.
Yeah, I need to write it down. Max seller.
So whenever you guys get a chance, just when you're done here, just let me know.
Yeah, sure. 1 second. Miss 1 minute.
You just whenever you're done, just let me know. I know there's a lot of notes on this page here. Max seller concession allowed for FHA and VA loans, 6% of the loan amount. Above where it says New Jersey Housing Mortgage Finance Agency, right? NJHMFA. And then write this next to the title of conventional loans, and then this at the bottom. That maximum seller concession allowed for a conventional loan is 3% of the loan amount.
With no, right? No third.
With no third party involvement or influence.
Yeah.
So conventional loans are originated by portfolio lenders with no third party involvement or influence.
Right. And the last line, max seller.
The max,
Again, same thing.
yeah, the maximum seller concession allowed for a conventional loan is 3% of the loan amount.
I'm almost done. Okay. Concession.
3 or 6?
It's 3.
Yeah,
It's 3% for the FHA and VA loans, 3% for conventional loans.
Okay, I'm good.
You guys
I'm
done?
done. Yes.
All right, so how does lending work?
How lending works.
Most lenders, they don't lend their own money. And those that do are called portfolio lenders, or sometimes you refer to them as conventional lenders. They call them portfolio or conventional lenders. And the loans are often referred to either as conventional or portfolio loans.
Mhm.
Who do consumers get loans from? Well, they get them from banks,
Banks,
credit unions, and investors. But who are these investors, these private investors? Well, insurance companies, investment funds, etc. These are common sources of obtaining funds. Look, your insurance company, homeowners insurance, car insurance, life insurance. Most people don't file claims because we hope not to get into accidents. So in the meantime, between claims being filed, the lenders are sitting on a pile of money. They don't just sit on it. They use the money to make more. They give out mortgage loans, or they buy mortgage loans that were already originated, because there's a lot of money to be had in them, in buying these loans and servicing them, right? We already seen that example for that $300,000 loan at only a 5% interest rate. Now, banks lend their depositors money. Now, this story is technically incorrect, but it's easier for us to comprehend and understand when I tell it this way. So I'm going to read this story so you have an understanding of how banking works. But then in one of these coming slides, I'm going to show you about a 15-minute video that explains to you how it really works.
Mm-hmm.
So banks lend their depositors money. That's what most people think. You go to a bank to get a loan to buy a house, they're lending you their depositors money. That's why they're always trying to get depositors to open new bank accounts, right?
Right.
So banks lend their depositors money according to some third-party investors' criteria, those lending guidelines for the loans that they're willing to purchase. So they lend their depositors money with the intent to have lined up already an investor who's willing to buy those loans so that they could get all the money back, plus some of the interest as profit. And then maybe the investor will also pay that bank a servicing fee to continue doing the monthly mortgage loan collections for the payments and rendering billing and all that stuff. Okay, so that's how your banks make money. They keep writing loans and then selling them, getting the money back, plus some interest, plus a servicing fee to do the billing and collections. Okay, and they write many loans out, they sell them, they get the money back, they do the thing, rinse and repeat over and over again. That's how your local banks make money. Okay, easy to understand, but technically wrong. Okay, we understand that concept, so you can visualize that concept. It's easy to understand. Let's just stick with that for now. Now, we need to know what the primary mortgage market is. This is going to be mentioned in the next chapter. Remember, I told you some of these chapters, the information kind of like overlaps. Well, the primary mortgage market, or simply referred to as the primary market, is where loans are originated to consumers to purchase real estate.
Right.
Those loans are then resold to investors in what is called the secondary market, or the secondary mortgage market. You could just call it the secondary market or the secondary mortgage market. So the primary market is where loans are originated to the consumer to buy a home. The secondary market is where those loans are then resold to investors. Everybody understand that? It's a
Yes.
There's no reason to try to confuse it.
Yeah.
Okay.
What do you call secondary loan?
Yeah, the secondary market.
Market, right? Okay.
Primary market, you could use the mortgage in there or not.
Right.
Primary market and secondary market. Yep.
Okay.
The primary market is where loans are originated to consumers to buy real estate. Secondary market is where those loans are then resold to investors, which are usually other banks or hedge funds or what have you, you know.
Okay.
All right, so here's that video I was talking about. I already showed you a little cartoon clip from it. Remember about usury? Dare I ask
Usury.
what usury is?
Yeah, usury.
What is-
Usury means
Recall. Memory recall.
To lend money for exorbitant amount
some-
persons.
some kind of negative word. That's usury is some kind of negative word.
Usury is charging an illegal rate of interest. It's charging an illegally high rate of interest.
A high rate of interest, right?
And usury laws are to prevent loan sharking, which is charging an illegally high rate of interest. But usury laws only apply to private parties, not to governments. Okay? So I got that little clip from this movie here, this documentary called Money as Debt. It's a great educational video on how money has value and how lending works worldwide, but focusing on the USA. And it was created by an economist, some world economist. So there's several versions of this. I like the first version the best, actually. He created a second version because some economists were like, well, you technically simplified this one aspect, so you're actually kind of maybe a smidgen teensy bit wrong. So he's like, all right, you guys can all keep complaining about it. And he fixed it, and he came out with a Money is Debt Promises Unleashed Part 2. Okay. But I think he screwed up the video in the process. So I prefer the first version. I think it's easier, simplified, and easy to understand. So we're going to watch about 15 minutes of this. Okay. So let me optimize the video for sharing, turn on the stereo, minimize my video, and we're going to open this up. Let me see. Do I have it in the next slide, or should I open it from the internet? Nope, I got it coming up on a slide. So I got it on the next slide. So, yeah, here it is. Okay, so let me put a little note here on this slide just to skip over. See next slide for video. Okay. Whoop.
Thank you.
All right. This is a video I think everybody should watch. So I tell the instructor to please show up till actually 17 minutes we're going to watch of this. So in the meantime, I guess while this video plays, I'm going to run off to the John, okay? But I'll be right back. But you guys watch it. Let me make sure the audio and everything is good first, okay?
Sure.
Here we go. I know the beginning is a little bit quiet here, so but read through this. All right.
Mm-hmm. Well, that's a powerful statement right there, isn't it? Permit me to issue and control the money of a nation, and I care not who makes its laws. Mayer Anselm Rothschild, banker. You guys ever heard of the Rothschilds? One of them super rich families.
Two great mysteries dominate our lives, love and money. What is love is a question that has been endlessly explored in stories, songs, books, movies, and television. But the same cannot be said about the question, what is money? It's not surprising that monetary theory hasn't inspired any blockbuster movies, but it was not even mentioned at the schools most of us attended. For most of us, the question, where does money come from, brings to mind a picture of the mint printing bills and stamping coins. Money, most of us believe, is created by the government. It's true, but only to a point. Those metal and paper symbols of value we usually think of as money are indeed produced by an agency of the federal government called the Mint. But the vast majority of money is not created by the Mint. It is created in huge amounts every day by private corporations known as banks. Most of us believe that banks lend out money that has been entrusted to them by depositors. Easy to picture, but not the truth. In fact, banks create the money they loan, not from the bank's own earnings, not from the money deposited, but directly from the borrower's promise to repay. The borrower's signature on the loan papers is an obligation to pay the bank the amount of the loan plus interest, or lose the house, the car, whatever asset was pledged as collateral. That's a big commitment from the borrower. What does the same signature require of the bank? The bank gets to conjure into existence the amount of the loan and just write it into the borrower's account. Sound far-fetched? Surely that can't be true. But it is. To demonstrate how this miracle of modern banking came about, consider this simple story, the goldsmith's tale. Once upon various times, pretty much anything was used as money. It just had to be portable, and enough people had to have faith that it could later be exchanged for things of real value, like food, clothing, and shelter. Shells, cocoa beans, pretty stones, even feathers have been used as money. Gold and silver were attractive, soft, and easy to work with, so some cultures became expert with these metals. Goldsmiths made trade much easier by casting coins, standardized units of these metals whose weight and purity was certified. Well, to protect his gold, the goldsmith needed a vault, and soon his fellow townsmen were knocking on his door, wanting to rent space to safeguard their own coins and valuables. Before long, the goldsmith was renting every shelf in the vault and earning a small income from his vault rental business. Years went by, and the goldsmith made an astute observation. Depositors rarely came in to remove their actual physical gold, and they never all came in at once. That was because the claim checks the goldsmith had written as receipts for the gold were being traded in the marketplace as if they were the gold itself. This paper money was far more convenient than heavy coins, and amounts could simply be written instead of laboriously counted one by one for each transaction. Meanwhile, the goldsmith had another business. He lent out his gold, charging interest. Well, as convenient claim check money came into acceptance, borrowers began asking for their loans in the form of these claim checks instead of the actual metal. As industry expanded, more and more people asked the goldsmith for loans. This gave the goldsmith an even better idea. He knew that very few of his depositors ever removed their actual gold, so the goldsmith figured he could easily get away with lending out claim checks against his depositors' gold, in addition to his own. As long as the loans were repaid, his depositors would be none the wiser and no worse off, and the goldsmith, now more banker than artisan, would make a far greater profit than he could by lending only his own gold. For years, the goldsmith secretly enjoyed a good income from the interest earned on everybody else's deposits. Now a prominent lender, he grew steadily richer than his fellow townsmen, and he flaunted it. Suspicions grew that he was spending his depositors' money. His depositors got together and threatened withdrawal of their gold if the goldsmith didn't come clean about his newfound wealth. Contrary to what one might expect, this did not turn out to be a disaster for the goldsmith. Despite the duplicity inherent in his scheme, his idea did work. The depositors had not lost anything. Their gold was all safe in the goldsmith's vault. Well, rather than taking back their gold, the depositors demanded that the goldsmith, now their banker, cut them in by paying them a share of the interest. And that was the beginning of banking. The banker paid a low interest rate on deposits of other people's money that he then loaned out at a higher interest. The difference covered the bank's cost of operation and its profit. The logic of this system was simple, and it seemed like a reasonable way to satisfy the demand for credit. However, this is not the way banking works today. Our goldsmith banker was not content with the income remaining after sharing the interest earnings with his depositors, and the demand for credit was growing fast as Europeans spread out across the world. But his loans were limited by the amount of gold his depositors had in his vault. That's when he got an even bolder idea. Since no one but himself knew what was actually in his vaults, he could lend out claim checks on gold that wasn't even there. As long as all the claim check holders didn't come to the vault at the same time and demand real gold, How would anyone find out? This new
Remember I told you about that? If you ever go to your bank and you try to take out some of your money, a large amount, they don't have it there. Here's a link to how that works.
scheme worked very well, and the banker became enormously wealthy on the interest paid on gold that did not exist. The idea that the banker would just create money out of nothing was too outrageous to believe, so for a long time the thought did not occur to people. But the power to just invent money went to the banker's head, as you can well imagine. In time, the magnitude of the banker's loans and his ostentatious wealth did trigger suspicions once again. Some borrowers started to demand real gold instead of paper representations. Rumors spread. Suddenly, several wealthy depositors showed up to remove their gold. The game was up. A sea of claim check holders flooded the street outside the closed doors of the bank. Alas, the banker did not have enough gold and silver to redeem all the paper he had put into their hands. This is called a run on the bank, and it is what every banker dreads. This phenomenon of a run on the bank ruined individual banks and, not surprisingly, damaged public confidence in all bankers. It would have been straightforward to outlaw the practice of creating money from nothing. But the large volumes of credit the bankers were offering had become essential to the success of European commercial expansion, so instead the practice was legalized and regulated. Bankers agreed to abide by limits on the amount of fictional loan money that could be lent out. The limit would still be a number much larger than the actual value of gold and silver in the vault. Quite often the ratio was 9 fictional dollars to 1 actual dollar in gold. These regulations were enforced by surprise inspections. It was also arranged that, in the event of a run, central banks would support local banks with emergency infusions of gold. Only if there were runs on a lot of banks simultaneously would the banker's credit bubble burst and the system come crashing down. Over the years, the fractional reserve system and its integrated network of banks backed by a central bank has become the dominant money system of the world. At the same time, the fraction of gold backing the debt money has steadily shrunk to nothing. The basic nature of money has changed. In the past, a paper dollar was actually a receipt that could be redeemed for a fixed weight of gold or silver. In the present, a paper or digital dollar can only be redeemed for another paper or digital dollar. In the past, privately created bank credit existed only in the form of private banknotes, which people had the choice to refuse, just as we have the choice to refuse someone's private check today. In the present, privately created bank credit is legally convertible to government-issued fiat currency, the dollars, loonies, and pounds we habitually think of as money. Fiat currency is money created by government fiat or decree, and legal tender laws declare that citizens must accept this fiat money as payment for debt, or else the courts will not enforce the obligation. So now the question is, if governments and banks can both just create money, then how much money exists? In the past, the total amount of money in existence was limited to the actual physical quantities of whatever commodity was in use as money. For example, in order for new gold or silver money to be created, more gold or silver had to be found and dug out of the ground. In the present, money is literally created as debt. New money is created whenever anyone takes a loan from the bank. As a result, the total amount of money that can be created has only one real limit: the total level of debt. Governments place an additional statutory limit on the creation of new money by enforcing rules known as fractional reserve requirements. Essentially arbitrary, fractional reserve requirements vary from country to country and from time to time. In the past, it was common to require banks to have at least $1 worth of real gold in the vault to back $10 worth of debt money created. Today, reserve requirement ratios no longer apply to the ratio of new money to gold on deposit, but merely to the ratio of new debt money to existing debt money on deposit in the bank. Today, a bank's reserves consists of three things: the amount of government-issued cash that the bank has in its vault, the amount of credit it has with the central bank, and the amount of already existing debt money the bank has on deposit. To illustrate this in a simple way, let's imagine that a new bank has just started up and has no depositors yet. Investors have paid for the bank's infrastructure and have supplied it with sufficient cash to meet the demand for cash withdrawals. Typically, cash in the vault will amount to no more than $1 for every $20 or $30 that could be demanded from the bank. The bank has joined the central bank system, which permits the new bank to borrow cash from the central bank if it's needed. The doors open, and the new bank welcomes its first loan customer. The customer needs $10,000 to buy a car. On approval, the bank creates an account for the borrower and types in that the bank owes the borrower $10,000. This $10,000 is not taken from anywhere. It's created on the spot. The borrower does not take this money out in cash. Instead, he writes a check on his account to buy the car. The seller then deposits this newly created $10,000 check at her bank. At a ratio of 9-to-1, this new $10,000 deposit allows the seller's bank to create a new loan of $9,000. And if that $9,000 is then deposited by a third party, it becomes the legal basis for a third issue of bank credit, this time for the amount of $8,100. Like one of those Russian dolls, each layer of which contains a smaller doll inside, each new deposit contains the potential for a slightly smaller loan in a decreasing series. Now, at any stage, if the money created is taken out in cash and not deposited at a bank, the process stops. That's the unpredictable part of the money creation mechanism. But more likely, at every step, the new bank credit money will be deposited at a bank, and the reserve ratio process can repeat itself over and over until almost $100,000 of brand new bank credit money has been created within the banking system. All of this new money has been created entirely from debt, and all transactions have been carried out with bank credit. None of the banks involved have needed to use any of the cash in their vaults. What's more, under this ingenious system, the books of each bank in the chain must show that the bank has 10% more on deposit than it has out on loan. This gives banks a very real incentive to seek deposits in order to be able to make loans, supporting the general but misleading impression that loans come out of deposits. Now, it can't be said that any one bank got to multiply the initial $10,000.
So remember I told you that story about how banking works in a nutshell, how the bank lends the depositors money.
Mm-hmm.
It's easier for us to understand, but it's technically not true. That's not the way that it works. So let's just back that up again.
Must show that the bank has 10% more on deposit than it has out on loan. This gives banks a very real incentive to seek deposits in order to be able to make loans, supporting the general but misleading impression that loans come out of deposits. Now, it can't be said that any one bank got to multiply the initial $10,000 of bank credit into $100,000 of bank credit. However, the banking system is a closed loop. Bank credit created at one bank becomes a deposit in another, and so on and so on. In a theoretical world of perfectly equal exchanges, the banks would owe each other nothing at the end of the day, and the $10,000 created out of thin air as a loan by the first bank could indeed become almost $100,000 of new loan money in the banking system. If that sounds ridiculous, try this. Actual reserve ratios can be much higher than 9-to-1. For some types of accounts, 20-to-1 and 33-to-1 ratios are common. There are also many exceptions where no reserve requirements apply at all. So, while the rules are complex, the common sense reality is...
All right, we're going to leave that right there. But what did you guys think about that video? Is that very eye-opening? And did you learn anything there about banking that you didn't previously know?
It's a lot behind the scene going on.
A lot going on there. Yeah, banks come up with money. They lend you money that they don't even have. If you tried doing that, you'd go to jail for fraud. They do it, and that's their everyday business. That's their everyday business model. It is kind of eye-opening. It's very eye-opening.
Mm-hmm.
We also think that the bank lends their depositors money, but they don't, because they seek out all depositors, because the more people that deposit money into the bank,
the more they're making.
Allows them to create more money out of thin air, more of that fake money out of thin air.
So what put banks out of business when they do that?
When all the creditors or all their depositors, like you, if you go to the bank and a bunch of people go to the bank, all demanding their money out at once.
Oh.
Then the central bank comes in and tries to swoop in and provide that money so that the bank doesn't go out of business and crumble. That's why, remember, they all try to work together. All banks are members of this central bank.
Central banking, yep.
If this happens to a bunch of banks at once, boom, the system comes crumbling down. All right. So conventional loans are those directly between the borrower and the lender with no third-party involvement or influence. So this is a pretty good slide I have here just about conventional lending.
Right.
It gives a better definition than the book does in a paragraph or so. So conventional loans, also referred to as portfolio loans, are loans directly between the borrower and the lender with no third party or involvement or influence. So therefore, they have more flexibility in who they lend to. You get these from portfolio lenders, also referred to as conventional lenders. These are lenders that lend their own money, so they make the decision on who they want to lend it to, because they don't have no intent on reselling those loans to an investor. So do not confuse conventional loans with conforming loans. These are two different entirely loans. Conventional loans are from conventional or portfolio lenders that lend their own money. Conforming loans are those that meet some third party's arbitrary lending guidelines. They conform to those lending standards. Fannie Mae is the largest purchaser of loans in the secondary market. It's estimated that they own 1 out of every 10 loans in existence. That's a lot for one company.
Mm-hmm.
So,
I had a first student loan with them.
With who?
Fannie Mae. And I'm like, they still around?
Fannie Mae, you got it through a relative, Sally.
It wasn't Sally Mae. When I went to Catherine Gibb, it was Fannie Mae.
You got Fannie Mae, you got Ginnie Mae, you got Sally Mae. They're all
Fannie Mae.
Sally Mae was the one giving student loans.
Sally Mae? That was Sallie? Maybe, yeah. Yeah. I look back at my records, but you might be right.
So Fannie Mae purchases, they deal with real estate loans, So Fannie Mae buys 1 out of every 10 loans in existence there for the real estate. And then she got her ugly stepsister, Ginny. Sister. Well, I want you to know that they're related, but you can see by their last name that they're related.
Mm-hmm.
But Ginnie Mae, she buys those risky loans that lenders make for people that don't put down a lot of money or that have not so great credit scores. With greater risk comes greater reward for the investor. So Ginnie Mae pays out more for the investors. Okay, so anyway, the lender has the final say in who they're going to lend to because they're lending their own money and they're more flexible. That doesn't mean that they make risky loans. So the maximum seller concession allowed for a conventional loan is 3% of the loan amount. They typically require a larger down payment. 20% is common or more. But I have seen conventional loans with the requirement as low as 3%. If the LTV is higher than 80%, what does that mean? That means they're lending more than 80% of the value of the property. The borrower's putting down less than 20%. Conventional banking theory states that that's risking their depositors' money, so they need to carry private mortgage insurance, PMI.
Right.
Okay, so anytime the lender loans you more than 80% of the value of the property, the borrower must pay private mortgage insurance.
Okay.
The list of some portfolio lenders I had in my Rolodex. I'm not sure if PPAC Gladstone's still around, though. I know they moved out of Piscataway, so I'm not sure if they're still around.
I think they're up in like Branchburg, like up northwest.
You seen them around still? Okay.
Mm-hmm.
Well, there's a plant in New Jersey called PPAC Gladstone.
PMI.
I think they're moving more to PA.
Well, the town's up north, Jersey. So, Amboy Savings Bank, PPAC Gladstone, Provident, Unity, Columbia, and Santander. These are all portfolio lenders. They lend their own money. Although Santander, they only tend to lend their own money for larger projects. So what's that PMI insurance? Here's a slide that explains
private mortgage. Sorry.
Yep. So here's that slide that explains this to you. That PMI is private mortgage insurance. It insures any amount less than 20% the borrower put down when purchasing. An example is if the borrower only puts down 5%, the PMI insurance insures the other 15%, the amount less than 20% the buyer put down. It does not insure the whole loan. It's not life insurance either. It only insures the down payment less than 20% that a borrower put down.
I thought more than 20% if you have, then PMI, you need insurance.
You need PMI insurance when you put down less than 20%.
Less than, sorry. Okay.
So lenders, a borrower can request that the lender drop the private mortgage insurance at the borrower's request when their equity reaches 20%. Because what does PMI insurance insure? The amount less than 20% you put down. And lenders are required by law to drop PMI insurance when equity is greater than 22%. So you could drop the PMI insurance at the borrower's request when equity reaches 20%, and they must drop it by law when it reaches 22%. What is PMI insurance insuring at if you got 22% equity?
Nothing.
Nothing. It only insures the amount less than 22%. So why does the government allow banks to charge you for private mortgage insurance up to 22%? And then they have to drop it after that. Well, because values fluctuate always, you know, so it's hard to keep an eye on everything exactly at 20%, right? So the borrower's request, you can request it, they'll look it up. If it's 20% equity, then they'll drop it. But they must drop it automatically when it reaches 22. So they're only allowed that kind of a leeway for market fluctuations in value. Now, it is not life insurance, and once again, it does not insure the entire loan like MIP. I know it's got the same letters, PMI, MIP. MIP is insurance for FHA loans, which insures the entire loan. See,
okay, and that's the difference between PMI, because they only insure up to 20% or less. Okay.
Insurance only insures the down payment amount less than 20% that the borrower did not put down. MIP is mortgage insurance premium that the borrower pays for the entire loan. So let's highlight that. Now, sometimes to confirm that you've reached 20% equity, the lender will pay a real estate agent to do a BPO, a broker's price opinion. That's an estimate of value, similar to a CMA, but we do it for a fee for the lender. If you are doing BPOs, you still need to be paid through your broker. You cannot be paid by anybody but your broker. So that payment has to go through your brokerage. So as with other commissions and fees, any payment the licensee receives for providing a BPO must be paid to the agent's supervising broker, and then that gets split with you according to whatever your commission split is. Unless you have an agreement with your broker that they'll pay you all of it.
Too much, too many things to remember. What is the last line? Yeah, S.
Okay. Anybody still highlighting?
I'm done.
Okay. So now we're going to go over the FHA. You guys may want to snap a picture of this because this one slide contains information you're going to be highlighting over like next 5 or 6 pages. I got it all on one slide here for you, the information you need to know about FHA loans. And apparently I need to fix something in this slide. All right. Okay, so FHA loans. FHA is the Federal Housing Administration. They opened up their own website. They used to have their web page through HUD, but now they got their own website. It was opened up during Biden's administration. They started FHA had started their own website, but its website is pretty much nothing now. They pretty much refers to, I think even now it points now when you go there.
Can't reach this page.
So it's gone now. It was a pretty useless website. All right, never mind. Maybe they're doing something with it because I know they were just they had their own FHA Gov website. FHA.com, by the way, is not a government website. FHA was temporarily. It was up for a little during the Biden administration, but it was pretty useless. There wasn't much information on it. All the information was still on the HUD website for FHA. But let's take a look what happens when you go to FHA.com. Oh, look at this cartoonish website. Look at this character over here. Zero down payment possible with a grant. 3.5% down payment required with a credit score. 10% down payment without a credit score.
That's not true.
It is when you get a loan through them, it is. This is not the FHA. They tell you the Federal Housing Administration increased loan limits annually in 3,151 counties across the country due to house price appreciation through the last year. FHA limits inform borrowers of the maximum available to purchase a home in every county, and it's per county. It varies per county. This website, this lender, I don't know who the hell this lender is, FHA.com. I don't know what the actual lender's name is, or if that's what they call themselves. But they stipulate here that FHA.com is a privately owned website. It is not a government agency and does not make loans. Oh, that's pretty interesting.
So what do they do if they don't make loans?
So what are they, just an information website? Well, either way, I found they got a lot of good information here about FHA loans on here. FHA.com since 2001. Maybe they generate leads for mortgage reps, and then they sell those leads. This is what some websites do. They just generate content, and then they get leads for borrowers that are looking for loans, and then they sell those leads to mortgage solicitors. So they got a lot of good information here. Like, let's see what the FHA loan limits are now. Look at this. You could get an FHA loan with a credit score as low as 580 with 3.5% down. Apparently, you can get a credit score lower than 580, but you got to put 10% down. Wow. Wow. 30-year FHA fixed is currently at 6.07 interest rate. All right. Yeah, and then they show you all these other different lenders here. Okay, there's a lot of information you could get about FHA loans on this website other way. Let's go back here. So the FHA insures loans, but doesn't lend money. It insures the lender for the entire loan amount against loss. The FHA says, hey, lender, loan this borrower your money if they meet lending criteria. Loan your money and we will insure you against loss, that you won't lose a penny. That's what the FHA does. Loans are for purchasing or refinancing owner-occupied 1 to 4 family homes, not for investors. They're for owner occupants.
Hmm. 1 to 4 family homes.
That's residential. Anything other than 4 units is considered commercial, right? So this is not for investors. These FHA loans are meant for owner occupants, for people to get into home ownership. For 1 to 4 family homes. You don't need to buy a 1 family home. You could buy a 4 family house. You live in 1 unit and you rent out the other 3 to help you with mortgage, right? So the FHA 203B is the most popular FHA loan program. It's a 30-year fixed rate loan. But FHA has a lot of different types of loan programs available. They have adjustable rate mortgages as well. They require a low down payment of only 3.5% down. So the LTV is 96.5. However, they do have a minimum repair requirement that the property needs to be in livable condition, not requiring a lot of repairs. Why do they put that requirement in place? I see a lot of times we get people who are, blue collar workers, the contractors and such. They want to buy their home and they know how to fix it up themselves. They know how to do the repairs. but yet they can't get a loan through the FHA for them. Why does the FHA do that?
To repair.
Because they want to ensure the work has been done, so people they don't take money they don't spend in another.
Well, the FHA, they're looking out for you as the consumer. You don't have a lot of money. That's why you're getting an FHA loan. In most cases, right? People don't have the 20% to put down, so they're getting an FHA loan that allows them to only put down 3.5%. So if you don't have a lot of money to buy the house, where are you going to get the money to fix it up? So they figure out that they're looking out for the consumer by requiring the house be in livable condition, not requiring a lot of repairs. You won't be able to get an FHA loan for a house that has a loose railing, or the steps are cracked or loose, or if it has lead paint that's peeling off the walls. And they require, if you're going to get an appraiser to appraise a property for an FHA loan, that appraiser has to have a special FHA designation on their license, because there's certain other things they need to look out for and make note of on the FHA appraisal form, which is they got to check for loose railings and cracked steps. They need to check and see if there's lead paint that's cracking and peeling. They got to check the stove in the kitchen to make sure that the oven works. If the oven doesn't work, you're not getting the FHA loan. If it doesn't have an oven, you're not getting an FHA loan. If the kitchen has a dishwasher, that's a big if. Doesn't require to have one, but if it has a dishwasher, the appraiser, not a home inspector, the appraiser is required to turn it on and run it through its cycles to make sure it doesn't leak. That's part of the FHA appraisal, okay? Because they got to report that stuff back to the FHA. Now, FHA loans require an upfront mortgage insurance premium called MIP to be charged at closing. Or it can be wrapped into the loan itself, which insures the lender for the entire loan in case of default. Okay, so there you have it. Did you hear what I just said there? When you get an FHA loan, the borrower is required to pay an one-time mortgage insurance premium.
One time.
But you don't have to pay it up front. You could wrap it into the loan and finance the fee. God, only a government agency will figure things out like this. You're required to pay insurance in case you default on the loan front, but then again, you don't have to pay it up front. We could also finance it too. But what if you failed to make the payments? Insurance never paid. Leave it to the government to come up with these ideas. Anyway, that's the one-time upfront monthly mortgage insurance premium you have to pay. But there's also a monthly MIP fee that you will pay as well. So the monthly MIP payment is also required and can be dropped only when equity reaches 78%. So it's the opposite with conventional loans, where you can drop your private mortgage insurance when equity reaches 20%, and it must be dropped when equity reaches 22%. Here, when equity reaches 78%, you could drop the mortgage insurance premium. But those PMI and MIP are different things. What does PMI cover? What does that insure?
PMI, that insures PMI insures.
Insure when the down payment is less than 20%?
Yes. Any down payment amount less than 20%, it insures that amount. Okay? MIP, mortgage insurance premium, insures the entire loan. It insures the lender against loss in the event the borrower defaults. So
you can drop it when you get 78%
equity, but only after you've had the loan for at least 11 years.
Okay.
If the borrower put down at least 10% at the time they got the loan. Otherwise, the insurance coverage can never be dropped. You always had this stipulation in FHA loans that the insurance premium can be dropped once equity reaches 78%. However, when President Obama was in office, just before he left office, he put in a few rules. He said the only time you could drop these PMI insurance is still when equity reaches 78%, but you had to have had the loan and paid into the mortgage insurance premium for at least 11 years. And you had to put down at least 10% at the time you got the loan. If you don't meet those requirements, you could never drop this insurance premium. You have to pay it until the last day of the loan.
Wow.
Why did he do that?
To make sure you get paid.
Yeah, pretty much. Because the FHA loans, remember, half the loans out there were FHA loans, and when they were doing all them bailouts, they were bailing out a lot of those FHA. They were paying back the lenders FHA loans so that they didn't lose a penny. Remember, because that's the purpose of an FHA insurance.
Yep.
So he knows that most people, when they get FHA loans, they only put down 3.5% because that's the minimum required. Most people getting FHA loans don't put down 10%. They could, but most don't. So if they don't, they'll never drop this insurance premium. So he just made it so that the FHA loan is an attractive loan to get into home ownership, but not one you want to stay in for the long term. So once you reach at least 20% equity, he suggests you refinance to a conventional loan, and then you don't need to carry any mortgage insurance. No PMI, no MIP. Okay? So maximum seller concession allowed for an FHA loan is 6% of the loan amount, not the purchase price. The borrower may be able to finance some of the closing costs. Any or all of the down payment and closing costs may be a gift, not a loan, from the buyer's relatives. Why not a loan? Because a loan you have to pay back.
You have to pay back.
Yeah.
To pay it back, they need to factor that into your debt to income ratio and factoring out if you could afford this loan. Right?
And the other thing, what you said, that's a good one to remember. The interest and what? That's a gift, you said?
It's a gift. The down payment and closing cost could be a gift, not a loan from the buyer's relatives. As a matter of fact, they're not stupid. They're going to, if you say that your relatives are giving you a gift for the closing cost or down payment, and it's really a loan, well, they're not going to be fooled by that. They know what people do. Sometimes they lie and say, we're just saying that it's a gift, but it'll really be a loan. I'll pay you back, you know. Well, the FHA is going to say, okay, well, we just need you to prove that it's a gift and not a loan. We're going to want your relatives that are giving you that money to sign this form. And this form basically says, this is a gift and not a loan, and it does not need to be paid back. And that's a legal contract.
Yes.
It's a letter, right?
So yeah, so if you're going to be having a relative that's going to be lending you money and you're going to just say that it's a gift just so that you can get this loan, and now you're going to have them sign a legal document that says, no, it is a gift, not a loan. It does not need to be paid back. They may be a little bit sketchy on giving that to you. Okay, so now the FHA loans before December 15th, 1989 are assumable by anyone.
Ooh, excuse me.
99, 2009. All right, they should be reaching their end of their 30 years now. So loans that were before December 15th, originated before December 15th, 1989, are assumable by anyone. But those made after this date the buyers assuming the loans have to still qualify for the loan to be able to assume it. The FHA 203K is another loan program they have. K for construction. I know that's not the way you spell construction, but it helps me remember. K, construction. This is their rehab loan. It's not a construction loan for new construction. It is one loan to cover the purchase price of the property, plus another loan for doing extensive rehabilitation work. Like if you need to remodel the kitchen, or if it has those cracked steps or loose railings or whatever, or you want to put an addition on or build a garage. Okay, that's extensive rehabilitation work.
So FHA 203K, what is 203K? That's like a
That's their loan program. It
loan
gives
program.
to buy the property, another one to fix it up.
Okay.
Okay. Now, it is to do extensive rehabilitation work. It's not construction, new construction to build something new. It's to rehab. Now, what is considered extensive rehabilitation? I'm going to show you on the coming slides. You're going to be shocked. So the amendatory clause, what's the purpose of that special amendatory clause that must be added to the purchase contract for all FHA and VA loans? It says if the house does not appraise for the purchase price, the buyer can get out of the contract without penalty, and it will not be considered in breach of contract. Now, if you're going to get an FHA loan, we just that other website, FHA.com, which is not related to the federal government in any way, that there's certain loan limits that dictate how much you could borrow from the FHA, and it's dependent by which county you live in. So here's the website. If you notice, it's not FHA.com or gov. It's enterprise.entp. It's the abbreviation for enterprise.hud.gov. Let me click on this and I'll show you. It's a database that shows you, let's see, let's search New Jersey. Okay, we're going to sort by county. And
We
we're
don't
gonna,
see it.
Okay, let me share it with you.
Okay.
Okay, so we're sorting it by county. We're going to sort by we're going to pick out the state of New Jersey. And that's all we're going to fill in. That's for the fiscal year 2025. So here's the county name in this row. And here's for 1 family, 2 family, 3 family, and 4 family, how much they're winning for that county. And here's what the median, the average sale price is in that county. So Atlanta County is one of the cheaper counties in New Jersey. So the FHA, you could get a loan up to $524,225 for a 1 family. $671,000 for a 2 family, $811,000 for a 3 family, or $1 million for a 4. Bergen County is one of the more expensive counties. For a single family house, you could get a loan of up to $1.2 million, 2 family up to $1.5 million, 3 family 1.8, and 4 family 2.3 million. Holy crap.
What is in Newark in that area, like the urban area?
That's Bergen County right there. That's Essex. Newark is Essex County. Essex County is also one of the more expensive counties. Their average sale price is $1.1 million. So they'll lend you up to $1.2 million for a single family, 1.5 for a 2 family, 1.8 for a 3, and 2.3 million for a 3 family or 4 family.
Okay, is it going by the locations?
It goes by the county that you're in. So those lending limits you have to follow. You got to realize that. How much can a borrower using the FHA loan program? Well, it depends on which county they're in and what those loan limits are by the FHA in that county. Look at Camden. Camden The average sale price is 517,000, which is that blows my mind. So they'll lend you for one family house up to 594,000 for one family, 761 for two, 920,000 for three, and up to 1.1 million for four.
I don't know if I'm looking at this wrong, but in those areas, why is it so expensive? Can you look at Somerset?
Well, you're looking at the whole county. I know you may be thinking of certain municipalities in Camden where the house is like $100,000 because it's a
Yeah, because I'm like, where am I finding a place like? Okay.
you may be thinking about some of the banged up neighborhoods over here they got.
Yeah, and I'm like, well, where is that at? I'm not paying that much money for to be in that area.
Yeah, but then again, when you think of Cape May County, you think of the beautiful shore houses that are millions of dollars, right?
Mm-hmm.
Cape May over here, the average sale price is 580. The one family they'll loan you up to 667, two family 853, three family only $1 million, and a four family 1.2 million.
Wow.
I guess if you move away from the actual beach, you'll see how the other half lives. That's the majority of the people there, so that creates the average. Right on the beach, yeah, they're expensive.
Can you just go down to Somerset real quick? I just see what their numbers look like.
Here, Somerset for one family, it's 1.2 million, 1.5 for a two, 1.8 for a three, and 2.3 million for a three, with a median price of $1.1 million.
Wow.
Yeah, that's what I said. Wow.
Yeah, Somerset County, they're a little up there.
I'm just looking at all these prices in New Jersey, it blows my mind. To think when I was in 2004, when I started in real estate,
Mm-hmm.
and these prices are crazy because that's already when we were starting on the real estate bubble.
Oh, yeah, it's going up.
And man, those figures from when we had the real estate market bubble that crashed, those figures already. But those were artificially created because of all these hedge funds purchasing entire neighborhoods and places like Zillow and Blackstone, buying up entire neighborhoods with the cash that they have on hand from investments, and then you got these people that are moving out of New York where they pay rent more than what we charge for the price of a house here that we consider a mansion.
They consider a regular home to them.
They're like, oh yeah, that's a good price. So they got the cash to lay out for that,
That's like I went to North Carolina to our family reunion, and I'm asking, it's been 5 years since we had a family reunion. I'm asking like, where's all my family at? Because they're all over North Carolina, not just in one city. And a lot of them moved to South Carolina. I was like, well, why is everybody in South Carolina? They said because everybody's moving to North Carolina, like the superstars, the celebrities, and they're buying.
Yeah, they're driving up the prices. Well, why is everybody Jersey? Well, they're moving to California, and it's still a liberal state like what they're used to, but the prices are cheaper by comparison, and the politics is still the same. The prices are cheaper by comparison, and it's safer and cleaner.
Yeah.
Even though we're getting pretty messed up compared to what we used to be, it's still safer and cheaper than California.
Yes.
Too. People are getting there's walking in the street just getting punched in the face at random just because, they're like, all right, time to get out. And, they moved to New Jersey as well. So these people with all this money are really willing to buy the real estate at much inflated prices. They could stay close to New York and still have those cheaper places, safer neighborhoods, and probably better schools. Even though all of their stuff is going downhill, it's still better than what they got right now. And the people in New Jersey then are moving out of New Jersey, and they're going like to Texas and Florida and those states because they're like, those are really safer states. Those are cheaper taxes, lower cost of living. So we're going to move over there. So it's like everybody's like switching places with migration. If you take Ottawa class, by the way, to see the market updates. That guy will show you. He gets the data from different databases and resources, and and they compile these reports, and he shows you where people are moving from. In this region of New Jersey, we got people moving out to this area and this area, based on moving company data of, people hire moving companies to do the moving for them. So they keep track of that data of where people are moving from and to, so it's really interesting how they compile their data and get their information from. But it's accurate.
Now I have a question, another one. Now that you brought up North Carolina, and this is going to be it. When they had that huge fire over there, they say half of the fire hydrants wasn't filled up with water. And if that's usually not like a high risk place,
they had the same thing like California did, or Hawaii. That was Hawaii, right? No, California.
No, California.
California had those fires too. Yeah.
That's what I'm talking about. California. I said you mentioned California. I said while we're on California, remember when they had all those fires this year?
Yeah.
And they were saying like that fire hydrants some of them wasn't working because they haven't serviced them in so long.
The fire trucks, they got like 150,000 fire trucks sitting in storage yards that don't work, and then they got all these fire hydrants that don't have water because the reservoir was broken and they didn't fix it. It's really all bullshit because they do have water in the highlands. It's just that to avoid affecting some little species of obscure little minnow or fish. Instead of taking that water runoff from the mountain range and using it for fire and to put into the reservoir, they divert it out to the ocean.
So how did insurance cover all those fires?
I wouldn't. Insurance companies actually started pulling out of those areas and notifying them before that fire. They're dropping their insurance coverage. Some of those people didn't have insurance because insurance companies were dropping them because there's no fire, there's no hydrants, there's no fire response, there's no reservoir. It's because of the politics in that area. The insurance company says it's too much risk. You're living in a high risk area as it is, and we're giving you insurance. And we don't think we can even insure you anymore because the risk is just getting too great. How the politicians didn't know that? That's bullshit.
Mm-hmm.
All right. FHA has approved condos. If you're going to buy a condominium with an FHA loan, the complex needs to be FHA approved. In order to get FHA approved, the condominium complex, most of the units had to have already been sold, with more than half of them being owner occupants, not renter occupants. Because owners take better care of the property than renters. So they're looking after the owner once again, that if you buy in an FHA condo complex, that the property value is not going to be going down because you got a bunch of renters there that don't give a crap about the property. And the construction had to be up to a certain minimum standard, and the finances have to be in order. So they have to fill out these applications and information and submit it to get their complex approved. And it needs to be reapproved once every 20 years. So let's use this database and go to this database here. Am I sharing the window with you?
Yes, the condominiums. Yes.
Okay. So let's look at condo names and look up New Jersey. And let's look up Edison. Edison has a lot of condos, right?
Yeah.
So let's look up Edison. Let's see how many condo complexes in Edison are FHA approved.
Okay.
So let me pull them up here for you. And let's see. Here we see one condo complex. This is actually an older complex. It's called Aspen. It has 102 residential units. Approximately almost 2% of the
Okay.
have FHA loans already. It was so it's been around for a long time. It's an older complex, so it's older than 20 years. Some of the to get an FHA loan, it looks like in 2018, and they tried to submit the package to get it reapproved, but it looks like it was rejected because they didn't submit a complete package and they didn't follow up with giving the additional information that was needed. So they probably switched and changed their mind and ended up getting a conventional loan instead, or some other loan. Look at this. You can see a lot of complexes here that already have FHA loans in them. Let's see. Let's look at this one. Expired, withdrawn, rejected, expired, rejected, expired, withdrawn, rejected, expired, rejected. None. Not one. Not one complex in all medicine is approved for FHA loans right now. Now, they have been approved in the past, but since then, nobody submitted an FHA application along with information to try to get it reapproved. Either that or they didn't meet the requirements of the FHA. Even worse.
So they got approved, and then I guess after that term, they just never reapproved it again. They never.
Yeah, after 20 years, the complex's FHA approval expires, and then they need to resubmit the package through the management and stuff to be able to get it reapproved for FHA loans. So new people getting FHA loans to buy in there can get FHA loans.
So that means nobody's really applying for those FHA loans. So they ain't having to submit another packet.
Yeah, they're submitting packages, but then they're not following up with getting it. I guess they figured it's too much of a hassle. So then they changed the type of loan that they could get. Because there are conventional loans out there that could offer low down payments as low as 5% or 3%, even though the they can find them that offer lower. All right. Now, FHA home, the borrower doesn't pay their mortgage and they need to foreclose. FHA turns over their foreclosed homes to HUD. So you cannot call HUD homes foreclosures because they're not foreclosed. They're now owned by HUD. They were foreclosed by the FHA. The FHA then gave it to HUD for HUD to sell. But right now, we had a little bit of a housing crisis with all this illegal immigration, where the government needed to find housing for people. They were overpaying rent. They were paying rents for hotels and motels and shut down motels. They were reopening to put all the illegal aliens in them, and then pay outrageous rates for rentals. So HUD figured, hey, you know what? Government's got a lot of homes that were foreclosed on. Let's give them to local housing agencies or what do you call it? The local governments that need to put people up in housing. Usually these HUD homes go up for auction for the public to buy, but they can give priority to governmental agencies if they need them. You know, they also put these homes were also available for teachers and police and firemen for $1.
For what?
$1.
That's what I thought I heard.
Okay. So why did it do that? Well, they're only available for police, fire, and teachers because they figure that some of these homes are in neighborhoods that may be a little bit banged up, and by introducing these people into the neighborhoods and then becoming your neighbor, instead of people being scared of police and firemen and teachers or whatever, they figure that they'll elevate the neighborhood by becoming friends with everybody, seeing that they're normal people and mixing up, and probably improve the neighborhood and I don't know what the hell their thinking is, but anyway, something along those lines. So HUD-owned homes, we could go to the HUD home store. Ooh, what the hell happened here? Oh, it's not. Oh, they got to do some improvements. Okay. So this is their link. For some reason, it's not working. I guess the cipher mismatch. Okay, they need to update their security certificate, their SSL security certificate. So until they do that, it's not available right now. Yeah, there's nothing we could do to bring that up. It's not going to come up. These modern browsers don't allow you. Oh, there we go. Maybe they do. It came up now. So here's the
Oh,
homestore.gov. Is
you
that
don't see that.
slide? Hold on a second. Oh, you guys are not even seeing any of this. Okay, hold on a second. HUDHomestore.com. Okay, so HUDHomestore.com, I kept refreshing, and then it eventually opened.
Oh,
Now it takes you to HUDHomestore.gov. So this is what I did. I took you to .com, and I did this. And then I just kept doing this, and then I deleted everything in the front there, went like that, and it forwarded now to HUDHomestore.gov. Okay, so that's the new link apparently. So let me update that link. I'll copy it. This is the place where you could get foreclosed FHA properties. They're now called HUD homes. Now, only real estate agents who are can make offers on homes. So your broker should have an NAID number. You should, as a real estate agent, you need to get HUD approved too. There's a class you need to take, and you could get your own NAID number as well. And you could get listings from HUD homes or place offers on HUD auction homes. Well, let's take a look and see bid results. Ooh, okay, forget about bid results for now. Let's just take a look and see. Here we go. Here's the country. It looks like there's HUD homes available in all states except for Vermont and New Hampshire right now. But if I do this, it'll tell you how many homes are available in each state. Now, I'm going to tell you, in the past, as long as I've been in this business, there's been hundreds, if not thousands of homes in each and every state available. These are foreclosed FHA properties. So immigration and them giving these properties to local agencies to provide housing and stuff. Let's take a little peek and see how many homes are available now. Let's try to sneak in here and get to New Jersey. 10.
10.
10.
That means only 10 is in foreclosure. In the whole thing.
Only 10 they didn't turn over to the federal government yet to use. This one is this one looks like it's a condo or something. 635,000. That's
Essex County.
That's pretty expensive for a home. Usually you can get great deals on these things too. Jeez, I wonder how much the price is if it's not a HUD home. This one, 570,000. These are auctions where you bid on them. This is in Cranberry. Oh, Cranberry's a nice area. 570.
Yeah.
That's probably below the average price.
What's the GP code? Jeep code did you put?
What's the what?
Which city you looking for or zip code?
I know.
New Jersey.
Just did New Jersey as a whole, just to see.
Okay.
In the whole state of New Jersey, there's only 10 homes available. These are the homes that are currently available. The auction.
Good thing.
This auction open bidding starts at 9:22 as well.
These are all foreclosure?
These are foreclosed HUD properties, yes.
Oh.
So FHA foreclosures. Okay, here we go. Here's one in Woodbury, 225,000. This looks like it's a condo, but a townhouse. 305,000. Sussex County. Sewell, 215.
What's this 100 Manville? I know
The 305 one is a good house, right? It looks
but that's
big.
just a lot. There ain't no house on there.
This one's just a lot. Yeah, 0 beds, 0 baths. Yeah, $110,000 though. In a flood prone area.
I was about to say Manville. Yes, it is a flood area.
All right.
Why 0? Oh.
But this is the resource of where you could find FHA foreclosed properties, okay? And then we got the FHA.com, which I already went to. So let me copy these links and I'll share them with you, but I have to replace that HUD home store because that link is not.
No. The link is okay, but you just have to take out HTTP as the security one.
Yeah.
semicolon that, and then it's gonna be
Yeah.
gonna work.
It's .gov, not .com.
It forwards to HUD.gov though. They changed.
Mm.
There's no more HUD.com. HUDhomestore.com. If you go to HUDhomestore.com, they only set up a forward from for those that type in the browser www.HUDhomestore.com. They should have also set it up to forward from HTTPS and HTTP HUDhomestore.com to go to HUDhomestore.gov, but they didn't do that. So whatever, that's their. I used to be in IT. I know what they're doing here. Okay, so let's.
Jack of all trades, aren't you?
Yeah. C certified car mechanic, computer program. I was in managing mainframes, and I dealt with Unix servers and all kinds of good stuff like that. And then I went to real estate, and I've been in real estate since 2004.
You
Yeah.
must like this better. You're a people person, I could see.
Yeah. Yeah. Hit them all equally.
Victor, one of the house I click on it, the 2000, 15,000, it says availability of home is subject to the assets manager accepting bid from earlier. That means it is not in market?
And accepting a bid from an earlier bid period and removing the home from the market. Yeah, I don't know what that means.
They removed it?
You'd have to come them and look into it.
No, I just click on one of them and I said, let me see.
Their home is up here for auction, and not all homes sell at auction. If they don't get their minimum bid or whatever, or if they don't sell at auction, it'll eventually auction again. So if a bid came in and they were working something out, and that one hasn't been killed yet, before it goes back up on the market, they got to kill it or something. That's probably what they're talking about, that deal.
I see. Okay.
Okay, so I just shared with you guys all that information.
Nice.
It also makes sense for me to state that in the ClassLinks Word document for your notes. So let me just do a search for HUD Home Store. HUD Home Store. And I'll replace those links up here. Boom. Done. And another location. Where that is.
The 20th. When is the 20th?
All right.
That's tomorrow. Oh no.
So those notes have been updated. So let's go back to the slideshow. And now we'll do all the highlights about HUD in the book. Page 276, get these highlights. Let me know when you got it. I'll move to the next slide. You could get the next highlights.
Alone, that is not me. Where are you at? FBA, FHA loan. Yeah, but I got that one. Loan, that is.
Okay.
All right, everybody got it?
1 second.
All right.
They are, what is that at? Most FHR.
See, that's why my one slide has everything you need to know about FHA in one slide. And into the book, and now you're highlighting stuff on the next couple of pages pertaining to it.
Okay, I'm done.
All right. Next, highlight this stuff. You don't need to write these notes down here right now, but just highlight this stuff. After we do the highlights here for the FHA stuff,
Hello.
we're pretty much here at the end of the end of the class already, but I'm going to continue recording this and teaching it here even after you guys are gone, so that I could make sure that you have one complete video here for this, and I'll upload it so you guys can watch it and get the rest of it. If you're leaving right away, that's fine. Otherwise, I'm going to stay here and talking to myself about like I'm teaching you guys the class, and I'll record it. Okay. So you'll have it for the weekend here. Oh.
I'm here.
Okay. All right.
Okay.
This can like this as well. This is on page 277. This is continuing the things to highlight about FHA loans. The interesting thing here, they show you that FHA allows down payments as low as 3.5%. And the interesting thing here is they show you that lenders will consider applicants with credit scores as low as 580. Well, you know what? The FHA actually has no credit score requirement whatsoever. It's the local lenders that do. That's what I wrote here. Lenders may consider applicants with credit scores as low as 580. And we just went to that one website where they showed you that they'll allow you credit scores below 580, except you need to put down more money. Okay.
Is this cross out will and put lenders may consider applicants?
Yeah, where it says will, I just crossed out will and I wrote lenders may. Okay, because the FHA doesn't have a credit score requirement at all. It's
Can you repeat one more time?
The FHA doesn't have a credit score requirement at all.
Okay.
It is the local lenders that do.
Yeah.
And it's usually 620 is considered prime, and anything below 620 is considered a poor credit score, and it's subprime. And they would give loans to people as low as 580. However, if you're below 580, you need to put more money down. Actually, at below 620, you needed to put more money down, but apparently a lot of lenders will accept as low as 580, with still requiring only a 3.5% down payment. I just question what you're probably not getting is the best rate. You know, because you got that poor credit score. And then
but some
580, you don't only have a poor credit score, but they want you to put more money down because you're
but sometimes we hear that loan not approved. What does that mean? Very low credit score, that's why?
It could be your credit score, it could be your income, it could be your debts, it could be your debt to income ratio, could be money you're putting down. It's too much risk to the lender, so they don't approve you. Okay, everybody got this?
Yes.
Yeah. Oh, minimum repairs allowed. Okay.
Yeah, they have minimum repair requirements, right? Okay, next page. FHA loans are for owner-occupied properties. Right now, we've been seeing in the news about what was that lady? Was that Letitia James that was going after Donald Trump, the prosecutor? She was saying that he was committing mortgage fraud because he overestimated the value of his property, and everybody in the right mind in the world, they're like, no, Mar-a-Lago is worth more even than what he estimated that it's worth, you know. But she took him to court over this, trying to get him, trying to get Trump.
About his property in New York, right?
Well,
yeah, I remember hearing about that.
As well as the one in Florida, you know, nothing could be further from the truth. Even the lenders that loaned the money said, well, it's our obligation to do our own research to see, but we don't rely on the consumer and how much they tell us their home is worth. It's our obligation to do that. And we decide who we want to do business with. And we did business with him. He paid it back early, and we definitely like to do business with him again. But yet she was going after him, trying to get Trump, right? So the interesting thing there now is we're seeing that now she's up on charges for mortgage fraud because she got an FHA loan on the house
On that kind of income?
that she claimed was her prime, or anybody with income can apply for an FHA loan. You know, the thing is, FHA loans are for owner-occupied properties.
Yeah, she's not occupying it.
She claims she occupies this home, but she does not. This home is in a different state. She's a prosecutor in New York. She's supposed to live in New York, right? She's got a house in New York that she claims is her primary residence on her employment stuff, but yet on her loan application, she's got a loan that's for a FHA loan for a house in a different state that she claims she's the owner of. So you tell me that's not mortgage fraud when you loan a loan application saying you're going to live here and then you don't. Okay, so FHA loans must intend to be owner occupied, 1 to 4 family properties. Now, she didn't intend to live there at all because she got that loan after she's already the prosecutor in New York. You know, already got a house she's living in and ain't planning on moving out of it.
With that type of income, how could you afford those type of loans?
Oh, she makes good money.
Right, but I thought those type of loans for people that don't make good money.
No, they're for anybody. Anybody can get them.
Oh.
You just need to meet the qualifications. You need to your debt to income ratio, how much money you make, how much your credit score, how much money you're putting down. You know, as long as you meet the requirements and your property meets the requirements, you can get the loan. Anybody can get the FHA loan. Yeah. All right.
Hold on, get that last written note.
Can get out of contract without penalty. That's the purpose of the special and mandatory clause required for all FHA and VA loans. If the house does not replace the purchase price, the buyer can get out of the contract without penalty.
Sounds good.
All right, everybody got those notes?
Yeah.
All right. Oh. So here's that FHA 203K loan. Remember I told you for construction, it's a rehab loan? This is a house around the corner from me. Now, I don't know if they used an FHA loan for this, but I've seen the same exact thing where people bought a house using an FHA 203K loan. One loan used to buy the house and another one used for extensive remodeling, for remodeling kitchens or putting an addition on a house. People do this. Look at this. They tore down the entire house except for the garage and one wall. Here's another perspective. You see the garage here and one wall?
Oh, it's actually a whole house right there at one point.
Yeah, actually they ended up taking down this wall. It's just the power company didn't come to take down this power line yet.
So they couldn't knock it down.
So they took that down, then they tore down that wall. They dug the basement deeper and further out, made the house even bigger. It's an old builder's trick. If you leave one original wall standing from a house, it's not new construction.
Nope.
It's a remodeling. So in the tax records, this house shows as, even right now, built in 1953 or 55 or whatever it is, remodeled in 2024. Does that look like a remodel? Looks like
one wall.
A new one. And here it is in the construction phases. This house is 3.5 times the size of the neighbors on both sides. I'm showing you the various forms of the stages of the construction. Look at this. This house is huge compared to these houses next door.
Yeah, on that little lot.
Look at this.
You ain't got no land.
So this house has a full upstairs. See, these ones are just the pitched roof upstairs, you know. This one, it's got a full second floor and an attic above that. Even a garage. These houses don't have living space above the garage. You see that?
Yeah.
Now, with that house, because it's so, wow.
Look at the aerial view. Boom.
Now, would that house bring value to the other houses on that block?
Yeah, it looks like the neighborhood when they start doing this all over the neighborhood, which they are now. But this is an example of an old builder's trick to try to avoid the tax man's reassessing the value of your property. Yeah. In the tax records, it still shows this house was built in 1950 something. In actuality, the whole house is new. The only thing that's existing is the garage walls. And they built a whole new house around it. The basement, they dug deeper, they poured new concrete. Like, there's nothing original except for the garage, a wall in the garage. And that's because in most municipalities, the tax man and the building department don't speak to each other. Usually across the hall or next door to each other in City Hall.
They enemy now.
With each other. And municipalities in the state of New Jersey, the tax man actually talks to the building department.
What city is that?
I don't know, but you could probably count it on one hand.
Nah, the builders don't like the city. The city come after every permit and everything. You ain't have to have all those permits like they used to. You need a permit.
Okay, these are formally known as GI loans. That's for general issue. So these are loans that are given to veterans. They're intended for veteran occupied 1 to 4 family homes. They're not again for investment properties, but for veteran owned or veteran co-owned homes.
Do you have anything open?
I'm sorry?
Do you have anything open on your screen?
Oh yeah, here. Can you see it now?
No, I see it, but you're mumbling again. I mean, not mumbling, but it's blacking you out. So I just wanted to know if you covered it.
Check the optimization. No, everything should. All right. There we go. The audio. I shut it off. Okay, for the sharing. Okay, can you hear me now?
Yeah.
Okay.
Hopefully now it's good.
All right, good. So VA loans, these are formerly the GI loans. These are loans that are guaranteed by the Department of Veterans Affairs. They're intended only for veteran co-owned occupied 1 to 4 family homes. They're not investment properties. They're for veterans. So the VA no longer, they changed the rules here in 2021 that the VA no longer has lending limits, and they will guarantee 25% of the loan for properties over $144,000. That's weird. They no longer have a maximum that they'll lend, but they do have a minimum now, which they did not before. It's now the minimum is $144,000 that they'll lend. So therefore, no down payment is required. So these loans can be 100% financing for the veteran. So it depends on the lender and the borrower. Sometimes the lender may require a little down payment, but the loan is still based on your credit history, income, and assets of the veteran. Just like with the FHA loans, there has to be a special amendatory clause that says that the veteran fails to make the payments. Oh, I'm sorry, if the house does not appraise for the purchase price, the veteran can get out of the contract without penalty and not be in breach of contract. Now, here's something interesting. The appraisal statement for a VA loan is called a CRV, a certificate of value. And this is going to be on exam. What do you call the appraisal statement for a VA loan? CRV, certificate of reasonable value. Yeah, I just tell people here's a way to remember it, and then they usually do, even though it's kind of weird. Just remember one of the most popular cars out there is the Honda CRV.
I was going to say the same thing.
For some reason, people remember it, whatever works for you, It's not the car that's on top of my head, but it is apparently for a lot of people. So the Honda CRV, one of the more popular cars out there, that's how I relate to remembering what do you call the appraisal statement for a VA loan? It's a certificate of reasonable value, a CRV. That'll usually be on an exam. Discount points can be paid by the seller, buyer, or shared between them, just like with any other loan. And the funding application fee. There is an application or funding fee that must be paid by the veteran. or it can be paid by the seller. Now, how much that funding fee costs may vary depending on the amount of down payment. And if the veteran is a National Guardsman or reservist, they pay higher funding fees. VA loans can be assumed by anyone who does not need to be a veteran. You need to be a veteran in order to get a VA loan. You do not need to be a veteran to assume a VA loan.
Wait, but at the beginning it says intended for veterans, owner, and co-owners occupy one of four families. Then out here it says VA loans can be assumed by anyone.
Yes. Well, you need to be a veteran to get the loan.
I need a veteran to get a loan.
You need to be a veteran. You either it's either you either own the home to use to get a loan to buy a house. There has to be a veteran that's one of the owners.
Oh, okay.
Okay, and they need to occupy it. It's supposed to be veteran owned or co-owned by the veteran and occupied by the veteran.
Okay.
Okay? It's not supposed to be an investment property. However, anybody can assume a VA loan and take over the payments on it.
Oh, okay.
You need to be a veteran to take over a VA loan. Often that's an exam question too. Now, to get a VA loan, whatever you meet your requirements to get any veteran benefit. Okay.
I don't think your computer likes you after 5 o'clock.
Right.
The last two sentences you said, nothing came out but.
Really?
But like even on a recorder, I wouldn't know what you're saying.
That's weird.
Basically said you need to be a veteran to get the VA loan, but not to assume a VA loan. You don't need to be a veteran to assume a VA loan. The eligibility requirements to get a VA loan are you need to have served 90 consecutive active duty during wartime or 180 days of active service during peacetime, or served 6 years in the reserves or the National Guard. And then I've got my resources down below for veterans. And this stuff is also in the class links Word document. And I also mentioned here Stripes and Band of Brothers. These are good movies to deal with veterans and military, if you guys ever seen them. If you haven't, watch Stripes. It's a comedy. It's funny as hell with Bill Murray and those guys from Ghostbusters.
Oh, God.
Okay. Stripes.
2-3 movies to watch.
80s, but it's a fun. Have you ever seen it? Now you're breaking up on me.
No, I haven't seen Stripes, but I'm going to look. I got 3 movies that I got written down on my list.
Yep, Stripes is very good. And an HBO miniseries, Band of Brothers, that's like a 10-part series. It runs like, each one is like 2 hours long.
Wow.
I got that set on DVD, but you could watch it on streaming Amazon too. It is excellent. If you like war movies, it is it's an accurate historical reenactment, I guess, with a fictitious story using the actually it's not based on a fictitious story, it's based on a real story, because as they show you the different series, they actually interview some of the actual veterans that were there at these conflicts. All right. So anyway, VA loans, you need to be a veteran to get them. And the VA guarantees 25% of the payment. So no 100% financing is possible. VA loans require that special amendatory clause, just like the FHA loan. And certificate of reasonable value is which the CRV is what you call the appraisal statement for a VA loan. So let's do those highlights now in the book. can be assumed by non-veterans.
Loan is made by a local lender.
You do all this highlighting, and then where it says no down payment, you could put 100% financing possible, or
Veterans can purchase a single home dwelling.
Right here.
what's that? Yeah, I'm getting a little bit of the breakup now from you guys too when you're talking.
No max.
Ah, yeah. Sorry.
All right, just let me know when you got all the highlights down here. It's 278 under guaranteed loans.
No down payment.
What is that? VA
VA guarantees at the time.
loan.
Yep. So next to the title, you write can be assumed by non-veterans. Then you highlight loan is made by the local lending institution. The VA guarantees the top 25% of the loan, so no down payments necessary for VA guaranteed loans. In other words, the veteran can get 100% financing, no money down, depending on the lender. And this could be used for the veteran to purchase a one-family, single-family, or an owner-occupied 2 to 4 unit home. Not for investments. So the veteran has to live there. And the VA appraisal statement is called a CRV, Certificate of Reasonable Value. And as with FHA loans, VA loans have to have that special amendatory clause that said that if the appraisal comes in lower than the purchase price, the veteran can get out of the contract without penalty. Or at the veteran's option, reach deep down in their pocket and pull out cash and pay the difference at closing. But why would you want to pay more than what an appraiser just said your home is worth?
Okay, guys. It was a great week. I have to log off.
Okie dokie.
The keywords, it's going to be in this video, right?
Yes, we're going to go through the keywords, the key terms right after. We got one more thing to go over here, and then we're going to do the key terms, and then we're going to be done.
Okay. All right, everyone have a great weekend. See you on Monday.
You too.
You too.
Bye-bye.
All right.
Okay.
You got all the notes?
Yep.
Mm-hmm.
All right. So we have the NJHMFA, New Jersey Mortgage Housing Finance Agency. They offer below market interest loans with low rates, with little or no down payment to qualified buyers, not investors, only owner occupants, for people who live in urban target areas. They apply through the various approved lenders, and they could get these loans interest-free of up to $10,000 for installing water filtration systems. Remember that? We spoke about that in an earlier chapter. That was coming through the NJHMFA as well. The interest-free loans up to $10,000 to put in for people who are on water to be able to get those water filtration systems put in. And they also have loans for first-time home buyers for down payments that don't need to be paid back. with down payments that don't need to be paid back. But there's a little catch to that. You have to live in the house for a certain period of time. Loans for first-time buyers for down payments that don't need to be paid back. Okay. So here's the contact information for their websites and such. And they have their own bank-owned properties as well, the ones that they foreclose on. And here's their link for their REO properties. I have them in the class links Word document as well. Let's take a look now. Do the highlights for this. New Jersey Housing Mortgage Finance Agency offers below market interest loans with little to no down payment to qualified buyers who purchase homes in urban target areas, and then underline urban target area, because you'll get a question on exam. Which one of these loans are for people in urban target areas, or loans for NJHMFA for what areas, you know? And these loans are
can you?
For family occupied. Yeah, go ahead. What?
Can you please repeat the question again?
No, there's no question. I just said these homes are for people who live in urban target areas, who are buying homes in urban target areas.
And related exam, you said something.
Yeah, you need to know that it's in an urban target area. What type of loan?
Okay.
You know, or what area do HMFA loans for people who live in urban target areas?
Okay.
Okay, so here's that down payment assistance program they have called the DPA. It's they have first-time homebuyer loans. Now, you know, you could have owned a home in the past and still be considered a first-time home buyer. A first-time home buyer is defined as somebody who did not own a house in the last 3 years. So you could qualify for the first-time homebuyer program if you didn't own a home in the last 3 years. The borrower's income must not exceed 140% of the area's median income to qualify for the loan. A second loan of up to $15,000 for the down payment assistance programs available, in addition to another $7,000 for first-generation home buyers, for a total of $22,000 that you don't have to pay back. So it must be combined with one of their 30-year fixed rate loans, insured loans. The buyers used to have to take a class to qualify for the loan. It was like a class that taught you how to balance your checkbook and how to like replace a washer and a sink and an air filter, so that you don't got to go calling specialists every time you need help with something and then realize, oh my God, I can't afford this house. It's the money pit. So the way the second loan for the down payment works is this. You got to live in the house for at least 5 years. If you do, you don't pay any of that money back that they gave you for down payment and closing costs. 4 years, if you sell it, you got to pay 25%. 3 years, 50%. 2 years, 75%. A year or less, you got to pay back all of the money for the down payment. Okay. So if you live in that house for at least 5 years, you don't got to pay any of it back though. And here's some more resources for the different types of loan programs they have. They have fixed rate conventional 30-year loans, first time home buyer loans, home 30-year fixed rate loan. I don't know what the difference is between these. You'd need to contact them. They've got a loan for New Jersey police and firefighter pension systems. And they have that down payment assistance program, which is self-liquidating, meaning if you're in the house for at least 5 years before you sell it, you don't pay any of it back. And so these are the resources on their websites: njhousing.gov, theroadhomenj.com, and 1-800-NJ-HOUSE. And here I've got links for their water filtration systems where you can get that $10,000 interest-free loan. They've got mortgage calculators here at this link and whatnot. I've got all these links in the class links Word document. Okay, and then lastly, this is the last thing we got for this chapter, the REC D. That's the Rural Economic Community Development, formerly the Farmers Home Association. These are loans for people for 1 to 4 family homes, once again, not for investors, for low to moderate income, first-time homeowners, not just and farmers, and people, anybody living in rural areas. You can get these loans with a subsidized interest rate as low as 1%. 1% interest rate on a loan. No money down, 100% financing, 1% interest rate to buy a home in a rural area. That's what this is. And you get the loan directly from the USDA, the Department of Agriculture is the one that funds it. What was your question? Did you have a question, Raphael?
I said, does serious this program does exist in reality?
This is for rural areas, you know. We do have, like, Middlesex County, Union County are not in rural areas. Somerset County, a lot of it is considered rural, you know. It depends where you are. They used to have a map on their website that was interactive, but now there's, I think, a form you could fill out with an address and it'll tell you if that's a rural area or not. But you got to find it. They buried it on the website. Okay, their website is rd.usda.gov. Okay, and you really got to browse through it to find it, though. It used to be on the front page. Now it's hidden amongst layers. You got to browse their website. Okay, so here's what you need to highlight in your book, and then we'll do the key terms to review. So they're loans funded by the USDA for rural area homes. You just write that next to the title of Farmers Home Loan. Loans funded by the USDA for rural area homes. Formerly called the Farmers Home Loan Administration. Now it's called the Rural Economic Community Development, or the REC-D. So these are for low to moderate income. It's not just low income. First-time home buyers who buy homes in rural areas. That includes farmers or just anybody who's living in a rural area, where you could get 100% financing on the loan and interest rates as low as 1%.
Wow.
That is, yeah, wow is right.
Can be as in by non.
Resource there, you know. You got the notes?
Yeah.
Only one sentence.
Okay, I'll give you a second.
I'm good.
And that concludes this chapter, so we'll do the key terms to review now.
Ooh, yeah, that's interesting.
There's 2 of them. All right, let's see how well we do. Mortgage payments can be taken over by the next buyer.
Okay, 1 minute. Mortgage payment can be taken over by next buyer.
That can be taken over. A mortgage loan that can be taken over by someone else. They could just take over your payments. What do we call that?
Can be buy down? Buy down? No.
When somebody can take over your mortgage payments, it's called assumable. It's an assumable. Yeah, 3 is A. The highest interest rate ever allowed on a specific adjustable loan.
Ceiling. Cap.
So 7 is B, the ceiling.
Yeah.
Payment plan, the equivalent of 13 monthly payments per year.
Oh yeah, I like it. That one is biweekly.
Yep. 4 is C, the biweekly mortgage. A plan with interest rates periodically changed up or down.
Buy down?
No, what kind of loan do the interest rates go up and down?
Adjustable rate mortgage.
There you go. One is D. All you gotta do is rephrase the statement that they have here and you could figure it out, you know? So don't rush to the answers. Look through the, try to rephrase it in your head there. So one is D.
Right.
A written estimate of value by a real estate licensee, not an appraiser.
Return. Amortized loan. Return estimate of
Certificate or reasonable value.
real estate.
No, no.
tax.
Written estimate of value by a real estate licensee. That's us. How do we value people's homes? What do we do to value people's homes? We can't call it an appraisal.
Equity.
Cap, no, cap, no.
By amortized loan.
It's not a loan we're looking for. We're talking about a written estimate of value. How do we as real estate agents help people determine the value of their homes? What do? We don't do appraisals. What do we do? What is it called that we do? We can't call it an appraisal because we're not licensed appraisers. So what do we do to help people value their homes?
Or the reasonable value, certificate of reasonable value.
Reasonable value? No.
That's what you call an appraiser's statement for a veteran's loan.
Mm.
We do CMAs, a comparative market
Oh
analysis.
yeah, CMA.
We need to study these terms.
Yeah, return
HSE.
estimate.
A repayment plan of principal and interest that gradually reduces debt.
Ah, that's equity.
What do
Write
you,
down.
I was like, a repayment plan that where your month, let's see, a repayment plan of principal and interest that gradually reduces debt until your balance is zero. Your first mortgage payment all the way through to the, oh wait, I don't want to say that. What do we call that? Where your monthly payment pays off your debt, reducing your debt.
Amortize
Amortized loan. The
Loan, yeah, because amortizing
yeah,
go off over time, right? So you're
over
killing
time, right?
over time. So 2 is F. A percentage beyond which interest rate cannot be raised at adjustment.
Oh, that's a cap.
That's the cap. 6 is G. Payment of extra points in return for a lower interest rate.
Payment of extra point.
Yeah,
Buy down.
it's a buy down. 5 is H. You're buying a lower interest rate.
I missed that.
Yeah, 5 is H. A difference between the current value and the money that's owed on the property.
That's equity.
That is equity. 10 is I.
Equity.
What do we call the VA appraisal statement?
Certificate of reasonable value.
The CRV, Certificate of Reasonable Value. 9 is J. All right, let's do key terms 2.
Yeah.
A loan that is guaranteed by the federal government, not insured, but guaranteed by the federal government. Who guarantees loans?
FHA?
No, the FHA.
No, guarantee. Guarantee. Private mortgage insurance.
Nope, that's insurance.
Straight loan.
VA mortgage?
It's a VA mortgage.
Oh, that's the federal.
Veterans is, yeah, the Department of Veterans Affairs guarantees 25% of the loan amount. 10 is
Oh,
protection for lender on low down payment conventional mortgage.
protection for lender.
Yeah,
Okay, low
low down payment. Less than 20% to be
Yeah,
particular.
less than.
Private mortgage insurance?
PMI.
7 is B. PMI, private mortgage.
Yes.
7 is B. Mortgage payment including amortization, interest, and certain expenses.
PT.
PT?
Yep, it's a pity loan. And what is a pity also known as?
I'm
You-
sorry?
What is a pity loan also known as? Pity loan is right, so 5 is C. But what is a pity loan also known as?
Payment and interest.
What do we call? Not what it stands for. It stands for principal, interest, taxes, and insurance.
Yeah. What is that?
What do you call the loan, the pity loan, that includes all of those payments in one payment, in one mortgage loan payment? It's also referred to as a budget loan.
Oh, yes.
So you may want to write that next to pity there. Right?
Yes, I did. Budget loan. Yes.
Percentage of property's value that may be borrowed.
Percentage.
Yeah, the percentage of a property's value that may be borrowed.
Point.
Loan to value ratio.
The LTV, the loan to value
Oh,
ratio.
LTV. Yeah, LTV.
D, that's the loan to value ratio. Or
LTV.
lender agrees to hold the interest rate for a certain period of time.
Hold rate lock.
It's a rate lock. 8 is E. 1% of a loan amount charged as an upfront interest when the loan is made.
Point.
6 is F. Low down payment insured mortgage loan.
Low down payment, insure mortgage loan. Low down.
Yeah, who insures mortgage loans?
Private mortgage insurance.
No. No. Who insures mortgage loans?
FHA.
What kind of loans that require low down?
Straight loan. Straight loan.
Listen to me, listen to me. What kind of loans require a low payment? And these loans are insured because the down payment is so low.
FHA? No.
Yeah, FHA. One is G. FHA 203. That's their most popular loan. They require low down payment, only 3.5% down. Right? And those loans are insured. The FHA says, lend your money to this borrower and we will insure you against loss, right?
Oh, that's the one, right?
Yeah, one is G.
FHA.
That's the FHA loan, the FHA 203B to be specific, but FHA loan. A mortgage with payments of interest only. What do we call those?
Interest only. Mortgage with payments of interest only.
Yep. What do we call interest only loans?
Interest?
Straight loan.
Straight loan.
Straight loan.
Straight loan. 9 is H. A charge for the use of other people's money.
Interest.
Yeah, that's the interest.
Yes. 3 is I. A guide to national mortgage trends used for adjustable rate mortgages.
Index.
An index. 2 is J. There you go. And that concludes chapter 14. I told you,
Wow.
chapter had a lot of stuff in it and it was long.